Good morning. I'm Alexis Christoforous.
I'm Miles Upton in for Brian Sazi. This is a Yahoo Finance special report, the November jobs report, due out in about 30 seconds.
And we're going to dig into this report from top to bottom to figure out what it means for your portfolio and the economy, especially ahead of that Fed meeting next week and with all the bad news this week on manufacturing. And all in all, Miles, it looks like we are looking for a solid jobs report, although we're probably going to see a slowdown in the number of jobs added.
Well, we're looking for about a 50,000 job kind of artificial boost from the GM strike being resolved, so we'll have to kind of back that number out. Unemployment rate expected to stay at around 3.6%, but we'll kind of see where we shake out.
All right, we've got those numbers. We're going to go to Jessica Smith live at the Labor Department with the very latest. Jessica.
266,000 non-farm payrolls rose by 266,000 in November, surpassing expectations of 180,000. The unemployment rate down to 3.5% versus 3.6% expected. Average hourly earnings rose by 7 cents to $28.29. That's up 0.2% month over month and up 3.1% year over year. Economists were looking for an increase of 3% year over year. The average work week remained unchanged at 34.4 hours, and the labor force participation rate was little changed at 63.2%. Looking at some of the sectors here, we were really watching manufacturing because workers were returning from that GM strike. Manufacturing added 54,000 jobs, including 41,000 in auto parts and motor vehicles. Again, largely because of the return of GM workers. Healthcare added 45,000 jobs. Leisure and hospitality added 45 as well. Retail added 2,000 jobs. Now, we did have some upward revisions in October. 156,000 jobs were added, up from 128 previously reported. September, that number was revised up by 13,000 to 193,000 jobs. And then that's a total of 41,000 more jobs than previously reported. In U6, the broadest measure of unemployment is at 6.9%, down from 7% in October. And again, 266,000 jobs created in November.
All right, Jessica Smith in D.C. with the latest on the November jobs report. Let's dig into this report with Greg Dacko, Chief U.S. Economist at Oxford Economics, also joined by James McDonald, CEO of Hercules Investments. Greg, I think pretty stellar number all around. The headline is certainly strong. The revisions are strong. What stands out to you just in the first couple of minutes?
Well, I think overall it's a good report. We have strong job growth. We had the expected rebound from the GM strikers returning to work. We have wage growth that is staying steady at about 3%, slightly up to 3.1%, which is a good number. The unemployment rate falling down further to 3.5%. The broad underemployment rate, which includes people that are working part-time but want full-time jobs, that's also falling to a low since 2000. So all around, it seems to be a fairly good number that shows that the economy is not about to fall off a cliff.
And does this report, James, show, is it proof that this economy can weather a prolonged trade dispute with China?
That is what I'm most interested about this report. Obviously, when we look at this bull market, we're looking for risks. The primary risk to this bull market has been the tension in the China trade deal situation. I was looking for this report to see if the China situation impacted the economy in any way, with the employment number going in a positive direction, with the jobs added going in a positive direction, and with the market response being so strong. I think the answer is no. The China situation has not impacted the market, and that's great news for this market. And it also is going to tell us what the Fed is going to interpret in terms of how things are going, and more importantly, how President Trump might continue to use the trade situation coming up to the December 15th deadline as an arbiter of how to move this market.
Yeah, we'll get to the Fed a little bit later. Brian Chung will join us in a bit. But Greg, just thinking quickly about where the Fed might come out on this, I took away from Jay Powell's most recent comments that he's pretty sure he's on the right track here. Like what he and the Fed have done has helped the economy. And I feel like they will be even more emboldened by their stance, given what we've seen in the last couple of months.
Yeah, I think headed into the last FOMC meeting of the year, the Fed is on hold. Chair Powell and the FOMC committee were very clear that unless there was a material reassessment of of the Fed's outlook. There would not be a change to the downside in terms of interest rates. That being said, if you look into 2020, there is a cooling environment in terms of employment growth. We are on a steady downward trend with some headwinds, global headwinds affecting the labor market, and a maturing when you have an unemployment rate at 3.5%. So as we go into 2020, we do believe there will be some reassessment of the labor market, and the inflation undershoot continues to be an irritation. So I do foresee another rate cut in early 2020.
All right, we have Jared Blickery over at the Wi-Fi Interactive Board for a look at stock futures, which, no surprise, are rallying on this better-than-expected jobs report, Jared.
Yes, they are. We can see the S&P 500 futures up 16.5 points. That's roughly about half a percentage point. So this is the overnight price action. We can see the spike right here, right on the job numbers. Just a little bit of hesitation, though, because sometimes we get retracement of that and then another acceleration into the open and past the open. What really matters here is the close on the business today. We've seen S&P 500 futures rally recently, and despite a lot of headwinds regarding trade, really no retracement, not much of a retracement in terms of selling off on any of those particular headlines. So a nice little jump here, and we'll see if it lasts into the open.
James, your take on wages, up 3.1% year over year, up 0.2% month over month. Still not the kind of breakout wage growth that you'd expect, given that the unemployment rate now sitting at 3.5%. Right. It's a 50-year low. What's going on?
What's going on is a roller coaster. As it's riding up to the top, it decelerates, right? And so we're talking about a growth story that's continued. Growth is great, but growth has to slow down. You can't go at breakneck speed forever. And what we're seeing is we're seeing a continued strong economy simply slowing down. We're not moving downward. We're just going up less with less acceleration. And so I think the numbers are strong. I think this is good. I think, as Greg said, the Fed is going to interpret this positively. And, you can't go up forever at that kind of speed that we looked at.
And we do have an environment in which businesses are constrained from the profit margins perspective. They have limited pricing power. Profit margins have been squeezed for the past 4.5 years. And an environment where you do have some headwinds. You do have international headwinds. You do have trade tensions. You do have a lot of business uncertainty. Businesses are going to be cautious with wage growth. So 3% is perhaps that steady equilibrium, which is good enough to support income growth and, in terms, consumer outlays, but not accelerating too much that would hinder business investment.
But I still think there's sort of an open question here, Greg, on how tight the labor market is or is not. Because on the one hand, you're adding, 250,000+ jobs in a month. Over the last couple, it comes out to 185 or something like that. So that's quite a lot of jobs, would suggest there is some slack. At the same time, 3.5% unemployment rate, wages accelerating for the first time in 3 months. Maybe things are a bit tighter than we had thought in the summer months, when I think Jay Powell and many others were saying, no, we need to kind of press on the gas a little here because this labor market is not where we want it to be.
Well, I think overall, if you look at the broad picture, a slight acceleration of 1/10 on wage growth isn't a big game changer. It is comforting to see that wage growth has plateaued around 3%. If you look at the broader picture in terms of where we are, in terms of full employment, you're seeing the participation rate steady at 63.2%. That's perhaps the most important number in this release, because it indicates that people are still returning to the labor market and they're still finding jobs. And in an environment where you have an unemployment rate at a 60-year low of 3.5%, that participation rate slowly ticking up is a very good sign.
What about when we dig into areas where jobs were added? Retail, just 2,000 jobs. We had Black Friday in this report. We know Thanksgiving came late. Could that have skewed things? Maybe the hiring in the retail sector is happening later, and it was a little bit soft for the November report?
I think the seasonality is an aspect, but that's not really the picture that I think is the indication of what this report tells us. If you look at where job growth is coming from, it's coming from mostly the service sector. And within the service sector, you break down, it's going to be healthcare, and it's going to be professional services. Those are the two strongest areas of job growth. And when we look at these numbers, we have to understand the job pool isn't infinite. There are only so many people. And when you approach these levels of record unemployment, the greatest workers are in their jobs, they're enjoying their jobs. People that are still in the labor market looking, there's just not an unlimited supply of people. So there's going to be a natural slowing down. The seasonality that we're seeing going into this report, I think, is the secondary story. The primary story is that people with the best jobs in the strongest areas are reaching full employment.
So I think, James, it brings for me this question we all sort of assumed we knew the answer to maybe about a year ago, which is, are we late cycle? And everyone said yes, of course. I think this year has kind of made a lot of people reassess are we actually late cycle? I mean, to your point, it's been 10 years. We know that for a certain class of worker, things have been fine for a long time. But just because all that is true, I mean, this report to me suggests there's no reason to think we're late cycle other than the fact that it's been 10 years since the recession.
Right. Well, 10 years ago, the economy and what was driving the economy isn't the same. If you look at the numbers around manufacturing, we've changed the way we do business. Technology's been around a long time, but it's very, very powerful in the last 10 years. There's been an explosion around e-commerce. There's been an explosion around the global trade around, not just e-commerce, but the global trade around digital commerce. We're not in the same economy we were 10 years ago. And so the numbers comparatively can't be looked at. If we look at late cycle concepts here, what we're talking about now is we're talking about a whole new generation of workers. I don't know whether it's Generation Z, Generation Y. It's a whole different generation of workers. It's a whole different generation of how we work. If you look at the boom of WeWork, if you look at the boom of what Amazon's doing in terms of shipping and construction, it's just a totally new picture. So when we look at these numbers, we have to understand the context and the lens at which we should look through them are this is a new economy. And this new economy is working, it's thriving, the length and the extent of the bull market is historical, just as the low unemployment rate. So we have to change the lens in which we understand these statistics and understand that technology and advancements in how trade works has completely changed everything.
Much better. I mean, 266,000 jobs added. The street was looking for about 180,000. Yes, we have that bounce from the GM workers coming back after the strike, but even if that didn't happen, this number is really a great number, but also how unsustainable is this?
Well, I don't think we're going to see numbers above 200,000 going into 2020. If you think about the broad picture, as Miles highlighted, you have an environment in which you had this large swing, about 40K in between the October survey and the November survey. So factor that out, and you're trending still in that 170 zone, which after the benchmark revisions is actually a little bit lower than that. So you're thinking about a labor market that's adding on average this year about 160, 150,000 jobs. Going into 2020 with an unemployment rate at 3.5%, with the headwinds that we're seeing, cooling domestic demand, we see that job growth number falling to less than 100,000 going into 2020.
But
so it is a maturing labor market.
And I know that a number of economists have said that's probably the number we need to sustain the expansion.
That's the break-even
So
rate.
you feel like it's probably around that 75 is the break-even or closer to 150? Because the San Francisco Fed kind of has a 50 to 150, kind of a broad range there. Well, that's basically the margin of error, right? On the job
that's right.
It's a large margin, but yeah.
That break-even rate is a rate at which the unemployment rate stays steady. And whether it's 120, 150, or 100 really doesn't matter that much. What matters is whether we're adding more jobs than the labor force is growing at. And right now we're doing that just barely. But as we go into 2020, we think we'll fall slightly below that, and we'll see some moderation in both the labor market and income growth, which will weigh on consumer spending. A gentle glide into the new decade rather than a recession, as some have been forecasting.
I'll take a gentle glide. Jared, what have you got over at the Interactive board?
Well, we see stock futures heading higher here. So we did a little bit of a retracement, but then accelerated, and we're making new session highs right now. S&P 500 futures by 3138. Let's check out the Dow, and we can see the Dow is 27,854. Not that far off from 28,000. Might get those hats out pretty soon. And then we're also going to look at the euro versus U.S. dollar. The dollar is strengthening, so this is the euro selling off and the dollar strengthening, and gold taking a leg lower here on these growth numbers. And we can see that it almost touched about 1470 right here.
All right, Jared, thanks a lot. Greg, James, Jared, we're going to ask you all to stick around. We'll come back to you in a little bit. We want to check in now with Inez Ferre, who's at the New York Stock Exchange. She has a special guest, Tim Anderson, a trader down at the floor, for reaction to this pretty stellar report, Inez.
Alexis, I saw Tim's reaction when this 266,000 number came out. Tim, you said, "Oh my God!" What's your reaction to this?
Well, I was concerned we might have a little bit of a miss because last month we beat consensus by about 40,000, obviously coming out of the auto strike. Plus, we had very strong revisions from both August and September. Now, those revisions are usually a leading indicator that things are going well, and clearly this report is just a great report for the economy. Now, if we were in an environment where people were concerned about the economy overheating, and if we had real inflation concerns maybe staring at us just around the corner, this report might be a red flag. But we are not in that environment at all. This is just the only possible downside to this report is that this may encourage President Trump to do even more saber rattling with China on the trade issue. So if you're really concerned, if you think that the settling trade with China is everything to the market and the economy, this might delay that process a little bit.
We saw growth in healthcare, manufacturing, revisions upwards. Were you surprised by this?
Well, the manufacturing, I think, is a lot of the auto suppliers, even though, look, when the strike ended, the workers came back the next day that were UAW workers, but then a lot of the suppliers that feed into the system, it takes them a while to call their workers back. And for them to come back, sometimes they have discussions about how many people they want to bring back right away. So I think this is a lag on that, a very positive number. It's curious that it's so different than what we saw from the ADP report on Wednesday.
And how sustainable is this? Can this performance continue like this?
You know, we got even more upside revisions in September. And we had not that much retail growth. Retail was one of the shortfalls with the ADP report. I know that the retail environment is changing significantly, and it's always been a brutal landscape in and of its own. We're going into the holiday season. I just think that there's no real negatives in this report.
Thanks so much, Tim Anderson. Alexis, Miles?
All right, Ness Frey live on the floor of the exchange. Stay with us here on The First Trade. We'll have a lot more on that November jobs report coming up right after a quick break.
Welcome back to this Yahoo Finance special jobs report. Here's a look at how the futures are reacting to that jobs report. Rally is all the way around. Dow futures up 174, S&P futures up 18. We've got NASDAQ futures rallying 62 points on news that the economy added 266,000 jobs last month. The unemployment rate ticking down to 3.5%, and wages up 3.1% year over year. By nearly every metric, this report beat what the street was expecting.
And of course, we all want to know what this might mean for the Federal Reserve. They will have their last policy meeting of the year next week. Yahoo Finance's Brian Chung is in our newsroom with more on that. So, Brian, I think the market certainly likes this report. There was not an expectation that the Fed would move next week, but we will get new economic projections. What do you think this means for the Fed?
Well, whoa, what a big labor market report report for the last month, it did have a quite impressive beat of 266,000. That did beat the consensus of 180,000. So that is well above trend for what we've seen in the past few reports, basically since the end of the summer, where the trend has been about 160,000. Some expected it to be 180,000 because of the offset from the ending of the GM strike. But what we've seen is that Fed funds futures markets were pretty much set already on the idea of there being no change to the federal funds rate. That is the benchmark interest rate in the United States in the Fed's final meeting of 2019. That will come next Wednesday. Headed into the jobs report today, the expectation on the street based on Fed funds futures contracts was actually a 99.3% chance of no change at all, with only a 0.7% chance of a hike here. And the only thing that you would see from a labor market report that would tell you or justify any case for a rate hike would be any sort of runaway inflationary pressures that you would see from wage growth, which, even though it did beat expectations, it only beat expectations by 0.1%. So not necessarily telling you based on this report, although you could call it hot, that there are runaway wage pressures, which means that the Federal Reserve's thesis for right now that they can let the economy run hot at the current level of 1.5 to 1.75% is pretty much okay for the time being. Miles?
And Brian, we've been talking about this idea, I think you and I have talked about this, that Jay Powell is so sure that he's done the right thing, that he's, really has his hand on the right policy levers right now. I sort of wonder if you could make the argument that he would look at this report and say, actually, I should cut rates because cutting rates is so effective and helps the economy so much, and there's so much slack left that maybe I should goose this thing along. He won't do that, but you could make that argument if you wanted to.
Well, that is part of his thesis so far, saying that he's actually comfortable with having more accommodative rates than what they call the R-star, the neutral rate of the economy, because they want the labor market to continue to run hot. Keep in mind, the Federal Reserve never expected the unemployment rate to be at 3.5%. They thought that the natural rate was somewhere, 200 basis points above that. So the Federal Reserve is comfortable with letting that run, but they don't want to provide too much accommodation. Jay Powell has said that he doesn't want to provide too much leverage to the system as well. So kind of a pushback on that point, but it seems like for right now, this seems to reinforce that rates will stay where they are for right now.
All right, let's bring back Greg, James, and Jared. Greg, do you agree with what Brian just said?
Well, I think in general, the Fed is likely to have more of that dovish tilt as we go into 2020. We've heard from Powell and from different participants of the FOMC that there is a desire to stimulate the economy and prevent a harder landing of the economy. Let's not forget, despite this very strong jobs report, I'll play Debbie Downer for a second, that we do have some headwinds that haven't dissipated overnight. We continue to have trade tensions. There are the threatened tariffs on December 15th vis-a-vis China on consumer goods. There is an environment in which global growth remains quite soft. There is an environment in which domestic demand and business investment in particular remains constrained by a high level of uncertainty and constrained profit margins. So we're not suddenly in this booming economy. We're in this gently gliding economy in which the Fed is on watch to provide further accommodation if needed. We don't think that will happen over the next 3 months, but we think that as we go into 2020, there's an increased likelihood of further accommodation by the Fed.
You bring up a great point, the December 15th tariffs. Could that just ruin the party? Because thus far, we, the consumer, haven't really felt the effects of those tariffs. And yes, we're at near full employment, but if those tariffs start really hitting our pocketbooks, it's just going to start to fall apart.
Not only could it ruin the party, it could send everybody home. If we look at where the risks are in the market, and we look at what the Fed has said, if you read the minutes, they attribute geopolitical risk as the #1 risk factor in the market, okay? If you look at the tape of what the S&P has been doing, the biggest pullbacks, the biggest strains, the biggest spikes in the VIX have occurred around the trade tariffs. And so December 15th is everything. Now that this number is behind us, we saw a muted market reaction to the ISM numbers, both manufacturing and non-manufacturing. We have to look at December 15th as the biggest risk to this market. I think that what happens on December 15th, though, is going to be strategic. If you look at what Trump has done, he's moved in sync with what the market perceptions are. The futures are soaring right now. If you look at the futures right now, I think, top ahead, that's the strongest opening, pre-market opening we've had in over 6 months. If that's true, Trump now knows he's got a strong market, high confidence, and is negotiating from a position of strength going into December 15th. So all bets are off in terms of if this market can keep going based on the fact that this good news is going to give Trump extra leverage to push back on China and to defend himself as well.
Yeah, Greg, let's go back to something we haven't talked about yet, which is I think the surprise that we now have at Wednesday's ADP report, or perhaps is that report in your mind still something of a canary, still a warning that there could be signs of slowing in the labor market? Because obviously the BLS's numbers and the ADP's numbers, they diverge all the time. But you look at what's been said in the ISM data, you see what market is saying about the economy right now. There is still a little bit of a split and some disagreement both on the qualitative and the quantitative side of where exactly the labor market stands.
And I think that's why you have to look at a broad array of data series. You can't just focus on one, and you can't specifically focus on even one BLS report. You have to look at the broader picture, and the broader picture is one of easing growth as we go into the new decade. We're in an environment in which there are still a number of risks, in which the manufacturing sector remains under pressure, in which business uncertainty and lower levels of confidence have eroded companies' desires to invest into the future and to hire. And that is a cautious sign. Again, this report is very good. It's very encouraging as we go into the end of the year. But let's flash back to last year. We had an environment where the job market was very strong, where trade tensions were on the rise, where there was a government shutdown, and where the Fed sounded more hawkish. Let's not repeat that environment, because that could be quite negative for stock markets going into 2020.
It was a very different December in 2018. Jared, if you take a look at that Dow Jones Industrial Average map, you see right there when the report came out, right? Big spike up.
Yes, you can definitely see we've only had the shallowest of pullbacks here. Usually we get something of a retracement, but haven't really seen that. The impetus is definitely up here. We can see the Dow is up about 0.2% along with the S&P 500 futures. NASDAQ is up even more, up 0.8%. We can also see the dollar strengthening. So this is a euro selling off versus a dollar. Gold took a significant hit here. We can see it's down to 14.70 support. That's a pretty big drop, just the opposite of what happened in stock futures here. And then WTI crude oil, we can see that is a little bit lower here, but not too much of a drop off on that report. And then the 10-year T-note yield, that has been spiking. Right now it is up 5 basis points, and that's a pretty significant move for this particular instrument here. All in all, it's a very risk-on report.
So is that it? No more talk of recession. We're all good. We're out of the woods, James.
No, we can't say that yet.
Tried.
I'm watching these futures, and I tell you what, that is a strong open. I'm a technical analyst with the markets, and we haven't seen a retracement yet, but if we don't see a retracement after the open, that tells us the bulls are in charge. And as this market has been very psychological, we have to look at the stock market as what it is. It's an open auction, but it's an open auction with carnival barkers standing around it, using Twitter as a platform, using headlines as a platform. I'm really curious to see how the market opens and how the market trends into December 15th. I don't think this report is everything, but it's definitely going to set the tone for both how the Fed is going to perceive things going forward, both how Trump is going to perceive things going forward. And buying here has got to get to a level where we beat a new high in the 52-week, a new 52-week high in the S&P and the Dow. It's just exciting to see these futures going up.
And James, just to follow up then, I guess, on the market's overall direction, the bulls have kind of been in charge all year with a few exceptions, but it does still feel like people aren't excited about the market. There was some exuberance, I think, end of 2017, but it's been now 2 full years since we've seen that. Are you waiting for that to come back into the market as a sign that we could finally be seeing some steam come out here?
Well, I think the big challenge is the U.S. presidential election next year. Many people attribute this bull market to Trump and Trump policies, and then a Republican-controlled government. What we have to look at here is if we go into the election with uncertainty, the market's going to change direction. I believe if Trump loses, the market's going to lose a ton of value in it. I'm not the only one that believes that. And as we go into the election, the more uncertainty that goes into that is going to impact the market.
All right.
We're going to leave it there. James McDonald, Greg Dacko, Jared Blickery, thanks to you all for joining us. Don't go anywhere. We have much more coming up at the top of the hour right after this short break. Stay with us. Good morning, everyone. I'm Alexis
And
Christoforous.
I'm Miles Upton in for Brian Sazi. This is the first trade for Friday, December 6th.
Jobs blowout. The economy adds a whopping 266,000 jobs last month and blasts past expectations as unemployment ticks lower. Now, futures are rocketing higher. We have all the analysis you need to know.
Well, they're going public in a big way. Aramco launching the biggest IPO in history with a $1.7 trillion valuation. We'll dig into what it means for the equity and the energy markets coming up in a bit.
And easing the tariffs. China makes it easier to buy U.S. soy and pork as a key deadline nears. Could it mean that a phase one trade deal is actually close?
All right, let's get a quick look at the futures market. Right now, we've got a rally on our hands. Futures higher after that big jobs report. The Dow about 150 points away from regaining 28,000.
Look out. We're going to get a full check of the markets in just a bit. But first to today's big story. It was a very strong November for the job market. 266,000 jobs were added last month, more than 80,000 above expectations, and unemployment ticked lower to 3.5%. And take a look at what the futures did as word came down. That huge spike you see there, well, that was at 8:30 a.m. Eastern. At the time that market came out, they are now set for a big rally when the opening bell sounds. Let's get right to Jessica Smith. She is at the Labor Department for us with the very latest on this stellar report. Jess?
Yeah, it's worth hitting those headline numbers one more time. 266,000 jobs added in November. The unemployment rate down to 3.5%. Economists had been expecting 3.6%. Average hourly earnings rose by 7 cents to $28.29. That's up 0.2% month over month and up 3.1% year over year versus expectations of an increase of 3% year over year. The average work week remained unchanged at 34.4 hours. The labor force participation rate was little changed at 63.2%. Manufacturing added 54,000 jobs, including 41,000 in motor vehicles and parts, largely because of those GM workers coming back to work after that strike. Healthcare added 45,000 jobs, as did leisure and hospitality. Retail added 2,000 jobs, but in that industry, clothing and accessory stores lost 18,000 jobs. We did have some upward revisions. In October, 156,000 jobs were created. That's up from 128,000 that was previously reported. And in September, that number revised up by 13,000 to 193,000 jobs. That's a total of 41,000 more jobs than previously reported. And U6, the broadest measure of unemployment, is at 6.9% from 7% the month prior. Alexis and Miles.
All right, let's talk a little bit more about the jobs report. We've got Greg Dacko, chief U.S. economist at Oxford Economics, also joined by Ben Harris, former chief economist and economic advisor to Vice President Biden, also currently a visiting associate professor at Northwestern University's Kellogg School and executive director of the Kellogg Public-Private Initiative. Ben, we'll start with you. Just your high-level take on what you saw in today's jobs report and what it says about the state of the economy.
So there's no way to cut it any differently. The 266,000 number is a big number. It shows we're still adding plenty of jobs to the labor market. The tick down in unemployment is great news. There's no way to cut it any differently. That being said, I think that there are some signs that we should be a bit cautious about getting too excited. Wage growth is not all that strong. If you're at 3.5% unemployment, getting 3.1% year over year is not where you want to be. And also manufacturing. The number of jobs we added when you're accounting for all the GM workers that came back doesn't give you a ton of enthusiasm about the state of the manufacturing sector. So it's a great jobs report overall as far as total jobs goes, but looking under the hood, it's not quite as terrific.
You know, Ben brings up a great point. He's highlighting wages, Greg. And do you think that if we had some clarity on the China trade war, that would actually help companies be able to make plans and perhaps loosen the belt a little bit and start to raise wages?
Potentially. But if you look at the last 6 months, we've had a moderation in wage growth. We used to be around 3.4% back in February. We've seen some moderation back down to 3%. I don't necessarily know that that's really due to the uncertainty pertaining to the China tensions. I think it's largely due to two phenomena. One, the fact that companies' profit margins have been squeezed over the last 4 years. And that the second element is the fact that business pricing power is more limited than it has been in similar types of growth environments.
But aren't those margins being squeezed in part because of the trade war?
In part, there are, because you're seeing increased input costs, especially in the initial phase of the trade war, with intermediate costs going up. Now you're seeing consumer goods being affected, and that's directly affecting final costs. But it is one source of pressure, and the other source of pressure, of course, in a company's bill is the labor bill.
You know, and Ben, I think a lot of market participants have talked a lot this year about the idea the economy is late cycle, right? That we're running out of people to pull back into the labor force. But as you look at the economy, does it say to you we might have a lot more people who were disenfranchised after the crisis ready to rejoin the labor force, and not even thinking about the millennial generation who is now in their prime earning years, you know, late 20s, early 30s, who are still looking for those opportunities to enjoy the prosperity their parents did?
Great question. So I think one of the sort of unsung pieces of good news about this jobs report was the U6, which is the broadest measure of labor market participation, ticking down from 7% to 6.9. This is the lowest number we've seen in a long time. That's good news. The bad news is, and Greg just hit on it, the bad news is wages. So the U.S. labor market right now is characterized by a situation where there are plenty of jobs. There are plenty of jobs for people, but there are very few jobs which we characterize as great jobs, and there's slow wage growth for people who do have a job. So if you're looking for good news, it's that anyone can get hired. The bad news is the type of jobs you're getting are tough to raise a family on and are tough to be sufficient to sort of stimulate the economy in the way we'd like to see.
I think one of the interesting elements to that point is the fact that we're seeing a lot of growth in low wages jobs, and that is bringing down the average hourly earnings artificially. But it's still supporting income growth, which is important because income growth overall, disposable income growth, is what people spend with. Yeah. We're increasingly in this bifurcated economy. You were talking earlier about the stock prices rising over the course of the year, but we know that about 2/3 of the people don't really have investments or aren't really seeing the benefits from the stock market gains beyond a confidence effect. So that is important. As long as we're seeing some job growth and some wage growth, especially for lower income families, that should continue to support consumer spending in the U.S.
Ben, I'm going to ask you what I asked our guest in the previous half hour. December 15th, a big number on the calendar for this market. If those tariffs go into effect on China, what can that do to the stock market rally and to our economy?
So, I'd like to point out now that we are in a full-blown manufacturing recession. The general economy is not in a recession, but manufacturing is. If those tariffs hit on December 15th, I hate to think what that means for American manufacturers. Also, if one thing's been proven true over the past 3 years or so, it's that American investors don't like uncertainty. And this back and forth with the trade war, I think, has had a real effect on the psyche of U.S. businesses, of U.S. investors, and I think that everyone's sort of ready for a bit more certainty.
All right, Ben Harris, Greg Dacko, thanks so much for being with us. We appreciate your time. Time now to head to the New York Stock Exchange and check in with Yahoo Finance's Inez Ferre for an early look at what's going on there before the bell. About 20 minutes to go before the bell rings there, and things are looking pretty good, Inez.
Yeah, that's right. Futures are pointing higher. I know you were just mentioning that December 15th deadline for those tariffs. Well, I do want to mention a headline that came out from Reuters that could be a positive sign to this whole trade negotiation. China will waive import tariffs on some soybeans and pork shipments from the U.S., so that could be seen as a positive sign regarding the negotiations. You'll recall that President Trump has talked about U.S. agricultural products being a key point to these negotiations. Also, I want to mention what's happening with Cloudera this morning, surging in pre-market after beating on the top and bottom line for their latest quarter, with the loss per share coming in narrower than what the street was expecting, and the company raised its full-year guidance. Looking at CrowdStrike, that stock is seeing a pop. It's seeing a lot of movement, actually, because when they reported their earnings report yesterday, there was a typo in that earnings report that sent shares down. Then they came back up after that typo was corrected. Their loss per share came in narrower than what the street had been expecting. Their revenue came in above expectations, and the company raised its fiscal 2020 guidance. And finally, PagerDuty is tanking in pre-market. This is after the company cut its adjusted loss per share full-year guidance. Already, Wall Street is weighing in, with JP Morgan cutting its price target on PagerDuty to $38 from $60. Alexis, Miles?
All right, Nez Frey live on the floor of the New York Stock Exchange. Well, coming up here on the first trade, we'll tell you about the company that's implementing a strict policy for its Christmas party, how employees are staying off the naughty list. Coming up next.
All right, let's take a look at what is moving the European markets this morning. Up arrows across the board. The FTSE 100 up 86, the CAC 40 up 58. Got the DAX in Germany rallying about 88 points. Yahoo Finance's Edmund Heafy joining us live from London. And Edmund, really ugly data from Germany's industrial sector this morning. Doesn't seem to be affecting their stock market, though.
Yes, Alexis. So German industrial output plummeted by 5.3% in October compared to the same month in 2018. That's the worst year-over-year decline since 2009. Now, there had been some early signs of an economic revival in Germany, but this could suggest that we're going to see negative GDP growth in the fourth quarter and that maybe Germany will enter recession in 2020. As we all know, Germany is the economic powerhouse of the European Union, so these woes will likely be reflected in Eurozone growth data that we'll see later in the quarter. Germany's economic ministry said today that it acknowledged that there was weak momentum, but it still thought that things would stabilize.
Now, Edmund, switching gears a little bit, Lloyd's of London sending a warning to its staff this Christmas season. What's the story there?
Yes, Miles, given the year that Lloyd's of London had, I think the warning is apt. CEO John Neal said today that he had emailed 45,000 staff at Lloyd's and its member companies about behavior during the Christmas season and reminding them of the standards expected of them. This comes ahead of the insurance market's Christmas party this evening, but also after Bloomberg earlier this year revealed a pretty horrendous culture of sexual harassment at the 331-year-old institution. It had been known for a kind of boozy culture that was long associated with the London finance scene, but this went far beyond what anyone had expected.
All right, Edmund Heafy for us in London. Thanks. Have a great weekend. Now, for more of what's happening in Asia, here's Yujing Liu from the South China Morning Post.
Hong Kong and China stocks got a big boost just as the markets were closing for the weekend. China announced it would exempt U.S. soybeans and pork from tariffs. The Hang Seng Index gained 0.6% this week, while the Shanghai Composite Index rose 1.4%. Looking ahead, Hong Kong's market is bracing for a major anti-government march on Sunday. It will be the first mass rally approved by police since the opposition camp achieved a landslide victory in the local election last month. After 6 months of street protests, companies are reporting big-ticket damage. Local rail operator MTR Corporation expects the protests to cost it over $200 million as passengers declined 14% between July and November from last year. In China, the mega listing of Postal Savings Bank will be the spotlight next week. The country's fifth largest bank by asset has raised $4 billion in China's largest IPO in 4 years, and the shares will start trading on Tuesday. That's all from me. Back to you in New York.
All right, coming up here on The First Trade, a unique Christmas documentary about to land on Amazon, and all you'll want are Friday's News Bites coming up next.
Let's take a look at today's News Bites. A dramatic police chase and shootout near Miami has left 4 people dead. Police say a pair of robbers hijacked a UPS truck and took the driver hostage. They all died in a shootout with police, along with a bystander in a nearby car. It's not clear if police or the robbers fired the fatal shots. Police say the suspects had earlier tried to rob a jewelry store, posing as postal workers. The House could vote to impeach President Trump before Christmas. The New York Times is reporting that a vote could happen on December 20th, the last day that Congress is in session this year. The next hearing in the Judiciary Committee is set for Monday, one of several planned as lawmakers determine on what grounds to impeach the president. California Governor Gavin Newsom is urging President Trump to release more federal money to help the homeless. Newsom says federal housing vouchers could help 50,000 homeless people in the state. About 130,000 people are believed to be homeless in California, more than any other state, according to the Department of Housing and Urban Development. And Mariah Carey is bringing Christmas to Amazon. 25 years after debuting her song All I Want for Christmas Is You, the singer is partnering with the e-commerce site for a mini documentary, Mariah Carey is Christmas. It will tell the story of how Carey's hit became a staple of the season. Coming up on The First Trade, making a lasting impact, we'll look back at the most innovative companies of the decade.
All right, the 2020s, a little more than 3 weeks away. So we're taking a look back at the 2010s to see where we've come from and where we might be going. Yahoo Finance's Ethan Wolfman joins us now at the desk to talk about some of the decade's most innovative companies. So I think if there is a word, Ethan, that defines the 2010s, it was probably the overuse of the word innovation. But there was actual innovation in the decade. You looked at some of the companies that really changed things for us. What'd you find?
Yeah, I mean, I guess the very first observation when kind of putting this list together and talking to various experts in business was that a lot of the most innovative companies are not new companies. They are kind of incumbent players, either from way back or players from the 2000s and maybe Silicon Valley giants that really changed things. That really tells me that the kind of positioning of the market really favors these companies that are already established and very strong. But that having been said, a lot of these sort of changes of mobile technology in everybody's pockets, that has sort of created this layer on which other companies have built.
All right, so give us some names. We are patiently waiting.
Right. Well, I think, first of all, a company that was very interesting to me, Venmo, changed kind of the way that we transfer money. That was a really meaningful kind of thing. And then Zelle, as the big banks copied this kind of innovation. Seeing things like Instagram, that was 2010. That completely
Really
changed how
A lifetime ago.
a lifetime ago. That really changed how this whole concept of influencers. That changed marketing. It changed e-commerce.
New stream of revenue for people, right?
Exactly. I think also getting more into companies that really changed their entire industry. I think Betterment was one that really shifted everybody in that space in the whole world of financial advice.
WeWork's up there.
WeWork is up there. I put WeWork on there because I don't think we're done with these sort of maximizing efficiencies from having, let's say, one company that can make a job slightly easier by being a good middleman. We've seen sort of the unit economics being very difficult for WeWork, but in a few circumstances that did work. And so I think it is possible to see that in the future, but I think seeing Workspace as sort of B2B innovation in the similar sort of way is
they definitely
Uber.
changed commercial real estate. But I can tell you here in New York City, it's actually forced prices to come down.
Right. Yeah.
Because they've gobbled up so many of these workspaces, it's not special anymore, right? Everybody's doing it.
Yeah.
And when I look back at the decade, to me, Uber is by far the most innovative company because you mentioned really the 2010s were about the rise of mobile technology. And for my money, no company really made your phone all it could be more than Uber did, right? Because all of a sudden it was easy to get anywhere you needed to go initially at a super low price, and all you needed was a phone with internet connection.
Yeah, I think the biggest theme for all of this is the entire innovation of our decade was sort of made possible by the sort of the AT&Ts and Verizons, our parent company, as well as Apple, Samsung, creating the technology, Google to make all of this in our pocket, and everybody built upon it. I think Uber is a really good example of something that just wouldn't have been possible. And yet again, we see iterations of this being, all these new services being built on top of the services that came before it.
Yeah. Now we'll just see if in the next decade they can actually turn a profit.
Right. That's always the, that's not important in life.
They actually matter.
We learned in the 2010s that you can get away with no profit.
Talk about
That's
innovation.
another theme. They didn't matter early in the decade. As we're moving out of the decade, they matter
Last
again.
6 months.
All right,
at the
Ethan,
end.
thanks a lot.
Thanks.
The opening bell is coming up next here on The First Trade. But first, here's a look at the action in overseas markets where things are up, and we'll be right back. Welcome back to the first trade on this Jobs Friday. We are about 4 minutes away from the opening bell. Stock futures just continuing to rally, with Dow futures now up nearly 200 points on the heels of that better than expected unemployment report. Let's go around the bell with James McDonald, CEO of Hercules Investments, Veronica Clark, economist at Citi, and Amanda Agati, chief investment strategist at PNC. And of course, we've got Yahoo Finance's Jared Blickery over at the Wi-Fi Interactive Board. Good morning to you all. And Veronica, I'm going to start with you here at the desk because I'd love to get your first read on this jobs report that looks like a pretty good one. Were there any red flags for you?
It was a pretty amazing number. So for a few reasons, we thought this one was going to be strong. We would have had the bounce back from auto workers that weighed on October payrolls coming back this month. That happened, and it was strong regardless of that. So we saw strong services employment, falling unemployment rate, partly because the participation rate fell, which if you want to poke any holes in it, it would maybe be that. But we also saw strong wages with revisions higher. So it was a good number all around.
And Amanda, I'll go over to you with your first thoughts on this report, which I think we can all agree is a strong report, but there are various areas that are standing out to folks.
Yeah, absolutely. I mean, we're pleasantly surprised by the outcome this morning. We thought it would be good. I think it beat our own fairly positive expectations. And, you know, it's really hard to pick it apart too much. I think from our perspective, it's just further confirmation that the sort of hashtag summer soft patch that we've been talking about for the last few months has finally faded, and we're starting to see a bit of a short-term cyclical reacceleration. So it really should be good news for Q4 GDP, earnings estimates, and even the consumer. So we're feeling great about it this morning.
Well, I wanted to ask about GDP because we all kind of accept that we're going into a slower growth phase. We've been in a slower growth phase. Does this reset your expectations? We have some economists looking for GDP growth around 1.5% in the fourth quarter. Could this lead to an upward revision of those views?
Well, I think our economics team is still suggesting that we would be in 1.5% to 2% kind of range into 2020, but there is a chance that we could see a slight uptick in terms of growth expectations. Our own view is that the lagged effects of the stimulus coming into the system from the Fed and a number of other sources really hasn't fully kind of come in and revealed itself yet. So we're starting to see the signs of that. So we actually are feeling pretty good about how Q4 is likely to shape up, and even the first half of 2020.
James, what are your expectations for growth in the new year?
I think the expectations have to continue to be positive. What's most remarkable about this report to me is how the market's responding. The futures imply an opening that would be the strongest opening in over 6 months. What that means is that the market is calm, the market is expecting continued growth, and the volatility that we saw early in this week is in the rear view mirror. It's an extraordinarily response to the market. This market has gone so high, so far, so long, without risks being perceived as a slowdown. This jobs report, I'm blown away by the futures right now.
All right, and well, I want to take a look at those futures again because pretty incredible with Dow futures up 200 points. NASDAQ futures were rallying more than 60. Here we have the opening bell at the New York Stock Exchange and the NASDAQ as investors react to that better than expected jobs report. Unemployment rate, by the way, 3.5%. That is a 50-year low. Wages crept up a bit, up 3.1% year over year. And here you have the Dow starting the day up better than 200 points.
So, Veronica, let's just talk a little bit about what this could mean for the Fed. We discussed it earlier in the hour, but right now I think Jay Powell believes he's done all the right things this year. He made a big mistake, obviously, in 2018. He's sort of admitted that to some extent. Does this change the way the Fed might be looking at their policy moves in the new year?
So for right now, this really just confirms that the Fed's policy stance right now of being on hold is the right one. So we do have a Fed meeting next week, and Fed has been very on message, saying that they've cut rates 3 times already, and now they're on hold watching the data. And so far, the data have been very good, and we don't expect any cuts going forward.
I want to get back to, you mentioned the participation rate slipping just a little bit in this latest report. What does that tell you about the overall economy, Jim?
It tells me that the economy is shifting to a services-focused, tech-focused, professional employment-focused economy. And we have to continue to look at this growth, the success of this economy story, as a change in the old guard. I mean, manufacturing is lost. Manufacturing is gone. Manufacturing is no longer the driver. And when we look at these jobs reports continue to be strong, positive, even having shifted to a tech-focused, services-focused economy, I think it's very positive.
All right, Jared, I see a lot of green on the boards you're looking at this morning.
Yes, in fact, no red. This is the Dow Jones Industrials heat map that we have, and Apple is up 1%, Microsoft up 0.5%, tech is doing very well. The 10-year T-note yield is up about 5 or 6 basis points, and financials are really rallying on the back of that. JP Morgan at a record high, up 1.5%, Goldman Sachs up the same amount. Let's take a look at the sectors and see what's breaking down here. We have financials up the most, that's up over 1%, 1.25%, industrials, materials, consumer discretionary tech. So the cyclicals are doing very well here. To the downside, as you might suspect, the interest rate sensitive sectors, utilities, and real estate are underperforming, as well as staples. So the defensive sectors lagging, and the cyclicals and value stocks are leading right now.
All right, Jared Blicker, the Wi-Fi Interactive Touchscreen. Amanda, let's talk a little bit about the rest of this month, because next week is not a week we can just sort of say, all right, we're done. We've got the UK election. We've got the Fed meeting. OPEC is meeting as we speak right now. So when you look at the rest of this year, certainly the jobs report suggests the U.S. economy is in a good place, but there are plenty of risks. What are you keeping your eye on?
Well, the biggest for us continues to be the policy uncertainty coming out of Washington. And so that December 15th kind of next round of tariffs deadline with China is really something that we're going to closely watch. It seems as if, or all signs are indicating, that we're not actually going to put that into effect. But that really, in our view, is the single biggest risk to the market cycle and really the economic cycle. So December can be a very notorious month. Last year, it was a very heavy calendar in terms of events, very notorious December from a performance standpoint. We don't think this year is going to repeat that by any means. But with, the heavy calendar for the month of December again this year, it's hard to argue that we'll get a calm, peaceful Santa rally. I do think that there will be some volatility around some of these key dates as we move through the rest of the month. But so it's not all cotton candy and rainbows by any means, but we're actually feeling pretty good about the underlying data at this point.
Do you think, Veronica, that investors have just been too enthusiastic, a little too optimistic, and not have baked in enough regarding these December 15th tariffs?
Yeah, I think the base case for markets right now is that they don't happen, and the risk is then certainly that they do. And we actually even got some trade data earlier this week that showed falling imports of goods that were hit with the September 1st tariffs. So it would be a downside for some of these consumer import products, and certainly a downside risk for markets too.
Now, James, we know that the downside risk on the news, the headline basis, would be those tariffs coming into play. But we were talking previously about the strength the market has technically, right? We continue to see all the major moving averages are rising. The bulls have pretty much been in control with a brief exception at the end of August. What would you need to see technically for you to feel like this market is getting weaker? Because there's been very few points at which we haven't seen the overall trend remain with the bulls.
As an old school trader, we used to trade on the news. Sell on the news. We saw earlier this week the first weakness of the market based on the Trump tweet about the tariffs. That to me was a clue that we could be seeing an end to the rally. Mm-hmm. The response today, not selling on the news, rallying on the positive news, tells me that the market sentiment is very positive. Going back to the fact that we've gone so far, so high, for so long, where do the risks come from? I think that Trump uses this economic report to negotiate from a position of strength now on tariffs. I think the risk is back on that the tariffs are put on. And so I want to see how the market responds to that. From a technical standpoint, it just gets stronger and stronger. There's been no retracement so far this morning. I think we continue to go higher. I think that Trump uses this news, though, however, to surprise the market about what's happening on the 15th.
Amanda, do you think if we get those tariffs on December 15th, we get a knee-jerk reaction to the downside and then investors push this market even higher into 2020? Or might that really be a flashpoint, and could we actually fall into correction territory?
Oh, no, we definitely do not think that it's enough to push us into correction territory. It's a really different story this year relative to last year. Financial conditions are so much easier this year. The Fed is basically on hold or on pause. Other global central banks have eased a lot on a year-over-year basis. Earnings revisions and earnings estimates are moving in a positive direction. So really the underlying fundamentals are much stronger this year relative to last year. And so we think that that is enough underlying support to help us weather another tariff or trade-related storm. I do agree, though, that tariff tweets happen at market tops, then all-time highs, and so we're definitely heading for that level again. Very likely that we could see some more headlines around that. But I certainly don't think that this next deadline is necessarily enough to derail what we have going here.
Now, Veronica, when we look back at where we were this time last year, certainly it was about the Fed, but also when we had the global economy slowing down, we essentially had a recession the first couple of quarters of the year over in Europe. The global economy seems to be in a better place. Are we, as U.S.-focused investors and commentators, thinking too much about what the Fed means, what this jobs number means? And really, it's been, the suggestions from Germany that there might be fiscal stimulus in that country, or, that Christine Lagarde is going to be running an even more dovish kind of regime over at the ECB now.
I think it's really a combination of everything. You have seen global PMIs maybe bottoming. It's a precarious bottom, but just like we've seen in U.S. ISM manufacturing, that could be a bottom that's in. But we have seen sentiment turning. Just the discussion of phase one U.S.-China deal, even if it's delayed, is a positive. The uncertainty, of course, is still there, and I think we need to be cognizant that the risks are still tilted to the downside, and we can't get complacent.
Let's talk sectors into the new year. What do you like right now, James?
I love sectors outside of the U.S. If you look at where there's explosive growth, and I try to produce growth for my investors. I'm looking at Taiwan. I'm looking at Sweden. I'm looking at Ireland. Those ETFs right now are on fire. They're going to continue to be strong. It's a recovery story from the weakness we saw after the Greek bailout situation. And although the U.S. is strong, these sectors, again, Taiwan, Sweden, Ireland, way stronger, almost double the performance.
You mentioned Greece. Do you touch it now? They have a new prime minister.
Oh, no, I don't touch Greece. I'm on the opposite side of Europe. I'm mentioning, the recovery story from that whole situation. Ireland and Poland, these ETFs, IRL, I believe, EIRL, it's been an explosive ETF. The same thing with Sweden and same thing with Taiwan. And those are where I'm talking about in terms of investments for growth.
All right, let's go back to Jared Blicker at the Wi-Fi Interactive Touchscreen. Jared,
yeah, we're looking at the NASDAQ.
More time, more green, right?
Oh, lots of green here. In fact, barely any red. In the red, you do see not even down 0.5%, Vertex. But let's take a look at some of the bigger large cap stocks here. We have Apple up 1%, Alphabet up 0.75%, Facebook even up nearly 0.5%, Intel up 1%. And if you look at some of the outperformers here, Ulta Beauty, now they released their earnings yesterday after the bell. Let's take a look at the 2 days so we can see this spike here, and that is up 10.5%. And if we look at the year to date here, this stock had been on fire until about September, but we can see that for the year to date, it's now up 6.5%. And if we take a look at some of the leaders today, again, noting that the 10-year T-note yield is up substantially, about 5 or 6 basis points. XRT, that is the retail ETF, that is up 2%. The KRX index, that is regional banks, that's up 1.5%. SOX, chip stocks, they're up 1.5%. Transport's the same. High beta, value, all these are outperforming. There's the S&P 500 there. And to the downside, we're just seeing low volatility, tech software, and biotech. And that's kind of been the story here. When the 10-year T-note yield is up, those do tend to underperform. But really outperformance today by just about all the major components that we've seen since about September.
Nice broad-based rally. We like to see that. Jared, thanks very much. Amanda, I want to get your take on sectors in the new year. Are you in the same boat as James? Do you like equities outside the U.S. right now?
Well, we do like emerging markets, certainly from a valuation standpoint. And then, to the extent that we get this macro reprieve kind of taking hold, we think that that can be really positive for the emerging markets. In the U.S., what we would avoid is really that minimum volatility trade. So staples, utilities, and even to some degree REITs. If we're getting this short-term cyclical reacceleration, that trade is going to fade. It's been on fire all year, and it's time for that one to kind of hand the baton off to value, high quality value, and even to some degree cyclical. So I think there are a lot of bright spots on a global basis. You just have to pick and choose wisely.
I would like to get on the other side of that trade.
What?
I would like to get on the other side of that trade. I think, as a growth-focused trader, I look at, big opportunities, and I think we have once-in-a-generation opportunity on the volatility trade. We're seeing a grinding decrease in volatility that is unprecedented. There's a ETF, UVXY. It's a leveraged short-term volatility ETF. It's been grinding lower. I think a normal mean reversion is going to take this ETF up 50, 60, 70%. The near in the money calls are going to be up 15, 20, 25-fold. It's a once-in-a-generation trade. When we look at the domestic sectors, we look at, what's the turnaround story? We've seen unprecedented low volatility. That volatility is going to mean revert. I think that's the best trade.
We saw a jump in volatility this past week, but you think that was just an anomaly?
No, it was an indicator of what's coming. I think there was a 40% jump just on that tweet with not even a mean reversion. We're talking about a tiny, tiny pullback relative to the growth in the market. If we see anything close to a normal correction, a 10% correction, I think you see volatility, not just on the VIX, but the shorter term volatility. I see you jump triple digits, and there are just incredible returns there.
Just your take on volatility real quick before we have to wrap.
I mean, this week we definitely saw it. We had a lot of data released, but of course it was the trade story that was driving everything this week. And I think now, though, what you've seen today with the NFP report is good news again. For a lot of this year, we saw that if we had a strong NFP report, stocks would be down because it would mean the Fed wouldn't be cutting. But now good news is good news again.
All right, we like that.
All right, Veronica Clark, James McDonald, and Amanda Agati, thank you all so much for your time today. And coming up here on The First Trade, major opportunities are on the horizon for Saudi Aramco. We'll talk about what's next for the oil giant after the world's largest IPO was finally completed. We're back in just a bit. All right, we're just a few minutes into the trading day. Let's take a look at what's moving the markets right now. Yahoo Finance's Inez Ferre is live on the floor of the New York Stock Exchange. Inez.
Miles, looking at Ulta, it's spiking this morning. What a different story from their last earnings report. In this earnings report, they were mixed results, but they spoke about the makeup sector in their conference call, saying that even though it's not out of its down cycle yet, they are seeing some white spots, some demographics trends, which are expected to help sales. And also they have expanded their skincare segment, which has been an outperformer in the beauty segment. And looking at Big Lots, that is seeing a pop today, surging. This is after giving some upbeat guidance for 2020, maintaining their full year outlook for 2019. The company says that 2019 has been a year of transition and restructuring, and despite the impact of tariffs, it's expecting EPS growth in 2020. And then just looking at Zoom, Zoom is under pressure today. This is after their third quarter results, beating on the top and the bottom line, giving some strong guidance for the fourth quarter, but it's seeing some slowing growth, and that's why you're seeing pressure on this stock. In their earnings call, CEO Eric Yuan said that right now their priority is to focus on their existing customers, making sure that they're happy.
All right, Inez from the floor of the exchange, thank you. OPEC is adjusting its output target over pressure from Saudi Arabia. Yahoo Finance's Jared Blickery over at that Wi-Fi Interactive board. I was going to ask you about Saudi Aramco. We're going to wait on that.
Yeah,
I want to know, what's oil doing?
Well, oil is up 1% here, up against resistance, 59. We haven't seen $60 a barrel in about 2.5 months, and this is a high that we haven't seen in that amount of time. Let's check out the overnight price action, because a week ago, everybody thought, well, this OPEC Plus meeting is going to come and go with absolutely no change. Instead, we got something quite different. We got a 500,000 barrels in additional cuts. That brings it up to 1.7 million. Now, in practice, that's not going to mean any actual deviation from what's been happening, because Saudi Arabia has been absorbing that, but they want to spread that around the OPEC Plus cartel here. So this is the overnight price action. We can see got a little bit of a bump here, and that's after the payrolls report. Took a little bit of time, but finally got a little bump here. And again, we are looking at resistance that we haven't seen in some time. And this is just in time for that Aramco IPO pricing, isn't it?
Yeah, Jared, let's talk a little bit about that Aramco deal now. I wonder, and we've talked about this a little bit, what OPEC looks like in the future now that Saudi Aramco is a public company. How does the interplay between those two look going forward, since obviously Saudi Arabia is essentially the leader of OPEC, and of course Aramco, their publicly traded arm?
That is very true, but there's also Russia. Russia is kind of a counterbalance. I don't think there's going to be much change to it, but they have a lot of headwinds going into the next year because we have additional supply coming in, not only from U.S. shale, but from Brazil, from Norway. And so I think that's going to put pressure on any future IPO prospects for Aramco, because not only do they want to list in Saudi Arabia now, they want to list in some other location and raise even more money. Difficult to do that when your crude prices are sinking to possibly $50 a barrel, and that's kind of the consensus going into late 2020.
All right, Jared Blicker, the Wi-Fi interactive touchscreen coming up here on The First Trade. Expanding its footprint, Facebook's big plans in Manhattan look to pick up where Amazon left off.
And get a load of the markets on this Friday. Dow up nearly 270 points. S&P rallying 27. Got the NASDAQ up about 80 again, all thanks to that stellar jobs report. We'll be right back. Don't go away. Now for a look at some of the companies and stocks the Yahoo Finance team is watching for you today. A mixed quarter at Big Lots. The retailer posted a smaller loss per share than expected, while net revenues posted a small beat, but comp sales were slightly below estimates, as was guidance for the fourth quarter. Still, the company said it expects to return to earnings growth next year. American Outdoor Brands, the parent company of Smith & Wesson, is seeing higher gun sales with numbers that beat analysts' expectations for the quarter. The company says demand for firearms has increased despite some sales restrictions on guns and ammunition at certain retailers. It also reported its second best Black Friday sales ever. Facebook is reportedly in talks to lease a landmark building here in New York City. The Wall Street Journal says Facebook is looking to pick up about 700,000 square feet at the Farley building directly across from Penn Station. That would make the social media giant one of New York's largest corporate residents with more than 3 million square feet of office space. And new details on sexual assaults involving ride-hailing giants Uber and Lyft. Uber said in a report that it received over 3,000 sexual assault reports from passengers last year, and 19 women have now joined the growing list to sue Lyft, alleging it ignored sexual assault complaints. Both apps say they're working to improve accountability and safety. And Airbnb has officially banned open invite parties at all listings. That's in the aftermath of a shooting at an Airbnb rental on Halloween, which left 5 people dead. It's also banning large parties at apartment buildings and condos. Boutique hotels and professional event venues are exempt from those new rules. Guests who violate any rule risks being suspended or blocked from booking future rentals. It is Flashback Friday. From impeachment hearings to C-suite conversations, we will look at the top headlines as well as a preview for next week. It's been another busy week here at Yahoo Finance. Time to look back in our Flashback Friday. Now on Tuesday, which seems like a lifetime ago, we spoke with Dell's CFO, Tom Sweet, to talk about the state of the PC industry. Also talked to him about earnings, which topped expectations. Sales came in a little shy. Also asked him about that chip shortage over at Intel, which has affected their business. And Tom Sweet told us that they are now looking outside of Intel for those chips.
As we look at alternative sources, clearly we're evaluating AMD, and we do have AMD products that we're offering. So the balance that we have is trying to ensure that with our direct model, and we are unique in that perspective, that we shape demand to the supply that we have. And so that's the work that we're doing right now, even as we continue to work with Intel to see what kind of additional capacity or capability they have to support our shipment needs as we look at Q4 and on into fiscal 21.
Yeah, and he also said they raised their outlook for 2020.
And of course, trade, another big story this week. President Trump spooking investors earlier in the week, saying he'd be comfortable waiting until after the 2020 election to make that deal with China. Alexis, for me, that was just another reminder for investors who I think for a long time had forgotten that trade risks were in this market, that really what Trump says on trade can be that marginal bid in the market, can push stocks higher or lower, even if you think that's out.
Still trading on the tweets. All right. And of course, this week, House Speaker Nancy Pelosi announced lawmakers are moving forward with drafting those articles of impeachment against President Trump. And Commerce Secretary Wilbur Ross spoke exclusively to Yahoo Finance about the impeachment proceedings.
It's a silly diversion of time and effort. Congress would do a lot better to pass USMCA, the wonderful new treaty with Canada and Mexico. That will bring $30 billion of new capital investment. It'll bring 176,000 new jobs. That's what they should be focusing on, not a witch hunt.
Now, the jobs report come and gone today, but next week, very busy for markets here. The Fed meeting Tuesday and Wednesday. They'll announce their policy decision on Wednesday. On Thursday, we get the UK general election, and that same day, Christine Lagarde will host her first meeting as president of the ECB.
All eyes on Christine. All right, taking one more look at that jobs report today. 266,000 jobs added. The unemployment rate ticks lower to 3.5%. Wages up 3.1% year over year. And the holiday season, Miles, it has officially come to Wall Street because last night the tree outside the New York Stock Exchange was lit up in a star-studded ceremony. Dionne Warwick, haven't heard about her in a while. She was there.
It's the right demo for traders, I think.
I think perhaps you're right. Is the 96th time the tree has been lit right there outside the New York Stock Exchange. Pretty beautiful. Look at all those people. All right, that's going to do it for the first trade for this morning. I'm Alexis Christoforous.
Now, Miles Ludlam, let's take one more check of the markets with Inez Ferre down on the floor of the New York Stock Exchange.
Miles, the Dow's up 275 points. The S&P and NASDAQ are also higher. Taking a look at Cloudera, that's higher as well. This is after the company beat on the top and the bottom line for their latest quarter, with the loss per share coming in narrower than expected. The company boosted its full-year guidance. PagerDuty, though, is tanking. This is after the company cut its adjusted loss per share full-year guidance. Wall Street is weighing in already, with JP Morgan cutting its price target on the stock to $38 from $60. And then Zoom is under pressure. This is despite a beat on the top and the bottom line, but the growth rate is slowing, and that's why you're seeing some pressure on the stock. And yesterday in their earnings call, CEO Eric Yuan said that the priority for now is to focus on the existing customers and to make sure that they're happy. The Dow's up 275. Both the S&P and the NASDAQ also higher. Make sure to stay with us. Wi-Fi AM starts right after the break. They'll be talking about the jobs report, a blowout jobs report. Stick around.
Good morning on this Friday, and welcome to Wi-Fi AM at Yahoo Finance. I'm Dan Roberts. We've got Heidi Chung and Kristen Myers here on the couches. Let's take a look at the markets. You are seeing green all across the screen. A very different picture from this time yesterday. All three major indices are higher by a lot. The Dow is up 288 points, or more than 1%, on the strength of a very good jobs report. Let's begin with the blockbuster jobs numbers that just came out this morning. The Labor Department announcing that the U.S. economy added 266,000 jobs in November. That was compared to 180,000 originally expected. A big beat. The unemployment rate also ticked down from 3.6% to 3.5%, and job growth for September and October were both revised up. Joining us to talk about it from Charlotte is Jay Bryson, Wells Fargo Acting Chief Economist. Jay, thanks for coming on.
Thanks for having me.
So what do you make of this? And sometimes we get the headline number and the jobs added is a beat, but there's some little dark cloud to talk about, say, well, people aren't paying attention enough to this other metric, and yet this particular report, it looks all very positive.
Yeah, there's very little not to like about this report. I mean, not only do we get much stronger than expected job growth, unemployment rate coming down. I mean, if there's anything that you could kind of, quote, quibble about here, it's that average hourly earnings weren't quite as strong as expected. But, on a year-over-year basis, they still remain above 3%. So, this was a very, very solid sort of jobs report. And it should relieve any sort of anxiety that may be out there that the job market is falling apart.
Jay, it's Heidi here. So a lot of people out there now saying that this blockbuster report gives President Donald Trump some leverage when it comes to the U.S.-China trade war. Do you agree with that?
Yeah, everything else equal, sure. I mean, it does. It shows that the U.S. economy is rather strong here. I mean, if it was really weakening, that would clearly, I think, weaken the negotiating position of the U.S. So, yeah, this, on average, does give some good news to the president in terms of that regard. But, this is only one little sort of data point, and I don't know if I'd read too much into that whole calculation there.
Jay, let's look forward a little bit to the holiday season. Obviously, we've had Black Friday now, we've had Cyber Monday. But what you hear is, look, this jobs report coupled with gauging the health of the U.S. consumer, which after Black Friday and Cyber Monday, the numbers were very encouraging. This sort of has more potential to juice stocks as we head into 2020 than the overhang of the trade war.
Yeah, well, so, I mean, if you look at our forecast, and we came out in late October with this forecast, for holiday spending this year, we're looking for a year-over-year growth rate of about 5%. We're a little bit above the consensus, at least at the time. And, when you look at the consumer sector in general, it remains very, very solid. And as long as we continue to create jobs, it even doesn't have to be at this pace. If we're talking 100,000 to 150,000 in that sort of area there, that's going to create a lot of sort of income. And as long as, the U.S. economy continues to perform relatively well, everything else equal, that should be positive for the overall job market. But there is still some risk out there. We could wake up on Monday morning and find out that trade talks have broken down between the United States and China, and I think that would put a damper, at least in the time being, on the overall market. So that's still a risk that's out there.
Hey, Jay, so speaking more about some of those risks, exactly how long, as you're looking at the economy, we used to talk about recession fears, exactly how long do you think this run is going to continue?
Well, there's no reason to necessarily expect a recession here. Recessions happen in one of two ways. One is when something big in the economy gets way out of balance and then it corrects. So examples here would be housing, or 20 years ago, tech. 30 years ago would have been commercial construction. So you say, look around the economy, what's wildly out of balance? There's nothing that's wildly out of balance. The other way recessions happen is something just unexpected comes along, like an OPEC oil shock. Those things, by their very nature, are just unforecastable. So, again, our forecast, looking out through the end of 2021, continues to see the economy continuing to expand over that period of time. I mean, I think the biggest thing that could get us, at least in the foreseeable future, would be one of these unforeseen sort of things. And again, they're just unforecastable.
Jay, quickly before we let you go, what are your predictions for the Fed meeting that we are going to have next week?
Well, if there was any question that the Fed would be on hold, I think this jobs report just completely dispels that. Clearly the Fed's going to be on hold next week. And frankly, I don't think it's that big of a deal. I mean, I think they're going to come out in their statement. They're going to continue to say, we're on hold. We're continuing to watch what's happening in the economy. Risk remain maybe tilted to the downside here. But I don't expect them to give us any sort of indications about their T-bill, any more details about their T-bill buying, or anything else in terms of monetary policy. I think it's going to be kind of a snoozer of a meeting overall.
All right, Jay Bryson from Wells Fargo, thanks for coming on. Appreciate it.
All right, thanks for having me.
Now, let's get to the latest in the U.S.-China trade war. China will waive some tariffs on pork and soybean imports from the U.S. These were retaliatory 25% tariffs that China had imposed on U.S. soybeans and pork back in July 2018. So you have to wonder whether this is a positive sign that maybe we're closer to a possible, potential Phase 1 trade deal. Yahoo Finance's Rick Newman is here on the couch with more. Rick, good news?
I detect skepticism in your tone of voice, and I think that's very appropriate.
You tell me.
I think China is doing exactly what is in its own interest. It actually needs pork. They've had African swine fever has decimated the Chinese pork industry, and they need pork. I mean, their biggest consumption period is the Chinese New Year, which is coming up in a couple of months. So they're just lowering tariffs so they can get what they need. They have been able to get soybeans that they used to get from the United States from Brazil instead. There's some speculation that Brazil has cranked up its prices, so sort of trying to take advantage of perhaps cornering the market. So China might be saying, yeah, we're not cool with that. We're going to go find another source. So I don't think this indicates anything at all about the status of the trade talks. I think China is doing what is in its interest and nothing more.
Like China, I need pork.
Same.
Oh my God.
Can we get Dan some pork, please?
Do you think, or what's the likelihood that you actually think the U.S. is going to hold off on those tariffs on the 15th? Because you've seen this before.
More likely than not is my guess. And I don't think that's because, if it happens that way, if Trump says we're delaying the imposition of these tariffs, I think the markets will read, oh, that means they're close to some kind of breakthrough on the trade war. And Trump will probably say that or suggest that. I don't buy that at all. I don't believe anything either side says on the progress they're making because we just have no deal. They've been talking about how close they are to a deal for over a year, literally. Oh, we're almost there. We're almost there. I'm really optimistic. It could be the greatest trade deal ever. And all we've gotten is more tariffs. I think those December 15th tariffs, that would be on the biggest batch of consumer products imported from China so far. I just don't think Trump can do it. I think he said he was going to do that, hoping that it would never get to that point. I think China might call his bluff and he might have to pass.
Rick, I posed this question to our guest earlier from Wells Fargo, but what are your thoughts on that argument that perhaps this jobs report that we just got, super strong, it was a really good one, that gives President Trump more leverage in this trade war, therefore he can really get what he wants, potentially whenever he wants?
Yeah, I think it does give him more leverage in the trade war. The fundamentals of the U.S. economy are pretty good. I mean, remember, even though we have a very solid labor market, we still have growth of only around 2%. And there are some trouble signs. I mean, one of the things I noticed in the jobs report is we had a bounce back in manufacturing jobs, but we have had a significant slowdown in manufacturing from last year, and that's important. But also remember that Trump doesn't just look at the jobs market, which we only get those numbers once a year. He looks at the stock market every day, even though he said earlier this week that he doesn't look at the stock market.
No, he
he tweeted just
this morning.
Yeah. How great the stock market is.
When it's good, things are good.
The
when
stock
it's bad,
market,
it's not his fault.
the stock market registers instant approval or disapproval of what's happening in the trade war, and that will keep Trump somewhat honest.
All right, we'll see. We'll see if this has an impact, even though you said it's really just about China doing what's best for China. Thank you, Rick.
Yep.
Well, Saudi Aramco's IPO will fall short of the $2 trillion valuation the Saudi crown prince wanted, but it will still be the largest IPO in history. Yahoo Finance's Jared Blickery joins us now to discuss. Jared, what is the status with this IPO? Why no $2 trillion?
Well, the price of oil has a lot to do with it, and the price of oil has been depressed. Now, in the last few days, it has shot up. Coincidentally, there was an OPEC Plus meeting where they decided to cut production by 500,000 barrels per day, which is very bullish for the price of oil. I think that's the only reason why we saw it get a $1.7 trillion valuation, because Wall Street, well, remember they were doing their road show around Europe, and they had to cancel it right before they got to London because there just wasn't demand. Almost all the money they've raised, and it's over $25 billion, which is a lot. It's the biggest IPO raise in history. But all of that is coming basically from Saudi Arabia and the surrounding states. And so it's kind of, I think it's a failure for them. They did get it off, but it's not listing in any major exchange. They're listing it locally. It's not going to have a lot of liquidity. And the test going forward is going to be, can they get that second listing on a major exchange? Because they really want to raise more money and they want to have the legitimacy of being in Tokyo or Hong Kong or London or the US, and that's not happening so far. And breaking news, the oil minister in Saudi Arabia just got off, he was in an interview and he said, we think that the Saudi Aramco is going to be valued at $2 trillion very soon. Well, that requires a $10, $15 spike in the price of oil. I don't see how that's happening.
Okay, so that was going to be one of my questions, is just oil prices. You and I always talk about crude prices.
That's all we do.
I mean, it finally broke above that tight range that it's been trading in, but do you think these levels are sustainable, and where do you think oil prices go from here?
Based on the long-term picture of crude oil, because we've been saying for some time we got tons of supply coming online, not only from U.S. shale, but from Brazil next year, from Norway next year. Russia is developing something in the Arctic, which could mean 2 million additional barrels per day. That's a few years out, but the long-term picture for crude oil, it's all pointing to a very bearish picture. So maybe $45, $50 a barrel instead of around $60 a barrel where we are now. And that points to a much lower valuation for not only Aramco, but all oil companies.
Where do you think is the likeliest place that it could list in the next listing on a major exchange? Could it come to the NYSE? Would it be in London?
Well, the reason they don't come to the United States, or they probably won't, is because they face litigation risk from a number of fronts. It's a very litigious country, but also because Congress passed a law which would allow 9/11 victims to go after Aramco. They have to avoid that. London is probably out because they're not listing enough of their shares, and then they could go to Hong Kong. I think because of the turmoil over there, that kind of got lost or put in the dustbin. And then Tokyo was actually the last place where they said we might do the second listing. That was the last rumor.
So, what does this mean then for the future success of a public company if they can't even attract any kind of foreign investment?
Well, it's all about valuation. Had they simply gone after $1.4 trillion, I think they would have seen a lot of institutional demand, but there's a certain amount of hubris that goes into this. Yes. They wanted to beat Alibaba, raising more than $25 billion, which they did by a very small percentage. So yeah, they're going to be the biggest IPO in history. But what kind of bragging rights come with that? I think the stock is not going to do particularly well over the next year. It's going to have to come down to reality. You had the Crown Prince phoning his wealthy citizens here, many of whom he locked up in a hotel room 2 years ago in the Palace coup. And so I think the handwriting was on the wall. A lot of these trades are on margin. They relax those restrictions. I just see it as kind of a sham to get the valuation up to $1.7 trillion.
Hubris. That is the headline. That is the right word. Thanks, Jared. Well, coming up here on Wi-Fi AM, Uber released its safety report, and some of the data is troubling, but the company is talking about openness and transparency. Welcome back to Wi-Fi AM at Yahoo Finance. Markets very much in the green after that very positive jobs report. Let's go right down to the floor of the New York Stock Exchange where Inez Frey can tell us more. Hey, Inez.
Hi, Danielle. We're looking at the Dow that's up 280 points. The S&P and the NASDAQ is also higher. I want you to take a look, though, at PagerDuty. This is the company that went public back in April. You'll take a look at that stock. It's under pressure. This is after mixed third quarter results. Their CEO, Jennifer Tejada, in their earnings call last night talked about front-loading sales hires back in the first half of the year. And this they didn't ramp up those sales hires fast enough in the territories where there was a lot of expansion. And so that impacted sales productivity. This is an execution problem that she says they are working on. The company also gave some weak fourth quarter guidance when it comes to their bottom line. They did announce also separately a new Chief Revenue Officer, Dave Justice, who's formerly from Salesforce. When this company went public, their IPO price was at $24 a share back in April. Then in June, it reached a high of $59 a share. Now it's trading below its IPO price, Dan.
Thanks, Inez. We'll check back in with you soon.
See you soon.
Well, Uber says there were 3,045 sexual assault incidents during Uber rides in the past year. 464 of those incidents were reported rapes. The details came out in the company's 84-page safety report yesterday, which broke down data that was recorded in 2017 and 2018, and it included incidents that had been resolved on or before October 31 of this year. Now, at least 103 of Uber drivers in the U.S. have been accused of sexual assault or abuse over the past 4 years. But it's very important to note that of those 3,045 reported assaults in the new Uber report, drivers were the victims in almost half of them. Now, CEO Dara Khosrowshahi tweeted about the report, "Doing the right thing means counting, confronting, and taking action to end sexual assault. My heart is with every survivor of this all too pervasive crime. Our work will never be done, but we take an important step forward today. In the long run, we will be a better company for taking this step, because I firmly believe that companies who are open, accountable, and unafraid are ultimately the companies that succeed." The idea being that Uber didn't have to put this report out publicly, but chose to. So openness, transparency. It's also worth noting that he tweeted that I'm sure some people will be surprised by how infrequent these incidents were.
I don't find that infrequent at all.
I think some people will think the number is very high, but it's all relative. And of course, whenever we talk about the dangerous things that have happened in Uber, Lyft, or other ride-sharing app rides, many retort that, well, those things also happen with yellow cabs, city cabs.
But also, it's worth noting here that Didi, which is the lead ride-sharing company in China, also has a lot of these situations in which several of the incidents ended up in death. So this kind of stuff does happen a lot. I think it does say something here, though, that Uber did come out and disclose these actual figures publicly before someone went through everything and found it themselves. I think that says something, but
proactive rather than reactive.
Right, but we also haven't heard from the company on how they plan on dealing with the future of these kinds of incidents and preventing it from happening.
But wait, do we actually think it's proactive? Because I don't, actually. I mean, there's been a lot. I mean, frankly, they were booted out of London because of safety concerns. Lyft had gotten sued by several riders that said that they were assaulted. I think that this is just where the space was going at some point eventually. I don't know if this is them saying they can really give themselves a pat on the back and say, oh, well, we were always, leading the way by releasing, some of these safety statistics, and particularly with Uber, they've been lampooned a lot about how little they've actually done to protect, I guess now both drivers and the riders, people being able to repeatedly go on the app even after being booted off or fired or for whatever reason. So I actually find these numbers pretty terrifying. But again, it is going to happen. Sexual assault is something that people do have to contend with in this world, so it's going to happen in an Uber or a cab or a bus or wherever.
Do these numbers dissuade you from using Uber as a service?
No.
Probably not.
No.
But I wonder if this will sort of spark a situation where maybe people will say, well, why don't we put cameras inside the vehicles? Maybe that will prevent things like this from happening. But all in all, I'll continue to take an Uber.
How many cameras there are everywhere else all over the world. So.
I was going to say, I was like, I don't find sexual assault declining because of cameras on every corner and block, where I feel like they practically are. So.
Right. All right, we will leave it there. Coming up here on Wi-Fi AM, we will tell you what stocks are trending right now on YahooFinance.com.
Let's see what. Time for today's trending tickers. First up, Ulta. Shares are higher this morning and soaring after the beauty retailer reported better than expected third quarter earnings and raised the low end of its 2020 guidance. Same-store sales also beat estimates and rose 3.2%. Things are looking a lot better at Ulta. If you recall, Ulta shocked investors when it reported second quarter financial results that missed estimates. The stock tanked nearly 30% in a single day back in August. So this is some good news. It seems like a bit of a relief rally here. And if you guys recall, when I did my decade piece, Ulta was number 10 on the best performing list of the past decade. So,
Lip kits.
Kylie.
Well, that was a bump for them.
You love saying kits every time we talk
I remember
about
that
Ulta.
big miss, though.
But also, I think what we need to talk about here is the fact that in the beauty industry, there are continuing issues regarding color cosmetics. Now, skincare is where all of the growth is right now. And so if Ulta cannot figure out a way to sort of deal with only relying on color cosmetics, they don't really have a big presence in skincare. I think that's something that a lot of investors are going to be concerned about going into 2020.
You remind everyone watching what the term color cosmetics means in the industry?
Yeah, so like when you're thinking about eyeshadows or foundations or blush, anything that is not put directly on your skin as something to improve skin as opposed to cover up things or enhance things. So skincare would be things like toners and serums and moisturizers and things of that nature.
Color cosmetics, not everyone can use the exact same product.
Right.
So Heidi and I wear very different foundations, lipsticks,
And
etc.
I.
And you as well.
And you as well, you do.
Exactly.
And Sephora has proven to do also incredibly well in the color cosmetics by picking up such brands like Savage by Fenty? Yeah.
Is that what it's called?
Fenty Beauty.
Okay.
Savage by Fenty is her, I think, lingerie line.
That is by Rihanna.
That's by Rihanna, yes.
And of course, Rihanna has her Puma thing.
Yeah, but also
Fenty originally was with Puma.
Sephora's owned by LVMH.
Yes.
Which obviously deep pockets, so that's nice for them.
Sephora, where I recently made an online purchase, and I found
what did you buy?
A rare example, a gift. So
Okay.
I'm not going to say on air. A rare example where the product was much cheaper than on Amazon. And that was on Cyber Monday. And it was not
Interesting.
marked down for Cyber Monday.
Sephora usually is so expensive.
Go Sephora.
But the one difference between Sephora and Ulta that I do want to clarify is that Ulta does have a lot of drugstore brands that they carry in store as well. So if you're going in to buy something, you can see a wide range of different kinds of
They're
products.
also better for hardware as well.
Like curling irons.
Like curling
and-
irons, blow dryers, things like that.
Yeah, I do enjoy an Ulta experience.
Right.
That being said, we are taking another look at a different ticker today, and that is Zoom Video Communications. Shares are tanking this morning, even after the video conferencing company reported a big beat on both the top and bottom lines during its third quarter. Zoom also boosting its full-year revenue guidance. So it appears that a beat and raise just wasn't enough, you guys. Analysts saying that perhaps investors were looking for an even bigger beat and raise. Now, keep in mind, Zoom was one of the rare profitable IPOs of this year. It went public at $36 per share, excluding today's price action, guys. The stock is up about 93% since IPO.
Maybe just a correction. It flew too high.
Well,
Do
I
we
wouldn't
think so. Down almost over 9% seems a bit much. They were expecting a
they're-
bigger beat and
it's
raise. I mean,
news.
they kind of like very strongly beat a lot of the estimates. They were again almost one of the few profitable IPOs.
No, it has soared since the IPO.
No, it has, but I mean.
In an environment.
Considering all of the other companies that we do talk about, especially the ones that went public this year, you would think that investors would be rewarding Zoom, especially on this news, as opposed to down over 9%.
Didn't we see this
That's a lot.
one quarter recently with Beyond Meat?
Yes.
It was a beat, it was a raise, still the stock fell.
But I
Because
feel like-
the expectations have gotten so high.
And also there was that lockup expiration. So that day it sank a lot. But I will say this stock is one of the only ones that IPO'd this year that is still above its IPO price. When we take a look at Uber and Lyft, I mean, Beyond Meat is still above its IPO price as well. But I mean, this company also, I think someone astutely pointed out at Bloomberg that during the Hong Kong protests, this company's stock price actually inflated. People were downloading this more because people were being forced to communicate through video chatting as opposed to going in person. So that was a really interesting point as well.
SAS.
I hadn't even thought of it.
SAS.
Yeah, SAS.
Cool.
Yeah.
All right, coming up here on the show, some very unfortunate Amazon mix-ups with Black Friday packages. We'll tell you about that story. Welcome back to Wi-Fi AM at Yahoo Finance. Apple is explaining itself after security reporter Brian Krebs said that the iPhone 11 Pro searches for a user's location even when location services was turned off. Apple denied that it tracks your location if you have location services turned off, but it's another Apple-related controversy. Our tech editor Dan Howley is here with more. Howley, is this happening or not?
No, not in the way you think. Right? So according to Apple, this whole issue has to do with the fact that when you would go on your phone, you could disable all of your location data. You see when certain apps ask if they want to use your location, you can say no, never, and that should be that. And that's basically the way Apple presents it. But it turns out that there was some location data that was being used to determine if you were in areas where a certain type of high-end connectivity is allowed or isn't allowed. It's really a new feature on the iPhone Pro, 11 Pro, and the iPhone 11, I believe. And really, this is high bandwidth connectivity between devices that's meant to be used for sending super precise airdrops. Or eventually, it'll lead to a Tile-like device that'll let you track your iPhone or Apple Watch or other Apple device from your phone. That's really what the basis for this technology is. But according to Apple, there are certain international regulatory compliance issues with this. So they needed to be able to know if a phone was in an area where it's not supposed to be used. And so they're saying that none of this data was ever collected by Apple. It was all done on device. So the device would be able to say, okay, I'm in an area like the CIA where I can't send high-speed communications between my device and another device.
If you're there, you already know.
Right. You're being tracked in the CIA, for sure.
I was going to say, this seems a little bit like, yeah, I mean, you have a cell phone. I just kind of assume I'm being tracked no matter what. Even if I turn
you don't want them to know where you are, well, they're always going to know where you are.
Right, they always know where I am. I mean, sure, the apps might not necessarily, a particular app might not necessarily know where I am, but like, yes, my phone knows where I'm at all times.
It's just like people shocked that the Amazon Alexa is listening.
Right, I can't be that.
It's a device made for listening.
Right, I can't be that surprised, and it's always listening to make sure it can hear you say, "Hey Alexa" or something like that. Right.
So I mean, so the Hey Alexa thing is. It's always listening, but there's a caveat in that it's never sending what it's listening unless it hears a wake word or it hears you say something.
So the same thing is happening here then, right? So your phone is always tracking. It's just not sending that information onto someone else.
Yes, I would say that that's a fair analogy. And the whole controversy really is that Apple has made a lot of its bones on the fact that it is not the same as Google, as Facebook, as any of the other big companies.
They even did billboards, about
in Vegas,
locked down.
Yep, they said what happens on your iPhone stays on your iPhone, while overlooking Google and Amazon, who had these big Amazon Echo or Alexa and Google Assistant tents, basically that were listening to you. That at the time, that's when we heard about the devices listening. Yes. And Apple was smart and was like, hey, we're going to put up this big sign that says, we won't do that on your iPhone. So it's kind of like an issue where Apple's reputation is very much, we are the safe bet. And if you look, they're not in this conversation
privacy,
about data privacy. Right, exactly. They're not a part of the issues that are going on. They are the ones that are always the safe bet. And so this kind of sullies that, but technically not.
Not really.
Yeah.
No, people forget.
You have to know. If you want a laptop that's not tracked, you got to get something air gapped. If you want a phone, like if you're on the run, you got to throw your phone away. Like everyone's seen the movies. We know this.
You're going to get rid of your iPhone.
No,
exactly.
Of course not.
No one will get rid of their iPhone because of this.
Well, I am, as I've said for over a year, I'm very interested in the Google Pixel phone. I don't think I'll actually cave and do it.
But that phone will track you too. You know what I mean? You're not going to.
Of course. No, if you don't want to be tracked, don't do any of this
tracked.
stuff.
You can't have a phone. Just don't use exactly. You can't have technology.
Well, cell phone signals. Cellular signals are able to track you, so no matter where you are.
And that's it.
No,
it's
I mean,
all
just
police state.
But if nothing on you has tech,
no, they still know. Skynet.
Oh God.
Skynet knows.
All right, thanks, Allie.
Thank you.
Thank you. As shoppers receive deliveries from their Black Friday orders, some say they're receiving more than they ordered. Some Amazon customers, most of them in the UK, who ordered a Nintendo Switch device, are complaining that instead of receiving what they ordered, packages they got were filled with random items, including batteries, razors, books, a tambourine in one case, and even condoms. Amazon issued an apology. It said, "We're really sorry about that and are investigating exactly what happened. We're reaching out to every customer who's had a problem and made us aware so we can put it right." And they remind customers that if you received the wrong items, you can go right to customer service. So maybe it was a mix-up with SKUs. SKU. You order the Switch and there's 1 digit different, and condoms are only 1 digit away.
That could most definitely be the case, in my opinion, because I've been looking a lot into SKUs recently, especially given that a lot of consumer packaged goods companies, beverage companies, snack companies, they have to expand essentially their SKU count by an incredible amount just so that they can reach the consumers that they're not able to reach already, right? So if we think about Gatorade, Brian Sazzi and I are actually working on a piece, and we'll probably be releasing it soon, but if you think about a company like Gatorade, the fact that they have low sugar, regular sugar, zero sugar. It's like, it's insane. So if you think about,
I ordered a 60-pack of the zero sugar, not the low sugar, you blew it.
If you think about the Amazon facility, right? The fulfillment center, think about how many products are being stored there, and thus they all have, how many different SKUs are there?
All that said, that's no excuse.
It's absolutely not an excuse.
It's supposed to be the most efficient,
saying, excuse?
smoothly running.
Is that your pun?
Yeah, no.
It would have been a clever one if you were.
No pun. What would that be a pun?
But anyways. Okay.
Excuse.
Okay, well, I guess my point is this.
Moving on.
Everyone buys a lot on Black Friday, Cyber Monday. It's like, how many of these incidents already occur on a, not regular basis, but I'm sure these mix-up happen pretty regularly, right? And so you're just going to hear more, you're going to hear about it more on a day like Cyber Monday.
But also, if an employee is being overworked and you're not able to check all of everything, the paper with the product, with the SKU code and everything, there's a lot of complaints.
That's why Amazon is automating their
about the warehouse workers.
Right.
Peeing in bottles.
Yep.
Being told to work, 15-hour shifts or whatever it was. Yep. We had our colleague Crystal Hu reporting live from one of the warehouses on Cyber Monday. That was a cool shot with all the packages in the back. And there is a part of the process that's already automated. There were all these levers pushing certain packages down to an offshoot. It looked like when you see into the guts of the conveyor belts at the airport.
Yes.
You're going to have mix-ups.
A lot going on. Yeah. But if you wanted a Nintendo Switch and you're excited to play games and you get a box of condoms, it's not what you wanted.
Fair enough.
Coming up here on Wi-Fi AM, we will take a look back at companies that died in the last decade.
Welcome back. I'm Ines Ferre here with Pete Tuchman. Pete, a blowout.
Pete.
A blowout jobs report.
Unbelievable. It's such an odd number. I mean, yes, they come out with these every month, and you got to wonder. Obviously, that shows a super strong economy. It is not a holiday season number, right? So this is last month's number. I don't know if they adjusted anything, but that's strong. And in any way you look at it, it's a super strong economy, and I know the administration is claiming responsibility for it, and that's always fun and good for a president that doesn't look at the stock market, my understanding is. But great numbers, 277,000, right? Is that what?
266,000.
Okay.
Does this give President Trump more leeway as far as the China trade negotiations are concerned, as far as the timeline?
I don't think it has anything to do with it. Right now, I think he's pushing that off because it may be the little ace in the hole for the election. For leverage for the election. It's obviously helpful to him because now the market is actually rebounding back to 28,000 on this good news, right? We saw one day sell off on that crazy drive-by about the 2020 postponement of the tariff war, the tariff question. We don't know what's going to happen. Yesterday we got a headline that said something is going to happen on December 15th. I don't know what it is yet. that kind of left everybody in limbo. But this is solid. This is what the market needs to go a little higher. I spoke to you last week about it. I think we need to totally disengage the China story. The market's telling us to buy on fundamentals here. The China story seems to be a short-term, whether it's positive or negative news on a headline or a tweet. It seems the market is once it fluffs it off.
The 15th of December, though, I mean, this looming
I think so that's a looming date. The president did say here, you got Kudlow saying jobs growth soars in November. That's all fine and good. But at the end of the day, yesterday, there was a headline that came out that the president, president said that December 15th, something's going to happen with tariffs. We're not clear what it's going to be. So that is the unknown. There's your Christmas present in a box. It could be good, could be bad. If it comes in that we are going to, it depends on how much he levies, if he increases it. I think if they raise it 50%, which is one of the threats, and it could put a short-term sell-off into the market. Are we going to look at a December as bad as last year? By no means.
different environment. Thanks so
Totally.
much. Thanks so much, Pete. Make sure to stay with us. Wi-Fi AM continues after the break.
Welcome back to Wi-Fi AM at Yahoo Finance. Now, as we approach 2020, we have been covering some big business milestones of the past decade, and today we're looking back at the biggest corporate busts of the past 10 years, some companies that basically died in the last decade. Yahoo Finance's Emily McCormick is doing that and joins us now. Emily.
Hi, guys. Yeah, so Brian Sozzi and I took a look back at the past 10 years and looked at some of the biggest corporate failures. So companies that went bankrupt, that are now defunct, now no longer in service. And we found a couple of similarities between a lot of them. So first is competition. Second is an inability to adapt to that competition. And then third tends to be a high debt load. So we're talking companies like Brookstone, Sears, Toys R Us, Blockbuster, Bon-Ton. Some of these companies that have been around for decades, or in the case of Sears and Bon-Ton, around since literally the late 1800s, that went bust in the past 10 years.
Wait a minute, Bon-Ton, what's that?
It's a department store,
Bon-Ton.
retailer, sort of like a, I guess like a JCPenney's.
They're very popular in places like Pennsylvania and Ohio. People hang out at the local Bon-Tons.
Wow.
Exactly. But if we look at some of the characteristics of these companies, I mean, I think Borders is a really good example. The bookstore, of course. They really didn't pivot when this competition started coming into play. I mean, at the end of their life, they still had these stores that were like 25,000 square feet. There was just too much retail space, too much merchandise, just as people were starting to pivot to Amazon and some of these e-retailers. They never started something like a Kindle or a Nook that Barnes & Noble did. So they were investing in technology, but the wrong type of technology.
Well, they had Kobo. They did have a Borders e-reader, but that was pretty late. They were way too late.
Right.
I do remember a massive Borders right near where I grew up that existed way too long. Now, just quickly, Sears, I think of all people, Sozzi would probably say, well, it's not dead yet, right? I mean, it's sort of,
right. I mean,
it's been reanimated as a corpse that can still move its limbs.
Right, and I think what he always says is it's really kind of like a zombie company, but for all intents and purposes, it's not at the height that it was in the mid-1900s. You know, that I think that is something everyone can agree on. And again, because of a failure to pivot,
no surprise, but a ton of retail names.
Right.
But there's also Theranos.
Right.
Wow Air. So those companies, I mean, Theranos, we know why it failed,
right.
But a company like Wow Air, it just didn't really have a really sustainable model to begin with, right? Because
right. And again, I think that still falls into the category of just increasing competition. I mean, think of something like a Ryanair. And WOW Air isn't the only company, only European airline that was a budget airline that went under. But it was because of that margin pressure and the fact that it really was a race to the bottom in airline pricing that they ultimately went out of business and left thousands of customers stranded on the day that they ceased operations.
So I saw Toys R Us is on the list. Are there any companies that you think could have like a Lazarus effect and actually rise back from the dead?
Well, even Toys R Us actually, now has new ownership, just opening a new store in New Jersey. That's something that Brian Sozzi had just covered as well. Some of these companies could come under new ownership, but I think with a lot of this, once as consumers, we have entrenched that they have failed, it's hard to really turn that image around. So I think a lot of times it takes something like a name change, a total rebranding to really bring a company back to life.
I know people wanted Vine to come back. I always thought.
Love
I actually always
TikTok
thought.
is like a
I
Vine,
thought Vine would always come back.
And actually, Dom Hoffman, the founder of Vine, is working on a Vine 2.0 or another social media platform.
Also
yeah,
the
so he
founder
says.
of Peach.
Right.
when you were doing this research, though, Emily, were there any companies that really surprised you? I guess.
Not really, to be perfectly honest. I think a lot of these were kind of a slow decline. We sort of saw all of them coming. I mean, look at Blockbuster. We knew since 2000, when that meeting happened between Netflix and Blockbuster, that they turned down the buyout opportunity, turned down the opportunity to partner, and now look where they are.
There is still one Blockbuster location in the U.S.
Have to visit.
Private
It's in
franchise.
Bend, Oregon.
Oh, it's Oregon. That's right.
I went to the second to last living
that
one,
in Alaska?
which has since closed. It was in Anchorage, Alaska. Sad. All right, thanks, Emily.
Thank you, guys.
And our viewers can find the story on yahoofinance.com. New government data shows that total healthcare spending in 2018 spiked 4.6%. And of course, that is a lot higher than income growth, which grew 3% in 2018. The reason more Americans are foregoing health coverage, leading to a rise in individual healthcare spending nationwide. Anjali Kemlani joins us now with more. So this is not a great trend.
No.
This is discouraging.
It's discouraging, but it's also, if we want to be really fair, it's kind of on an average pace of growth since 2008, which is, right before the Affordable Care Act hit. So what we've seen is that the cost of the spend in healthcare has been increasing marginally, but we've seen it hit, like the private side a little bit more. We've been seeing things like the health insurance tax, as well as the Cadillac tax that businesses are trying to fend off. They're supposed to help support the ACA and fund it, and that is where a lot of the growth is coming from, because it's just sort of shifting, to everyone else to take on that burden.
So we talk a lot, obviously, after every single Democratic debate about Medicare for all and all the varying plans that the candidates have proposed. How would any of them, just Medicare for all, frankly, impact any of this?
So it would kind of be, if you take a step back and look at it, it's kind of the same problem, because Medicare for all would then also have to be funded, right, in some way, shape, or form. And right now, Medicare itself is not able to cover all the services, and that's why Medicare Advantage exists, and that's why the private side exists. But then at the same time, we're looking at, expansion of services that the Trump administration is calling for on Medicare. So that would actually be a test case to see, can the services at the federal level take on more with the same sort of pool of money? But we've seen the trend has been in a couple of different areas. Like for example, we've seen retail drug prices increasing. We've seen drug prices in general increasing, but slowly. That sort of took a step back in this recent report. But then when it comes to hospital services and physician services, those are still sort of growing at the same kind of trend. So it's almost business as usual.
More people are foregoing healthcare. Is that correct? And
rather than getting a plan,
right? So they're
say, I'll pay out of pocket.
Right. And so is that something that we've been seeing since ACA happened, or just more recently?
More recently, because the Trump administration rolled back the individual mandate, and so that's where that is coming from. And it also comes with, there's been a lot of sort of innovation in the healthcare space when it comes to prescription discount cards, right? And that doesn't require the use of insurance. That is actually more out of pocket, but then you end up sort of paying less. And so we've seen a lot of these different variations affecting how consumers are actually choosing to pay for healthcare.
All right, spending more, and it's going to continue.
Yep.
Most likely.
Oh, definitely. They're supposed to hit $4 trillion in the next 2 years.
All right, Anjali, thanks so much.
Absolutely.
Well, coming up here on Wi-Fi AM, Sacha Baron Cohen is going after Google again over Larry and Sergey leaving. We'll tell you more when we come back. Welcome back to Wi-Fi AM. Netflix is working on a system to provide more audience metric numbers for its original films. Netflix is notoriously tight-lipped about viewing numbers, and it only occasionally shares them when it wants to tout a big hit. But Scott Stuber, that is the head of original films at Netflix, has said that it's time to be transparent to help the creative communities making films for Netflix. He told Variety, "We're not hiding anything. I just want it to be articulated correctly to protect the filmmaker and protect the movie, because box office is not the whole business for us." Now, I've written about this, whether we can even trust the numbers when they come out, because sometimes, on the rare occasion Netflix decides to say, look at how many people watched our movie, the number is a little hard to believe when you consider, wait a minute, like with the Adam Sandler, Jennifer Aniston, bad detective movie, they gave the number of households that had watched it, and it was like a third of all Netflix subscribers.
So,
like really a third of all the subscribers watched that movie?
So it's not just that the numbers are unbelievable, but you and I have also talked about this. Remember when they released the streaming numbers for Stranger Things? How they actually classify a viewer, I
70%.
don't actually believe is an accurate way of portraying what a viewer
Me too.
is.
For a show.
For a
TV
show, right. But this comes into part of how they're looking just wholesale at what they classify a viewer. Is a viewer if you consider a viewer someone who watched your movie if they've only watched 2 minutes of an hour and a half long film, I would say that is not a viewer,
70% for a movie I think is fair, because you're not going to watch 70% and not finish, or even if you don't finish, you watched. But I went with you to say that watching 70% of the first episode of a show means that that's a viewer of that show. Not at all, because how many of us watch just the pilot of a show to see, do we like it? And then we say, we don't. I'm not going to watch the rest of the show.
No, I agree with you guys both. But my question here is, I wonder if some creators actually came to Netflix and said, hey, we're not going to sign with you if you don't actually. Yeah, we want the actual data, and we want you to tell other people the data so we can measure our success, right? I feel like they're being pressured at this point, backed into a corner, because all the other outlets and all the other providers and platforms are doing that.
Wait, do you think, but to that point though, do you think some of these content creators, once they've gotten some of the these really large checks have been cut to them, do you think they actually then care on all of the content that they've made about
once
those numbers?
the check has been cut, maybe not. But
That's my point,
I think Heidi was saying before they even agree to do a movie that will only be distributed by Netflix, they want to know, well, how many eyeballs will see it?
Right, and advertisers or people that want to make merchandise for your movie or whatever, they want to know that you're reaching a larger audience, and that those people are also going to be those companies are going to be able to tap into that kind of audience as well.
I don't know. It's. I wonder if there's going to become like a Nielsen for like stream. I mean, I
well,
know that
there
they were moving, but you know what I'm saying? Like you can go to the Nielsen ratings and you can see for ABC, CBS, whatever. When are we going to start seeing that for Hulu, for Netflix, for Disney, for ABC?
That's happening. And Nielsen just started tracking those streaming services, but they do it using listening, and it doesn't quite.
It's quite difficult.
It's a
when are we going to start getting G, PG, PG-13, rated R
I've been wondering
ratings
about that,
on movies and shows on streaming platforms? Because at the end of the day, we had a guest on the final round, and Jen Rogers asked, well, is this safe enough to watch with my children? I had to look it up on a specific site. And I think Netflix and other platforms need to start doing that. And
some of them do start. I've seen some of the content out on Netflix will start releasing kind of some of those like warnings.
Heidi doesn't want her kids watching The Irishman.
Right, my child that I don't have.
Very good Netflix original movie I watched recently that was very under the radar. Barry, about Obama.
Oh.
Not a documentary. It's a movie with actors. It was good.
Oh.
Yep, I know. No one talked about it.
I want to watch it.
Free recommendation. All right, the actor Sacha Baron Cohen, you might know him as Borat or from his political satire show that was a big recent hit. He's come out criticizing the Google founders, Larry Page and Sergey Brin, after they announced they would step down from their day-to-day roles at Alphabet. He tweeted out, "First you drop your don't be evil mantra, now you drop out? You still control 51% of voting shares, so stop Google and YouTube from spreading white supremacy conspiracies." Now, in his previous ADL speech that went mega viral a couple weeks ago, Sacha Baron Cohen referred to Larry and Sergey as part of what he called the Silicon Six, which he coined in a speech, as I mentioned. And he also mentioned Sundar Pichai, Susan Wojcicki of YouTube, and Twitter CEO Jack Dorsey, along with Zuckerberg. Now, Cohen has been very outspoken about these media companies. Of course, they don't want to be called media companies, being an active part in the spread of misinformation. He used that ADL speech and pulpit to rail against mostly Zuckerberg and Facebook, But I had mentioned too, people frame that as, oh, he goes after Facebook. He also went after, in that speech, Google and Twitter and YouTube.
Yeah.
I don't know necessarily what impact this has.
Right.
But he has a big platform.
Yeah.
He does, but a lot of people don't really like it when celebrities get too vocal, and that has been something that has, I think, really accelerated since the 2016 election, but we are going into another election year, so I expect that we will hear people from a lot of different backgrounds get very political, and I know, but the big tech thing, to me, just seems like an easy target for a lot of people to drum up followers, and what's that look? I'm looking at Kristen like she's like,
I don't think he cares about drumming up followers.
Yeah, I don't either.
I'll take him at his word that he cares about this.
Sacha Baron Cohen for years has actually been kind of these under radar activists. He donates a lot to a lot of different charities. He has been outspoken in the past about, but he's not very big about it. He doesn't make a huge show. And it wasn't until that recent speech about Facebook, which frankly I found a lot of people agreeing with. I think he tapped into a very popular sentiment. Right. No, it was a great speech. Tapped into a lot of sentiment that we're hearing now. So I haven't seen that backlash of like stick to acting. Sacha Baron Cohen. You know what I mean? I think a lot of people have said, yeah, you're absolutely right. Now, I don't know if I necessarily agree with this line of saying, look, oh, you guys dropped out of running the company.
Then it's like damned if you do, damned if you don't.
Right, exactly. So what, are they supposed to stick around and just into this like company that he personally can agree with, and then they can
sort of
leave?
just using this news peg as a way to continue the screed.
Yeah.
But he has some very salient points, especially, I believe, about Facebook. Okay, we'll be right back here at Wi-Fi AM after a quick break. Welcome back to Wi-Fi AM at Yahoo Finance. Papa John's in South Korea has now introduced a new type of pizza. It's called American hot dog pizza. And, surprise, it has an entire hot dog on every slice. The pizza is available for a limited time at select South Korean locations. And our food correspondent, Heidi Chung, happens to be here on the couches today. How convenient. Would you try it?
I would absolutely try it. I do want to caveat this conversation by saying Domino's and Papa John's and Pizza Hut in Korea are very, very notorious for putting interesting toppings on their pizza.
That's a nice word for it, Heidi. Interesting.
So, yeah. Like what? They put interesting toppings on it. So they have very themed ones. They'll have a seafood one with like shrimp and clams and mussels and all sorts of things. And Korean pizza also likes to put sweet potato in their crust. So instead of stuffed cheese crust pizza like we have here in the States, they like to stuff it with sweet potato.
That sounds delicious.
Mashed sweet potato. Now, I'm a huge fan of Korean style pizza. It was definitely an acquired taste, but this is interesting. They put some other interesting stuff on it, not just hot dogs. They put like mashed potato.
All the things you said sound great to me, except the hot dogs.
Why? It's like a pepperoni. It's just
but look, it's an entire hot
pepperoni
dog.
Is a thin little slice.
Yeah, but
it's just a whole hot dog.
So if you fold that though, it's like a hot dog with cheese in it.
Yeah. You fold the slice. You fold the slice in half. You've got the.
Sounds dangerously close to the Paula Deen heart attack.
No.
But speaking,
it's like a cocktail
cheeseburger
wiener with
two Krispy Kreme donuts as the bun.
But as you can see also in that photo, Koreans love to eat their pizza with pickles.
Love a good
Love eating it with
not with-
pickles. I know, it's usually sandwiches here in the States, but Korean style is a little different. Speaking of Papa John's, though, we do have to talk about the troubled
more Schnatter
founder, who is no longer actually really a part of the company anymore, but Schnatter.
He owns quite a lot of shares.
Right, but he has been divesting some of his investment in the company, or his
Cash
share.
out.
Yeah, he's been cashing out.
Yeah, first he made news recently in a video interview when he said, I've had 40 pizzas in the last 30 days.
Yeah.
And then he said, these guys running the company now, they don't know pizza, they don't have pizza experience. And then he said, you just wait because more things are going to come out.
Stay tuned, yeah.
And stay tuned. And the interviewer said, why not just tell us now? And he said, stay tuned. And now the news today, unfortunately, John Schnatter's wife has just filed for divorce.
Right. Unfortunately for
More
who?
tough news.
But isn't he
Schnatter.
also trying to? He's there's a lawsuit, I think.
Yes.
Where he's also
Against
trying
the PR firm that
that released the audio of
Where
him.
he said the
Right,
N-word. Yep.
right.
We'll have to leave it there. Thanks, guys. That's Wi-Fi AM for today. Stay right here to watch On the Move. That shows up next, and have a great weekend.
We made it to Friday, 11 a.m. here in New York City. 90 minutes into the trading day, stocks are trading higher. You're hired. The November jobs report smashes expectations, with the U.S. economy adding 266,000 jobs. That's 83,000 more than analysts expected. Shocking report, Uber reveals more than 3,000 sexual assaults occurred during rides last year, and that's just in the United States. And pork progress. China says it will waive import tariffs on some U.S. goods, which include pork and soybeans. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for joining us. The top story, of course, is jobs, and the November jobs report crushed Wall Street estimates, with non-farm payrolls surging by 266,000, while the unemployment rate fell to 3.5%. This jobs growth was the best since January, and we've got team coverage to break it all down. Yahoo Finance's Brian Chung is with us, and Inez Ferez on the floor of the New York Stock Exchange. Let's start with Brian first to break down these numbers. Brian?
Well, a blowout jobs report for the month of November. 266,000 jobs added in the month of November on the top line, and unemployment rate down to 3.5% relative to 3.6% as of October. In addition, the average hourly wages actually went up 3.1% year over year. That actually beat estimates of 3.0% year over year. But the big number was really that 266,000 number. The expectation on the street was actually only for 180,000. Some expected that there would be some juicing in this report because of the GM strike ending. That brought a few few tens of thousands of workers back into the labor force, but no one expected it to beat by quite this much, especially when you consider that the trend for the last few months was actually around 160,000 since the end of the summer. So even if you only expected 160,000 plus the GM workers coming back to work, you only would have expected 200,000, which means that 226 figure that we got today was pretty amazing. On the unemployment rate, we did see it tick down to 3.5%. That is back to a 50-year low. The street had actually expected 3.6%, which was the same number that we saw in October. And then wage growth lastly again at 3.1%. This is what the Federal Reserve is very closely watching when it comes to any sort of inflationary pressures that may, if it were to be dramatic enough, actually inspire them to maybe raise rates. But it only ticked up to 3.1%, again, slightly above expectations, but not nearly at the 3.4% wage growth that we saw last year that actually spurred some concern that maybe there could be some hiking in the future. So for right now, it seems like this overall jobs report telling the Federal Reserve they can stay on pause for that last meeting that will happen Wednesday of next week.
All right, let's turn to Inez Ferre on the floor of the New York Stock Exchange for how the markets are reacting. We're in the green, Inez.
We are in the green, Adam. Markets rallying on the heels of this strong jobs report. And one trader was telling me this morning that the jobs report also gives President Trump some leeway when it comes to this China trade negotiation. We're looking at the Dow that's up more than 300 points. The S&P and the Nasdaq are also higher. Almost every single Dow component is in the green right now. We're also looking at record highs for some of the Dow components. Take a look at Apple. Apple up more than 1%. JP Morgan Chase up 1.75%. Nike also hitting record highs today, up around 1%. The Dow is being led higher by 3M and Goldman Sachs. We also want to mention some other record highs with Google up more than 1%. Qorvo, the American semiconductor company, almost up 1%. And also Taiwan Semiconductor hitting record highs today as well.
Thanks, Inez. And I want to introduce this hour's panel to discuss jobs as well. RSM Chief Economist Joe Brusuelas and Yahoo Finance's Brian Chung, who's still with us, of course. And also joining us from Chicago is Austin Goolsbee. He's an economics professor at the University of Chicago and former chairman of the Council of Economic Advisors under President Barack Obama. Austin, it's great to see you again.
Yeah, thanks for having me.
What is going on here with this jobs growth? We're now looking at this 3-month average of 205,000 with today's numbers and the revisions. What do you think is still driving it, and where's that slowdown that people have been predicting?
Well, you know, it's funny because we've got kind of this two economies going, or 1.8 economies and a 0.2 economy. Everything that has to do with the consumer, the job market, is very strong and very solid. And those things that have to do with manufacturing have not been that great. And even in this strong jobs number, you saw only enough strength in manufacturing that it probably came entirely from the GM strike ending and them coming back. I think the strongest story of the U.S. economy was, is, and remains that the U.S. consumer remains confident and keeps spending.
Austin, I'm curious, that wage increase, 3.1%, and non-supervisory wages, I don't have the percentage, but they actually rose by 7 cents. What do you interpret all of that to mean? Are we really seeing a tight labor market, or as some analysts have pointed out, that there may be slack, and what you really saw with wage growth is the end results of the stimulus we got through tax reform and fiscal stimulus from last year that still lingers today?
You know, I don't know if it's from the tax cut. I think most of the tax cut did what it was going to do in the first year, and then the tyranny of the accounting is if it goes up and then stays steady, that counts as zero after the first year because it's not contributing to growth. I think that 3% number has been relatively stable for several months. So before this month's job number, as you know, and as you saw on the graphic, we had 4 months where the jobs growth was getting slower and slower each month. But the wage number stayed around this year over year around 3%. So that's certainly solid. There probably, or there may be still a little bit of slack from the people who are out of the labor force. Maybe they could keep coming in. In the other survey, you saw that the number of people out of the labor force actually grew a fair bit this month. So it'll be interesting to see. This was an encouraging month. But like I say, if you have to do with the consumer, it's looking excellent. If you have to do with manufacturing, they've they've kind of been in decline for 4 months in a row now.
So Austin, Joe Brasuel is here. At the outset of the show, you noted, I think rightly, the unbalanced economy we had. What policy measures would you put in place to address that balance or imbalance?
Well, look, not to get into the realm of politics, my view of the tax cut was it cost $2 trillion, and what it mainly delivered was a windfall. It did not generate the investment that was promised. It didn't generate $5,000 increases in wages. It didn't increase the growth rate to anything substantial. We're now looking at a forecast for this coming quarter in the ones. So I think revisiting that and investing on the personnel side and in the labor force for the job market that we know we're going to have and need 2 to 5 years from now, I would put the focus kind of in that area.
Hey, Brian Chung here. So we've seen that maybe some of the previous jobs reports that we've seen, at least in the beginning of the year, were actually revised downwards, not necessarily meaning that all revisions are downwards, but that has been the trend recently. Do you expect this to be a candidate maybe for a downward revision? Would you expect it to be substantial when the BLS does end up revisiting these numbers at some point down the line?
That's an important question. It very well might be, especially when you get things like when you know there's a big strike. Months like that tend to have substantial revisions when you look back. I think an interesting additional, it's not really a revision, but what is going to be the role of the temporary census hiring, which in this month, government employment looked relatively small. I wonder when they come back with the revisions, if there's not going to be some more significant component of that temporary census hiring that from now through, let's call it the spring of next year, there are going to be literally hundreds of thousands of people getting hired. And then as we go into the summer of next year, there's going to be literally hundreds of thousands of people losing their jobs. So it's going to wreak a little noisy havoc on our jobs numbers.
Austin, next summer we're also going to be even more fully in the throes of the presidential campaign. It's my understanding that you have just endorsed Pete Buttigieg in that race. Tell us why. What do you like about him, particularly from an economic perspective?
Well, look, I think he's smart. I started skeptical, I will say, because he was a mayor. I got to know him. I think he's whip smart. His economic policy, I think, is spot on in what he's placing his focus. And he's got a lot of energy. And it reminds me of, I was an Obama guy back in early in the day, 2006, 2007, out in Iowa. It kind of reminds me of what's going on there. And I just think there's so much chaos in D.C. these days. Somebody not from the D.C. chaos would probably be the order of the day.
And the diplomatic way of putting it, I think. Austin Goolsbee, former chairman of the Council of Economic Advisors, as you mentioned, under President Barack Obama, now a professor at the University of Chicago. Thank you.
Thank you.
A staggering report from Uber. The company said it received almost 6,000 reports of sexual assault involving passengers or drivers in the United States between 2017 and 18. This was the first safety report the company's ever released. Joining us with more about this, Yahoo Finance's Alexis Keenan. And you want to point out, too, that when we hear these numbers, I think we're all kind of a bit in shock. But it's not just the passengers, it's the drivers, too, who are being assaulted.
So these are incidents of both. And keep in mind that we're talking specifically about a 2-year period, 2017 and 2018, in the U.S. exclusively, not overseas. So what Uber is reporting, and they didn't have to release this data, by the way. It comes on the heels of Lyft coming at the back end of another lawsuit yesterday. We'll talk about that in a minute. But this data represents 3.1 million U.S. trips per day during 2017 and 2018 on average. Now in 2019, they're up to about 4 million rides per day, so we would expect perhaps the numbers could increase. Now, Uber says that these incidents are extremely rare statistically. 99.9% of rides happen without any safety issue at all, but here are the numbers. So in total, sexual assault-related incidents, drive-related incidents, the total for those 2 years, 5,981 reports. 464 of those were rape reports, 587 attempted rape, 3,000 reports of touching of a sexual body part, as well as about 2,000 kissing incidents, non-consensual kissing incidents. This represents a major departure from Lyft. Lyft has not put out those numbers. Lyft is the subject of the defendant in many, many more lawsuits, at least 50 lawsuits with plaintiffs alleging sexual assault. Uber has at least 3 or 4 lawsuits against it, though despite Lyft being a little bit more forward and more into its litigation, and despite demands from attorneys asking for this type of information from Lyft, they have yet to disclose it. I have asked myself many, many times and have not received these numbers. So for Uber to be doing this, it's a big step.
So transparency is great, but what are they doing about it? I mean, there are some screening requirements for the drivers, but how stringent are those screening requirements? I mean, and again, as we talked about, in many of these cases, it's the drivers themselves who are being assaulted. But in the alleged assaults by the drivers, what is Uber?
So both companies have taken steps to implement safety features. Most of them are app-based at this point. A lot of the victims are calling for there to be live streaming video in the cars, and the drivers cannot operate or accept a ride unless they have a live streaming video enabled. But at least Uber has shared with us from its chief legal officer, Tony West, a video explaining what the company's intent is in releasing and analyzing some of this data. So let's take a listen to that.
What I hope is that ultimately we have a safer rideshare platform, and that means we have to understand what's happening on the platform. We've got to count it. If you don't count it, then you can't confront it. If you don't confront it, you can't end it. The numbers are hard to digest, and they're hard to see, but they're not surprising.
Now, added to those 6,000 sexual assaults reported, there have also been fatalities for both drivers and passengers. Fatalities for those 2 years, 107 people.
Is there, the numbers alone are frightening. Is there a way to put it into context? I can't think of another industry in which an individual is alone with the supplier of a service in this kind of manner. But is there a way to put this into context? Because they say statistically 99.9% of these rides are absolutely safe.
Sure, and on top of that, we know quite well that sexual assaults are widely underreported. And so Uber, in publishing this data, cautions that we shouldn't even be comparing the numbers to the nationally reported numbers because they say it's a very apples and oranges comparison.
Yeah, I would imagine it would be anything else in the gig. You know, if someone cleans your home or does another job in your home, I mean, anything that is a person-to-person service.
Mm-hmm.
I would
But 4 million rides, a day is it?
3.1 million U.S. trips per day for this particular time period.
In the era of big data, there's no reason why, as a consumer, I don't have more information on my driver. This is just simply not acceptable.
They want fingerprints. They want, more robust background checks. Right now, those things aren't happening.
All right, thanks, Alexis.
You're welcome.
It. Let's turn to trade now because China says it's willing to waive import tariffs for some soybeans and pork shipments from the U.S. as the two countries work to reach a phase 1 deal to end the year-long trade war that has rattled global markets. Also, we heard from Larry Kudlow speaking on a competing network this morning saying, we're making some progress, but, I'll believe it when it's actually happened, as I've said time after time.
I love journalists. I've worked with journalists for years. This is one of these mornings where it was a little bit
no offense,
clickbait.
but I'm about to say something to offend you.
Bad. Yeah, it was clickbait. It was this was taken out of context. What the Chinese said was, they're going to do more of this only if it's based on market, surrounded by market context, which the Trump administration doesn't support. This was just one of these great cherry-picked headlines, and at least early this morning, it bolstered futures. Fine, no big deal.
When you say clickbait, I thought they had already announced that they were going to rescind some of the tariffs because they have the problem with protein supply in China because of the virus killing the pigs. And they have yet, let's get to very simple. They promised to buy $50 billion, according to President Trump. They haven't bought. They aren't buying. Nothing's changed.
Nothing's changed. This is whether you liked Groundhog Day or The Boy Who Cried Wolf, pick your parable, right? It's the same day, one day after the other. And every time we get a good headline, futures on the Dow are up 0.5%. Okay, fine. We get a bad headline, they can go way down.
Yeah, and to your point, Adam, yes, I mean, the soybeans have been something we've been discussing for a long time, but I think investors are more concerned about any sort of headline risk that comes with anything related to that December 15 tariff, because that's kind of the more immediate, would be the new round, fresh round of tariffs that would really kind of.
But an investor who doesn't take into context that they had already said they were going to do this tariff move several weeks ago is being blind to what's happening. And if you're making a decision based on what could happen tomorrow, when you look at what's already happened from the Chinese, you know.
Look, they're not going to put that December 15th tariff in. Why would you want to kill the equities market and really do harm to the traditional holiday season? Because it's that last 2 weeks before the holiday where you get the most intense portion of the spending.
All right, well, coming up, signs of a slowdown with why German manufacturing just took its biggest hit in 10 years. Plus, before we go to break, take a look at some of the top trending tickers on Yahoo Finance today.
Welcome back to On the Move. I'm Jared Blickery, and we don't have the indices at record highs, but we got some sectors there: healthcare, consumer staples, which is lagging but still at a record high, and a few others, communication services notably. Dow is up 300 points plus, over 1%. S&P 500 just shy of 1%, as is the NASDAQ Composite. And here's a look at the intraday price action. We can see that we gapped up here, and we're just about touching that 31.50 level, which is resistance from last week when we were at record highs. We can see there it is, just 350 and change there. Let's go on to the SIBO Volatility Index, the VIX. The fear index is lower substantially after coming off highs a few days ago of 18. And then the 10-year T-note yield, this is up today, 4 basis points. Again, this is a 10-day view, but we can see the trend is definitely up here. So as we see the T-note yield rising, we also see the US dollar index is up as well. Now, we've taken a year-long look at this, and this is what's happened. We can see we got this trend channel in place, and we were speculating yesterday, are we going to bounce off the trend channel, or are we going to break below it? So far, we're bouncing right where we should. WTI crude futures, those are up by the biggest amount, or actually at a 2.5-month high here. And this is a year-long view, year to date, and we can see that we're still pushing up against that 60 resistance. Kind of touched it, just a few pennies short, but did back off from it. Gold took a big hit on that payroll report, and we can see that we still have this flag, but we are holding 1450 support there. And what else do we got? We do have the euro versus US dollar that is declining. That means the US dollar is strengthening. We just looked at that, and we'll take a look at a bunch of other stuff when we get back here in 1 minute.
Well, the November jobs report released earlier today, 266,000 jobs added. Our next guest is watching U.S. consumers, stating he expects consumers to stay strong going into 2020 despite market activity and geopolitical news. Sam Dunlap, who is Angel Oak Capital Advisor, Senior Portfolio Manager, joins us now to talk about this. And we've been talking about the strength of the consumer. What do you see that we might be missing about the consumer? We know the wage gain, 3.1%. What else is there that tells us the consumer is here and going to stick around for a few more months?
Yeah, great question. Thanks for having me on. You know, the U.S. consumer, really on the heels of this robust labor report that we got this morning, just continues to not only shine from an increased wages perspective, but they continue to de-lever. And I think that's to your question, what we may be missing here. I think that, you know, market participants are well aware of the strength of the U.S. consumer, but I think they've been using the fruits of the longest expansion in U.S. history to really de-lever and reduce household debt to GDP, you know, as I've mentioned before, from approximately 100% pre-crisis to approximately 75% today. So, you know, a healthier consumer with an improving balance sheet with a strengthening labor market bodes well as we look into 2020.
All right, so what's your favorite metric when you're looking at the consumer to divine where you expect the pace of spending to go?
Well, really, from a consumer credit metric that we really look to really is mortgage bond investors and focused on mortgage credit is really looking at mortgage debt to GDP, which has come down from approximately 75% pre-crisis to 50% today. So that's a really healthy metric as we look at the consumer debt picture, which has really been improving quite a bit, and particularly mortgage credit, and you know, again, on the heels of all these favorable labor trends that we're seeing and increased wages, and in addition, incredible amount of home equity that's been created. That really bodes well for mortgage credit as we look forward.
And non-prime mortgage credit is where you are mostly investing. We've heard some mixed signals on the housing market, right? Because we have some affordability issues in a lot of areas. For example, talk to me about how that corresponds or doesn't correspond with the attractiveness in mortgage credit.
Yeah, really where we focus is more on the non-agency side of mortgage credit. So anything really non-government guaranteed, and that incorporates a whole host of variety of factors. But you know, I'd really kind of boil the U.S. mortgage market into two different categories: agency and non-agency. And then as you look at the non-agency market, you really have pre-crisis, which is often referred to as legacy, and then post-crisis, which would be referred to as RMBS 2.0. One of the really interesting things that we're seeing in the RMBS 2.0 market is what's really the evolution of the non-QM or non-qualified mortgage market. So that's an area where you're starting to see increased credit expansion, but I think it's important to note that the expansion that we're seeing currently has been relatively muted compared to pre-crisis trends. So mortgage credit availability is still relatively tight, which is really improving the credit metrics that we're seeing in new issue RMBS 2.0 and particularly new issue non-QM. So we have really tight, robust credit standards of new issue non-QM with, historically speaking, wide spreads that make it a really attractive allocation for us. So, you know, the affordability side of the housing equation, I will note, you know, it's been under pressure over the last couple of years, really on the heels of this incredible home equity creation that I mentioned. But you also had that large uptick in mortgage rates, you know, on the heels of the Trump tantrum. But as we know on the Powell pivot,
hey, Sam, we got a question. Hold on a second.
I just want to ask. I want to expand on that QM point real quick. I mean, what is going to be the big catalyst from a structural standpoint in this market? Is it the adjustments that we saw from QM from regulators earlier this year, or will it be any sort of new frameworks that we can get from the federal government on how to reform maybe Fannie Mae and Freddie Mac and take them out of conservatorship?
Yeah, I think the trend from a political perspective, particularly a regulatory landscape, is that you're going to continue to see, I would say, influence from Fannie and Freddie in the mortgage market, and really an increased focus, if you will, on the growth of the private sector mortgage market and the potential growth of the non-QM market. Really on the heels of the non-Q or the QM patch, if you will, that's expiring in 2021. So, you know, there's a lot of unknowns and uncertainty, if you will, on the future of Fannie and Freddie and conservatorship, to your point. But we're pretty bullish on the prospects for growth as we look at non-QM, really coming with the expiration of that QM patch in 2021.
Sam Dunlap, thank you very much.
Thank you.
Coming up, PC or console? We'll look at some of the hottest video games this holiday season and how you can play them. Plus, OPEC agrees to cut oil production, what that means for the price of crude straight ahead. Coming up on 11:30 a.m. here in New York City, 2 hours into the trading day, stocks are rallying in the wake of the jobs report. Crude awakening. Oil prices are also rising. That's after OPEC and its allies agreed to increase production cuts by an additional 500,000 barrels per day. We're now seeing oil at $59.04 the barrel. A rough day for Papa. The latest drama surrounding embattled Papa John's founder, John Schnatter. And the unemployment rate fell to 3.5% in November, but it's not the same for everyone. We're breaking down the numbers in our latest edition of Yahoo You. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. We're heading to London. Germany's manufacturing sector taking a hit. In October, output fell 5.3% year over year. To break this down, Yahoo Finance's Edmund Heafy is joining us from London. And so do we know what's behind the steep drop?
Well, Adam, I think the factors are probably multifaceted, and this is the biggest month-on-month drop since 2009. And by way of explanation, I suppose there's US-China trade tensions, which are affecting everything. Then there's US-EU tensions, and then Brexit uncertainty, which continues to drag down the overall EU economy. If you dial back then and look at the actual manufacturing sector in Germany, it has been flagging for a while. There are 100,000 job cuts planned in the sector, and 80,000 of those come from the auto sector alone, which is dealing with the Dieselgate scandal and the shift to electrification, which they are all struggling with. The country then is also very reluctant to introduce fiscal stimulus measures because of the strict budget rules in the country. So what we're looking at here is, as a result of this, perhaps Q4 GDP growth will be in the negative, and one analyst from Bloomberg suggested that the German economy will have contracted by around 0.6% in the fourth quarter. And then because Germany is the economic powerhouse of the European Union, that will obviously have an effect on the overall Eurozone economic growth figures. The German economy ministry said today that they acknowledged that there was weak momentum in the German economy, but that they still expected the situation to stabilize overall.
Thanks, Edmund. Well, in 2014, Microsoft acquired Minecraft. Now it's out with plans to take it to the next generation with an augmented reality version of the game. It's called Minecraft Earth. Matt Booty is Corporate Vice President of Xbox Game Studios, and he's joining us now from Redmond, Washington. Yahoo Finance's Dan Howley is also with us as our in-house gaming and tech expert. Matt, I want to start with you. Tell me about Minecraft Earth and what you hope this will do to the user base for Minecraft.
Hi, good morning. Well, Minecraft Earth is our game that allows you to take things that you build in the Minecraft game and take them into the real world using augmented reality tech that we've got built on top of our Azure platform. And it's a fantastic way to build things in the game. You can build at home, you can build outside, and then take those out and anchor them in the real world. And we are always looking for ways to bring new Minecraft experiences to the community, which continues to grow and thrive. And this is one of the ways that we're going to further expand both the gameplay and hopefully the audience.
But how does, and I'm coming from the Atari generation, so forgive me, but how do you do this without a mouse, without a keyboard, with only augmented reality? I'm thinking of that movie with Tom Cruise where he's moving everything around with his hands. Is that what you're doing?
Yeah, it's actually much simpler than that, actually. Think of it as being able to build almost with building blocks or Legos, and all you need is a phone to be able to go outside. You hold your phone up, and with the power of our Azure Spatial Anchors, you're able to anchor those things that you've built in life size in a spot in the world. And so it's a pretty amazing experience the first time you do it, to build something that you've really only experienced in the game, and then to be able to take it outside and walk around inside of it. It's a pretty straightforward, simple experience, and it's really magical when you're able to take those creations outside.
Hey, Matt, Dan Halley here. I just wanted to kind of touch on another aspect of what Microsoft and Xbox are doing, and that's the cloud gaming platform that you guys are working on, Project xCloud. Now, we already saw Google Stadia. I got to play with it. Not really what I was hoping it would be, and I know xCloud is going to be teamed up with Microsoft's Game Pass, and that's really kind of the way that it looks like this entire industry is moving. I know Microsoft is also working with Sony on their own platform using Azure. How do you see this kind of changing the game space overall, and do you think it's a good thing or a bad thing for individual publishers?
Well, I think the ingredients for success when it comes to cloud gaming and streaming, we think of it in three parts. It's really cloud, content, and community. And I think to be successful, you need each three of those. I think Xbox and Microsoft were well positioned with Azure in terms of cloud, in terms of the infrastructure that we have, in terms of the services that run on top of that. Community is a big ingredient. Our Xbox Live community is a very vibrant gaming community. Each of our games, for example, Minecraft, but our other games such as Halo, have communities that are engaged in the game, that bring content, that bring a social aspect to it. And then when you mentioned Game Pass, that's the third part, which is really the content. And I think that all of these services will require a foundation of content. So we feel well positioned in terms of each of the three of those, and really hope to open up more choice and the ability to take your games with you and play on more devices. That's really our approach with xCloud.
For the investor that may not be familiar with your platform or your game, can you describe who the median user of this game is, what their profile is, and how you intend to monetize the virtual reality space?
Well, one of the beauties of Minecraft is that the audience is a lot more diverse, both in terms of age, gender, and geography than many of our games. The average age of a Minecraft player is actually in their upper 20s, which I think some people are surprised about. We have a big user base, obviously, with children, but the game remains popular with a lot of adults who grew up playing it. So when we think about the base of Minecraft, it really is one of the broadest, most popular games that we've got, both, again, in terms of gender, geography, and age.
Hey, Matt, so I got an early look at this when you guys first announced it, and I got to play it, and it was really something that blew me away. I played with the pigs a lot because that was fun, and I may or may not have accidentally killed a couple of chickens. But it's a really fun and amazing experience in the way that you have these different areas set up around the world and that you can drop your own in. I guess, how many users do you expect to make the jump from, Xbox, PC, the various, Minecraft is on every platform as is. How do you see that changing as far as the smartphone market goes? Do you see more people migrating? Do you see it existing as two different games? What do you expect there?
Well, in the case of Minecraft, we already have a very strong user base on mobile. It is right in there with console and PC, and mobile represents a bulk of our users. So I don't really think about it as any of the Minecraft players leaving console or PC. With a game like Minecraft, it really becomes a hobby for people. It becomes something that they want to engage with in many parts of their life. So we will see a Minecraft player play on console at certain times when they're in their living room. They might be playing on a PC or a laptop when they're at school, and then when they're out and about or when they're playing sort of solo, they might be playing on a phone. So we really think about the franchise and the game as making sure that we have some kind of content where you can engage across all of those endpoints. And that's true not just for Minecraft, but all of our games. Recently, our Gears of War franchise, for example, we have a mobile game that we launched, Gears Pop, which is a way for people to enjoy that content and enjoy that franchise, those characters, those stories, not just on console, but also on mobile.
Matt, thanks for your time. Appreciate it. Matt Booty is Corporate Vice President of Xbox Game Studios. Thanks.
Thanks.
Coming up, where are the jobs? We break down the numbers from November's Blowout Jobs Report, plus Papa John's founder John Schnatter sues his old ad agency while his wife heads to court and files for divorce.
In our stock spotlight, we got a big winner for you in the retail space today. That's Big Lots. The discount retailer reported a narrower third quarter loss. It was a loss of 12 cents versus the 20 cents that analysts have been anticipating. Sales rose by 1.6%. Comps, though, were just about flat, down about 0.1%. The company said it will return to earnings per share growth in 2020. On the flip side, we've got Ciena, the networking company, UBS, cutting it to sell ahead of its earnings report next week. UBS says that the company could miss what it's calling elevated expectations. The UBS analysts say that spending from clients like Facebook and AT&T has been going down. We'll be right back.
All right, OPEC and its non-OPEC allies have agreed to increase oil production cuts. That announcement came this morning as the Energy Alliance wrapped up its biannual meeting in Vienna. The group will cut an additional 500,000 barrels a day through March. Now, that's going to reduce output to 1.7 million barrels a day. We want to bring in Reed Morrison, PwC's oil and gas advisory leader. And as we were coming into the segment, I was looking at some of the oil stocks, trying to figure out what do you do if you're one of those investors who likes the yield with some of the big oil companies. And I pulled up ExxonMobil right here. ExxonMobil is trading higher right now. Its yield, its annual dividend yield is 5%. So these OPEC cuts, they don't really play into this, or do they? And if they do, explain to me as an investor how I need to calibrate that new calculation.
From the global production standpoint, these OPEC cuts are really just part of the system, because you also have another factor that's working against the production, which is the decline rate. And so as an investor, what you're looking at is how well can you rely on that dividend? And it's almost like the past present that the industry has given has been a lump of coal. You look at the destruction of capital, and now what they're giving the investor is a Rubik's Cube. It's sort of a trust me, but there's peak demand, and you got OPEC. And really what that investor wants is just a $5 bill. It's just give me a steady dividend.
Can I just very quickly, who do you trust?
Who do I trust?
Of the big oil companies.
Of the big oil companies, I trust all of them across the board in the standpoint of delivering the goods. It's the next tier of companies, that's when you start to see there's a little bit of a shared delusion around what matters.
You mean size-wise, the next tier down?
Does size even matter when you get into the size of those companies? Because the historical philosophy has always been growth was a good thing. And that investor was the growth investor. And that was when the narrative was peak oil. We don't know if we have enough. Now the narrative is peak demand. Who knows who's right? You know, predicting oil prices is a fool's errand. But what you can say is with a level of certainty, who's going to deliver the goods on the dividend? And the mid-tier companies and lower have not had that reputation.
So a lot of this is predicated on the collective action problem being solved, right? In a cartel, when you set pricing, that's the real issue. Right. Who eats the production cuts here beyond Saudi Arabia? And what do you think the composition is going to be?
I think you're going to have those that have the fiscal regime to be able to stomach that, because the interesting thing about these national oil companies and these big publicly traded oil companies, and then also the major independents, is they all have one main objective, and that is deliver free cash flow. And so if you've got the fiscal regime within a country that you can afford to take a little bit of that haircut, those are the ones that are going to do it, and that's what you're balancing.
I have to wonder, too, with Saudi Aramco about to come to market, obviously it's even more important than ever for Saudi Arabia to keep that oil price supported. So you have to wonder what kind of deals are being cut backdoor. You know, does Saudi Arabia say to another country that it wants to have more discipline in keeping to cuts? We'll give you an allocation in the IPO. Do you think those kinds of deals are being done?
I have no idea.
I mean, it would make sense, right?
I mean, them going public actually shed light on a lot of their financials. I mean, was there anything underlying then, to maybe rephrase Julie's question, in that Saudi Aramco IPO tell you something new about the way that people should be investing with this largest public company ever hitting the market?
Yes, I think that's one of the things that we're all looking forward to, is that level of transparency that comes with being a publicly traded stock. And that's where you're going to see both a lot of the concerns around, is Aramco going to be independently operated, or are they going to have some constraints? And that's the point.
I think what I'm hearing you say, and I think what the people who are watching as they try to determine whether to invest oil or not, is look for the dividend yield. The big companies, you seem to think, you know, the Exxon Mobils, the Royal Dutch Shells, whatever, those aren't so much a concern. It's the mid-level. What do those mid-levels need to do to compete with the big guys on that dividend yield?
They have to accept that it's not the big guys they have to worry about. And this is the cool part of the story, is the value investor doesn't care what industry it comes from. They're agnostic. So that mid-tier has always peered themselves against the super majors. Now they need to peer themselves against healthcare stocks, cigarette stocks. And you get into that scenario, and then you realize the game really has changed.
All right. Thank you very much, Reed Morrison.
Appreciate it.
Well, a stellar jobs report in November, as we've been talking about, with non-farm payroll surging by 266,000, unemployment falling to 3.5%. Let's dig deeper into that number and break it down by demographics. It's time for Yahoo You. Brian Chung is here with this week's lesson.
Okay, well, class is in session. As we saw from this morning's jobs report, unemployment is at historic lows, actually 50-year lows to be exact. And as we've heard Federal Reserve Chairman Jerome Powell say before, keeping the economic expansion going means pulling more workers off the sidelines and into the labor market. So here's the actual unemployment number, which shows the unemployment down at 3.5%. Again, that is a 50-year low. This period that you're looking at is only for the last 11 years, covering the financial crisis, which is actually in that shaded part over there. What we call this trend of declining unemployment tells us that this is a tightening labor market. But when you actually unpack the BLS data, you can actually see some really fascinating demographic trends that this headline number at 3.5% won't show you. And one way that they can actually granularize this is by taking it by and dividing it by education level. So this chart over here, the purple line is actually the aggregate number that I showed you in the chart before. But the blue line here actually shows you those that are unemployed among college graduates in the United States. And what we see is that's at 2%, extremely low. Makes sense because those who have that skill set coming from college are able to find a job easier. But what we want to focus on here is actually the orange line, which is above the aggregate number. This orange line actually represents those in the labor market that have less than a high school diploma. And at one point, actually only a year or two after the financial crisis, this number was once almost triple more than that of college grads. And what we've seen is that actually over time, it's narrowed. So those that have less than a high school diploma have actually caught up with the aggregate number in terms of being able to find more jobs in this tightening labor market, which means that this is a very good thing and a very good trend for those that are less educated in the labor market right now. And very interestingly, a similar story is playing out among minority groups. So let's keep in mind the purple line here in this case is actually the lowest one here, is actually the aggregate number. And the blue line represents those that are Black or African American in the US labor market, whereas the orange line represents those that are Hispanic or Latino. And these numbers show you that historically, Black and Hispanic workers in the United States have had a much more difficult time trying to find jobs in this market relative to the headline number. Now, unemployment actually improved for all of these groups, but what's most interesting is that specifically for Black or African American groups, which actually I'm now realizing is reversed, the orange line is actually Black workers, whereas the blue line is actually Hispanic workers. But the orange line represents how just dramatically the Black unemployment rate has come down over time relative to the aggregate number. You can see the gap in the years 2010, 2011, 2012, and just how narrow that gap has now gotten as the labor force has continued to tighten. But not as all perfect. So this is the labor force participation rate, and this is a measure of a different measure of the labor market. Whereas headline unemployment is a measure of how many in the labor force actually don't have a job. The labor force participation measure here is actually relative to all adult Americans, which would also include those that have given up on finding a job. And in the post-crisis recovery, this figure has actually slowly drifted down to a level of around 63%. For the past few years. So not necessarily a good thing that we can't get labor force participation up. But we also have a demographic breakdown of this as well. So in this case, we have the labor force participation rate at an aggregate represented by the purple line, whereas the blue line at the bottom actually represents African American workers, and the orange line represents the Hispanic members of the labor force. And these are actually the correct colors here. But what we have noticed is that the blue line, which shows you the Black and African American workers, it's actually been trending pretty closely to the overall aggregate labor force participation rate. So that as the labor market has tightened, there hasn't really been more workers being pulled into the labor market from that point in time. But interestingly, with the Hispanic and Latino members of the labor force, we've actually seen that it actually hasn't been too affected. We saw this drift down in the first few years after the crisis in the overall labor force participation rate, whereas at the same time, the Hispanic labor force participation rate didn't decrease by as much. It's a little difficult to see, but you can see that it actually did not fall in those first few years during the recovery as the overall aggregate did. So what does this tell us? This tells us that maybe there's a story in the Hispanic labor force that shows us there are maybe structural ways that you can get people back into the labor force that the aggregate and maybe African American workers have not experienced in the same way. And actually identifying what those factors are is a little bit of a more difficult task. But as we talk about this tightening labor market, yes, it's good for most workers, not necessarily all workers, maybe even better for some workers, but there are reasons behind that as well that don't have anything to do with one single point in time, like tax reform or like, for example, Fed policy, but all things worth mentioning as we continue to talk about this buzzy, hot labor market.
Thanks for the breakdown. Appreciate it, Brian. Let's talk about small business as well and how it relates to all of this. New data from the National Federation of Independent Business, it's one of the largest small business associations in the country, shows 30% of small business owners raised wages last month. 26% plan to do so in the months ahead. So, Joe, when you look at the small business plans here, you know, we talk here a lot about large public companies, but there's also this idea that small business is sort of the lifeblood of the U.S. economy. So it seems like good news that those wages
This is very good news, right? The number one challenge facing small and medium-sized enterprises is there are not enough labor, willing and available workers who have skill sets. So they are willing to increase compensation. When we run our surveys, our middle market business index, we see much more stronger increase in willingness to increase compensation to attract workers. But what I think is holding back the wage growth a little bit is we're now to the point where we're pulling off the sidelines people who've been out of the workforce for a long time. They don't have the social networks or the necessary skill sets. So there's a lot more outlays on training. When we talk to our clients, that's really one of the new things we're talking about is what sort of training, where are we going to go? And of course, for smaller firms, the intense fear is I give you this skill set, then you leave because your wage will get doubled after you've been with me a year.
You know I quote you a lot when I write different
yes,
things.
Thank you.
This issue you and I have discussed, that a worker today in what we'd call old economy, 72 cents to the dollar of someone. Are we going to see that start to go up? Are we going to see what we call income inequality start to shrink because of this?
Okay, you should see that at the end of the business cycle. We get some more employment reports like the one we saw today. Sure, but a lot of that is structural. The lack of investment in education and infrastructure in the traditional economy, which unfortunately we can also be called the red economy, that's holding those areas back, because if you don't have the quantitative foundation, if you can't code, you can't program, you're going to have problems breaking in. Those pathways to prosperity are much more, the hurdle's much higher than what it would be if you've had that education, right? We always talk about debt and student education. You know why education's expensive? It's because it's worth it.
Well, not always.
Well,
depends on what education.
You can have this debate during the commercial
Yes.
break. Coming up, presidential candidate Mike Bloomberg has a plan to control guns that would create a national licensing system. Plus, all work, no play inside the toxic work culture at one of America's fastest growing startups. Four people are dead after a shootout in South Florida. It started when two gunmen tried to rob a jewelry store. The robbers hijacked a UPS delivery truck. Police chased the truck for several miles. The shootout started when the truck had to stop because of traffic. The gunman, the UPS driver, and an innocent bystander were killed. Another shooting this morning at the Naval Air Station in Pensacola, Florida. The Navy says the shooter is dead. They've released very little information about this. 16,000 active military personnel and 7,000 civilians work at that base. 2 days ago, a gunman killed two people and himself at Joint Base Pearl Harbor-Hickam near Honolulu. Presidential candidate Mike Bloomberg released a gun control plan that includes federal licensing. He wants to create a national gun licensing system that would include stricter background checks and passage of a law that would allow courts to temporarily confiscate guns from people deemed dangerous. Papa John's founder John Schnatter is suing the ad agency that he says leaked recordings of him using racial insults. That controversy led to his ouster from the company he founded. Schnatter says his comments were taken out of context. By the way, his wife filed for divorce yesterday after 32 years of marriage, and she says they separated last April. We're going to be right back.
Time for Word on the Street, where we check in with our panelists and find out what stories they're watching. Brian, you're looking at the toxic work culture, allegedly, at the hip luggage company Away.
Yeah, so The Verge had a really fantastic investigative piece yesterday that profiled Jen Rubio, the co-founder and CEO Steph Corey of Away. This is one of those millennial brands that they sell luggage, and their model is direct to consumer. That's how they're trying to brand themselves. But the story just details the way that they were really abusing their workers, making them work a remarkable amount of overtime without proper compensation. And what's interesting about this story is they use Slack, which is a tool that we use here in the newsroom to communicate with one another, and they have a mandate that you cannot email, you cannot private message one another. Everything has to be done in a visible Slack channel so that everyone can see it.
And don't forget about the other connection to Slack.
Right, because Jen Rubio is engaged to CEO of Slack, Stuart Butterfield, and married now. But regardless, they were using this Slack messaging platform to basically berate employees publicly. It was like taking them out to the public square and saying, you didn't hit your quota for answering the phones today. Here, let me making fun of you in front of the entire company. And none of these things are illegal per se, but it just shows that this is an example of a millennial brand that brands themselves as we love the millennial culture, we love how hard everyone works, we're doing this because we're customer obsessed. But customer obsessed could also mean that you lose a sense of humanity, and that's not great.
Human nature is not unique to any generation, but there are things that are illegal. If you don't compensate people, those people can take you to, I don't know if it'd be the EEOC, but they can take you to court to be paid. I mean, they could face that.
Right, and I think what we've seen is that a lot of the employees who just didn't like it, they ended up leaving in this tight labor market. Hopefully they've been able to find something else. But yes, I mean, in some cases, maybe, who knows if there's some lawsuits maybe coming in the pipeline.
There have been reports on some other startups that are,
it's
not the
far
same
from
kind
the
of
only
abuses, but they're similar
A
culture.
very, very old comedy routine. Sometimes a banana is just a banana, according to Sigmund Freud, but when it's art.
I can make an economic argument that it's more than just a banana. Look, down at Art Basel, somebody paid $120,000 for a banana duct taped to the wall. All right, so this particular event probably is A, jump the shark. B, you wonder why young people think capitalism's not working. Go ahead and take a look. This will tell you volumes about changing attitudes, beliefs, and preferences in the country. And then third, perhaps wealthy people should think about reallocating what they do to more private venues. And publicly, you need to be talking about investing in people, software, equipment, and intellectual property. That's how we get this country moving again.
None of this is new. I forget who, it might have been Salvador Dali, years ago, went to an art event, like 50 years ago, and he brought a toilet. He brought a commode, he put it down, he said, there, art. This is not new.
No, this isn't.
How do you draw this to capitalism not working?
Okay, so when you see very wealthy people engaging in very silly spending behavior, it really upsets the millennials and Gen Zs who are having a hard time surmounting the hurdle or the barriers to entry into employment in the middle class. I mean, this plays into the conversation that we're having right now, whether it's the Democratic presidential candidates wanting to engage in very transformational policies, or the Republicans just taking a look at it and calling everybody socialist. Right.
Well, and the difference is Salvador Dali's toilet was not on Instagram.
Yeah.
That's true.
Right.
Right.
So the
Yeah.
reach,
Social media
the
has
reach
had it.
of these kinds of events, these public events, is probably greater than
It's
it.
true. That's definitely something new.
Yeah. All right, Joe Bruce Willis, great
Thank
to
you.
see you as always. Thank you so much. Brian Chung, thanks so much, especially for that demographic breakdown. Really good stuff. And coming up, Uber releases a shocking report that raises some serious questions about rider and driver safety. Plus, before we go to break, let's take a look at some of the biggest winners in the Dow today. afternoon here in New York City, about 2.5 hours into the trading day, and stocks hold on to that rally. And that's in the wake of this. You're hired. The November jobs report smashes expectations, with the U.S. economy adding 266,000 jobs, 83,000 more than economists expected. Shocking report. Uber reveals over 3,000 sexual assaults according during rides last year, and that's just in the U.S. And cracking down on insider trading. We'll have an exclusive interview with the lawmaker who is pushing for change in Washington. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Good to have you here. Our top story has to do with jobs. The November jobs report crushed Wall Street estimates, with non-farm payrolls surging 266,000. Now, while the unemployment rate has fallen to 3.5%, the jobs growth was the best since January. We obviously have team coverage on this to break this all down. Yahoo Finance's Heidi Chung is with us, and Inez Ferrer is on the floor of the New York Stock Exchange. We start with Heidi to help us break down the numbers. Go ahead.
Hi, Adam. Yes, the U.S. economy is chugging right along. The November jobs report absolutely crushing expectations. The U.S. economy adding a whopping 266,000 jobs during November, beating expectations of 180,000 jobs added. Now, unemployment rate at a 50-year low, ticking lower to 3.5% from 3.6%. And average hourly earnings rose by 3.1% from a year ago, slightly above consensus expectations for 3%. Now, looking at the different sectors here in November, the manufacturing sector added 54,000 jobs, exceeding expectations for 40,000, and that figure reflects workers returning to work after that GM strike. Motor vehicles and parts industries added 41,300 positions during the month, so just about reversing the decline of 42,800 from October. Leisure and hospitality and healthcare both adding 45,000 jobs during the month, and transportation and warehousing added 16,000. Now, both October and September's headline payroll figures were revised upwards by a total of 41,000 positions. Now, this revision brings up the 3-month average here of job gains to 205,000. Adam and Julie.
Thanks, Heidi. Let's now go to Inez for the market reaction. Inez, the rally is pretty much intact here throughout the day.
Definitely holding up, Julie. The three major averages are up around 1%, with the Dow percentage-wise gaining the most, up more than 1%. And if we take a look at the Dow leaders, those include 3M, Goldman Sachs, Chevron. And some of the Dow components which hit record highs today include Apple up more than 1%, JP Morgan Chase up more than 1.5%, and Nike up around 1.5%. Energy is leading the gains today. And speaking of energy, take a look at WTI oil, up more than 1%, trading at around $59 a barrel. This is after OPEC Plus, that's OPEC and its allies, agreed to an extra production cut in the first 3 months of next year. Julie, Adam.
Inez, thank you. Let's introduce this hour's panel. KPMG Chief Economist Constance Hunter, Yahoo Finance's Pras Subramanian, and joining us is LinkedIn's Chief Economist Guy Berger. Good to see you, Guy. We will start with you. Let's jump into the areas of the country which this jobs report, not only a good report, but for these areas of the country, really great. You point out hiring in Austin up 18.1% year over year. Phoenix is up 17+%, and Los Angeles up almost 15%. What's driving things in those regions, in those cities?
Well, especially Austin, Phoenix. You know, besides the weather that you have in Los Angeles, it's also affordable places to live. And so you have a lot of people moving there. These job markets are super tight, and jobs are growing across a wide range of industries, and people are moving there to take advantage of jobs and affordable housing.
And so the growth that we're seeing, does it also make sense when you look at the various industries where we're seeing growth? Heidi was just talking about healthcare, for example, as one of the big areas.
Well, healthcare was really strong in our data as well. And I think that's an industry that's actually like there are needs for these kinds of jobs everywhere in the country, but especially in places like Phoenix, where a lot of retirees may be going. There's extra need for those jobs. We saw transportation do really well in our data and also in the BLS data. And, you know, as a result, it's not surprising that we're seeing people, you know, the jobs growing, these areas that are fast growing, that are attractive, that are affordable, doing really well.
Hey, Guy, in the data that you're looking at on the city growth, what is the composition of those jobs, sort of the mix between low-paying, middle-paying, and high-paying jobs?
So we don't split up our jobs by pay, but I think when you look at, for example, skills that are in shortage in these cities, they tend to match what we see in shortage everywhere. I mean, a lot of it's things like tech skills, digital literacy skills, soft skills. It suggests, again, it's a broad range of jobs in all these places that are doing really well.
Hey, Guy Pross here. When you see wages climb about 3.1% year over year, what does that tell you? Is that good? Is that bad? Is it just right?
So the first thing I'll tell you is that what's interesting is that those numbers include managerial pay, and those have been kind of stuck and not doing well. And I don't know why managers are actually seeing slow wage growth right now. But if you strip those out and look at production, non-supervisory workers, wage growth for those has actually started picking up again and is now approaching where it was before the Great Recession. The job market seems to be pretty tight for people that aren't managers, and especially people on the lower end that in lower paying jobs.
Guy, there's something I want to ask both you and Constance, actually, and this was sparked by a piece that Neil Irwin wrote in the New York Times today, where he said the job growth, not just this month, but consistently has kind of shown economists had been wrong about, if you look, say, a year ago at the expectations for job growth, especially centered around trade, they were not this good. So, Guy, I'll start with you. What do you think has happened here, especially considering that we haven't really seen inflation as a result of the job growth?
So my answer is I don't think it was unreasonable to be worried last year. The stock market was crashing. Financial conditions were getting tighter. We didn't yet know the Fed was going to cut rates. I think there was a policy reaction. Financial conditions eased. And it's sort of either the worst case just didn't materialize. And so it's not surprising to me that once there's been a policy reaction, job growth has been resilient. If the Fed had not reversed course, I'm not sure we're seeing numbers this good.
Constance?
I would agree. The Fed reversing course has certainly helped, but I think I'd have to go back and look at the Wall Street Journal or Bloomberg averages, but I'm not so sure that people were expecting as much of a drop-off as you might expect this late in the business cycle. And of course, what surprised economists in both the private sector and the Fed, and a happy surprise, is the amount of people coming back in from the sidelines, the increase in the labor force participation rate that has enabled us to continue adding this many jobs above population growth this late into the cycle.
All right, LinkedIn Chief Economist Guy Berger, thank you for helping us understand these jobs numbers and the trends that are underway nationwide.
In the meantime, we're learning more about the risks associated with a different job, working at Uber. A staggering report from the company. It said it received almost 6,000 reports of sexual assault involving passengers or drivers only in the U.S. between 2017 and 2018. This was the first safety report the company has released. And joining us now is Alexandria Ravenel. She's author of Hustle and Gig, Struggling and Surviving in the Sharing Economy. Thank you for being here.
Thank you for having me.
So, Alex, these numbers are really dramatic. And even though the company says 99.9% of rides were safe, if you look at the absolute figures, you're talking about more than 5,000 over a 2-year period.
Right.
What does this tell us about the gig economy?
Oh, it tells us about how incredibly dangerous it is for workers. You know, it's over 6,000, and these are only the most extreme assaults that they're talking about. Everything from non-consensual touching and kissing to even sexual penetration or attempted penetration. And even more surprising is that about 45% of the assaults are actually being experienced by drivers.
Yeah.
So workers are incredibly vulnerable in the sharing economy.
I'm going to ask a question from the passenger side of this. Who bears the responsibility for verification that this driver is safe? Is it Uber, or is it, for instance, in New York City, none of these people can drive without a license to drive from the taxi commission? So is it the government?
Well, you know, regulation's not always the answer, but some regulation is definitely the answer when it comes to the gig economy. New York is a very different place where the drivers are held to the same requirements as the TLC drivers, as taxi cab drivers. But in most other places, that's not the case. And so we really need to see much more attention paid to the licensing of drivers, but also more attention paid to who is getting into the car, because again, the drivers are experiencing a lot of these risks.
And it's not just ride-sharing services, right? You pointed out in a note to us, if you think about any of the workers or employers in the sort of sharing economy, whether you're talking about people coming into your home to cook, people coming into your home to clean or do other, TaskRabbit people that you're hiring to do jobs around the house, that can also be dangerous. And is there recourse for people?
there really isn't any recourse. In my book, Hustling Gigs, Struggling and Surviving in the Sharing Economy, I have an entire chapter talking about the sexual risks experienced by workers. And yes, they're getting propositioned, they're getting sexually assaulted. There is no recourse for these workers. They can sometimes call the platform, but they're concerned that if they do so, they might get deactivated or viewed as a problem employee.
So if we compare, for example, drivers in the gig economy to taxi drivers, and how do those numbers compare, and is there data about that?
That's a great question. So taxi drivers have a barrier between them.
Not always.
If they don't have a barrier, they usually have cameras. And so there are more prevention tools.
Okay.
Exactly. So here in New York, if you now have a cab that doesn't have a barrier, it's because there's a camera monitoring. And many drivers do not have that type of protection. And even less so if they're a TaskRabbit going into someone's home.
I think people have been noting this is great that Uber is actually being transparent about all this information, because now we're kind of aware of how bad it can be for both the drivers and the riders, right? Do you think that more companies, especially gig economy companies, are going to kind of release a lot more data? Because this is stuff that they can kind of hold, and they don't need to do this.
Right. I'm hoping that they'll release more data. I think it will very much be a requirement for users to ask for this data. You know, we've seen this time and time again, that gig economy companies only respond to what their customers want, and the workers are secondary.
When they release this data, though, are they being so transparent that we can pinpoint which areas of the country might have a problem or not? Because we're assuming that the regulation protects people, but without knowing where these assaults and attacks are taking place, we can't be 100% sure.
That's a good question. Actually, it's interesting that we're talking about the transparency, because originally Uber was supposed to release information about over 20 different categories that would include things like propositioning and uncomfortable comments and even leering looks. And now they're only releasing the top 5 categories. So it suggests to me that the problem is actually even bigger and that they don't want people to know.
It would also suggest the rating system might have some flaws.
Exactly, yes. Well, and the workers that I talk to are very hesitant to report or even say anything to their passengers or their clients because they're going to get rated and ranked, and that affects their ability to get work in the future.
Wow. All right, Alexandria Ravenel, thank you so much. Appreciate it.
Thank you.
A bill explicitly banning insider trading is now heading to the United States Senate. This week, the House passed that bill with broad bipartisan support. Jessica Smith joins us from Washington with the details about this. And just people can already be prosecuted for insider trading. So how does this bill change things?
Well, I talked to Congressman Jim Himes. He is the lawmaker behind this bill, and I asked him that question. And he says right now cases are being prosecuted under anti-fraud provisions. And he says that's different than insider trading. He says it gets complicated when there is no explicit definition of what insider trading actually is. Right now, judges and prosecutors are relying on precedents set by the courts, and that can get messy. So this bill makes it clear that insider trading is illegal. He says that is when someone makes a trade based on non-public information that was wrongfully obtained. It also defines wrongfully. That means bribery, theft, espionage, breach of contract, etc. I asked the congressman how he came to find that balance of what is and is not insider trading. Let's watch.
It actually is a fairly complicated thing. You know, there are people, for example, who do things that are perfectly legal, like they might, you know, count the number of cars in a Walmart parking lot to try to come up with an estimate of you know, how Walmart is doing. That's obviously not illegal, and we don't want to go after people like that. But, you know, so the question is, has information been wrongfully obtained? And information can be wrongfully obtained because you pay an insider to give you that information, because you sort of stole it from somebody's network or whatever.
Only 13 lawmakers in the House voted against this bill. One of them was Congressman Thomas Massie of Kentucky. And in a statement to Yahoo Finance, he says he opposes this bill in part because of those anti-fraud provisions. He says this bill creates another definition of insider trading and opens the door for frivolous lawsuits. Now, Himes said he was pleased with the bipartisan support of the bill. He says working together on this created not a compromise bill, but a better bill. Now, as for what what its prospects are in the Senate. We will wait and see. I did touch base with the Senate Banking Committee to see if the chairman is going to consider this bill, but the chairman's office did not have a comment for us. Adam and Julie.
Well, we'll keep tracking it. Thank you, Jess. Appreciate that. Joining us, back with us, is Brian Cheung, who's following this closely also. So, Brian, this is something that's been sort of thrown around for quite some time now.
Yeah, and there have been many iterations of this bill, including from this congressman. So Jim Himes has, in previous Congresses, tried to pass something like this before. Insider trading has been a hot topic. It's not like in 2019 it's any more or less relevant than it was post-crisis or even pre-crisis. I think that the focus here, though, is that there seems to be some unanimous agreement among the House, because it was a 410 to 13 vote in the House to get this thing passed, that this does need to be addressed. The question is whether or not the Senate will take it. The problem is that there is no precedent right now. And everyone's kind of surprised to hear that. Insider trading is kind of associated to be one of those high-profile, white-collar crimes, but there actually is no law that actually defines what insider trading is. For the most part, it's been up to, as Jessica mentioned, the SEC and the courts to identify.
And we see differences. Stephen Cohen buying the Mets, SAC Capital. He never got convicted. He paid a $1.8 billion fine, but no conviction. Then you get Roger Rodnam, who went to jail. Is he still in jail? I think he might still be in jail.
Yeah, and this is the problem, is that the Supreme Court was this close to establishing a precedent that would have been the law of the entire land. In 2015, there was a case, the Newman case, Newman versus the United States, that went up to an appeals circuit, but then the Supreme Court decided not to take that case, which meant that we were deprived of the ability to have that Supreme Court standard over what does constitute insider trading, because here's where it gets kind of gray area, right? I mean, insider trading would be maybe perceived by most people to be something that allows someone to have an unfair advantage on a trade versus someone that does not have access to the same information. But what's the difference between unfair and theft, right? I mean, well, who's to say that the Walmart employee that gets to count the cars on the lots has more information than that person who's maybe trading Walmart stock who just has a portfolio with TD Ameritrade, right? I mean, not necessarily the case that you want to take that Walmart employee and throw them in jail for 10 years, but if an executive knows material information and then gives it to their friend or their family member to then trade on something that will be filed in an 8K at some point down the line, then that's more material, right? But how do you define what material is? And this is what lawmakers and courts have struggled with.
Isn't the big change now that you have to determine how the tippee got the information? If the tippee got the information incorrectly or kind of like fraudulently, then I, as the person receiving that, or I'm sorry, the tipper.
Tipper, yeah.
Tipper, yeah.
Well, and
as
also,
me, the tippee, I'm under kind of obligation to know how you got the information, right?
And also to what degree that person was aware that information may have been improperly collected. So this bill from Jim Himes basically says that you don't actually need to know that the information was wrongfully collected. If you did any effort to hide that information, or if you did any sort of effort to try to conceal that from law enforcement officials, then as long as they could trace it back at some point to someone who did indeed steal it, use espionage, bribery to get that information, then they could convict that individual.
Members of Congress are still allowed to insider trade, right?
No, Stock Act 2012, didn't they? They're not allowed to. I think
there was some sort of codification effort at that part, but I'm not exactly sure about the minutes.
President Obama signed it. It might have been amended since, but 2012.
At some point,
Obama
yes.
did sign it.
Okay.
And Roger Rodnam was released from prison this summer. He's got home confinement. As for Steve Cohen, $1.8 billion, no conviction, but I'll pay $1.8 billion for something I guess we didn't do. Coming up, don't give up just yet. Why one analyst says SoftBank may have the last laugh when it comes to WeWork. Plus, take a look at some of today's trending tickers on Yahoo Finance.
Welcome back to On the Move. I'm Jared Blickery. We got the major indices off only about 1% or less from their record highs. The S&P is just knocking on that door here. It's up 1%. We have the NASDAQ up 1% as well. Dow Industrials are outperforming, up 1.2%. This is the price action, and we built on gains over the last hour, only nominally, but still building on those gains there. Russell 2000 is worth looking at because it is at a 2019 high. Now, it broke out from this resistance level going back to earlier in the year last week, and now it builds on those gains, still about 5 or 6% off of its record highs. Let's take a look at the VIX because that is trending down, and we can see that we just violated the support, went down to about 11 recently, got that spike to 18. Watching for that, and it looks like the worst is over. Cross your fingers. Still have seasonality in December favors the bulls, but mainly from the 15th into the 31st. Got to check out the 10-year T-note yield. That is up 4 basis points. We can see you have this nascent trend intact though, but it's very gently sloping. We're going to take a look at some earnings. This is our earnings heat map. They reported after the bell yesterday or before the bell this morning. We got Zoom. That is off 10%, and it is right back down almost to where it started at the beginning of its trading career here in April. We also have, what am I looking for? PagerDuty, another in 2019 IPO. That hit record lows on the open. Those not doing too well. Also looking at CrowdSource, that is up 1%, and we will be back in a minute.
Well, dividend stocks can be a great income source for investors, but they don't come without risk. How do investors position themselves to make the most of dividends? John Burke is CEO at Burke Financial Strategies. He joins us now to break it down for us. And certainly in this low interest rate environment, dividend paying stocks have been attractive for a lot of people, right? Because they're looking for that yield. When you're looking for dividend payers, what are your important criteria? Are you looking for consistent growth? Are you looking for a high dividend, just full stop? What do you think?
Well, first of all, you look at the Treasury yield right now, 185. If you take the S&P 500 and strip out all the stocks that don't pay a dividend, the remaining group pays 3%. That's a pretty good comparison. So when we're looking to select stocks, what we want to do is find companies that have not only the ability to pay the dividend, but to grow the dividend. So if we can get 3% plus growth, that's terrific. So we're looking at free cash flow. That's the money that's available to pay out the dividend and to increase the dividend over time. So in free cash flow yield will be our favorite metric, and the market average is about 4. If you can get your portfolio to yield about 6% in free cash flow yield, you're going to be in good shape.
But you caution too, though, when you're looking at free cash flow, that a business could be cannibalizing itself and sacrificing its core in order to sustain the dividend.
Right, good point. So that's why we will not buy a company whose revenues are shrinking. So if you'll end up buying a company like Sears, which is very profitable, but the revenues kept shrinking, and of course, eventually they went out of business, or maybe even a Macy's. Here's another company with shrinking revenues. So you got to be careful there and look at the revenue trend. And you can't ask for 10% revenue growth and 6% free cash flow yield. You're not going to get it. But if you're going to ask for 6% free cash flow yield, you want to make sure you get some revenue growth.
Are these like the aristocrat type stocks here that kind of do well in good markets, but also will weather the storm in bad markets and still give you a nice yield?
Yeah, these stocks tend to hold up better in down markets, which make investors more likely to stick with their investments. The fourth quarter of last year, for example, the market was down 17%, and that universe that I just mentioned to you of dividend payers in the S&P 500 was down just over 10%. So that makes investors much more likely to stick with it and not to sell low.
Well, that volatility is a really important part of asset allocation, right? So if you can have lower volatility stocks, that's going to, help people stick to their asset allocation metrics, and it's certainly going to help overall returns.
Yeah, we would take that one step further and suggest to clients to say, okay, if the reason you buy bonds is because you want a lower volatility in a portfolio, well, if we can lower the portfolio in the stock portion of your portfolio, perhaps you can afford to have a lower allocation to bonds in the portfolio and make more money over time.
You gave us some example of dogs, Sears. I mean, Brian Sozzi has been doing that for a year. I'm curious, can you share with us an example of one or two stocks that would play into the kind of dividend yield and cash flow model that you've just described?
Yeah, so if you look at the healthcare sector, that right now is our favorite sector. It's underperformed this year. The healthcare sector is down, I guess, because of threats from Congress and also this perceived threat from Amazon. But the healthcare sector as a sector has a free cash flow yield of over 6%, and it's also a sector that does better in a down market. People need healthcare, good times and bad times, tends to hold up. So you get all kinds of names in the healthcare sector that have free cash flow yields above 6%.
What about the risks, the perceived risks that you mentioned, the competitive risk from Amazon and the legislative risk?
Well, there's no question that, look, anytime you're going to buy a stock, there are risks.
Risk.
Okay?
Yeah.
And if the sector, if what you're looking at is cheap, you have to understand the reason why it's cheap. The way we look at it is as the baby boomers in this country get older, they're going to be using more and more health care. So you're talking about revenue growth. We're going to get revenue growth and free cash flow yield. So this is our favorite sector and one that we would encourage investors to overweight in their portfolios.
John, thanks for being here. John Burke is CEO at Burke Financial Strategies. Appreciate it.
Thank you.
As we wrap up 2019, Yahoo Finance is taking a look backwards at the year and the 2010s overall. Today, we're going to look at the decade's most influential companies. They include Instagram, WeWork, Betterment, Venmo, Slack, Spotify. Want to talk about Enron? No, I don't think we want to include them. Yahoo Finance's Ethan Wolfman joins us now. And Ethan, okay, so what themes emerged as you were gathering this list? And no, Enron would have been before 2010. Yeah.
Enron before that. WeWork not. So I wonder if this is a surprise to anybody that I put this on there. But I think one of the big themes is this idea of leveraging the individual as a supplier, but also leveraging companies and real estate kind of in a similar fashion. WeWork doing something that was similar to Uber and Airbnb. So sort of like a further step from that, even though it was a failure. But I think the big theme of this past decade was figuring out how to build on top of this framework of connectivity that everyone now has. You have what was built on Verizon and AT&T providing this sort of network, plus Google, Apple, Samsung providing these phones for everyone to have, and how that changed our entire landscape. The companies now could build upon that and make new kind of cool, interesting things. I mean, Uber, Venmo, all of these sort of changes that are so fundamental to how we now live our lives. I think that was kind of the biggest theme that came from this.
So WeWork doesn't surprise me on this list. Betterment, though, does surprise me. What's the thinking behind that one?
Well, so having stuff like Betterment on here, these are sort of companies, Spotify as well, companies that changed their entire landscape because of Betterment, because of robo-advisors. You've seen all these incumbents following and having to change how they do their own business. It's changed, retirement and investing in a really profound way. And if you think about, to move on to Spotify, for example, the iTunes store really doesn't exist anymore in the same way. And that's sort of what the iTunes store did to CDs, Spotify has done. It's not necessarily they've won that space, but they've changed that space.
When you mentioned iTunes, I was thinking, how do I convert my MP4s into a playable format?
Remember that?
When you're looking at all of these, and when you talk about WeWork, didn't the model for that, though, shouldn't Starbucks, I realize it's not a 2010s, but I thought the whole impetus for this was that people were going to Starbucks to do their startup business because you got the free Wi-Fi, you had a cup of coffee, but they needed a place to congregate with their clients.
Well, so this idea that, a business might benefit from having a bit of flexibility and maybe paying more for that flexibility in terms of its own real estate to be able to farm out some of those costs. We've seen this through sort of incumbent companies like Microsoft and Amazon for their computing services with Azure, with Amazon Web Services. But this is something that we hadn't seen in physical spaces in the same way, although we had seen this demand for this flexible new kind of way for businesses to deal with their own real estate. The unit economics clearly do not work in the way that WeWork had. You cannot lose $1 billion a quarter. That just doesn't work. And but you might be able to have, as we've seen, certain individual locations being profitable. And so it's not impossible that this won't work in the future. You could easily see a use case that would make sense. Maybe not with a technology company valuation.
Right.
It worked for Adam Newman.
And there's actually
Sure did.
there actually is an analyst who's arguing it would work under certain conditions. We're going to talk about that later in the show. But for now, thank you very much, Ethan. Appreciate it. And coming up, better than booze, we'll talk to the woman behind the trendy new drink that is taking social media by storm. Plus, take a look at some of today's winners on Wall Street.
$12:34 in New York City, 3 hours into the trading day. Stocks are enjoying a good rally after that jobs report. We're going to hit that. Also, gold right now. Let's see what's happening with gold because it was trading down. It continues to decline, $1,466 an ounce and some change. Will SoftBank have the last laugh? Why one analyst thinks the company's bet on WeWork may not be as bad as it looks. Yeah, right. Replace booze, keep the bliss. We'll talk to the woman behind Kin Euphorics about just what's in the trendy new drinks. And what you pay for a banana and some duct tape. What would you pay? One person thought it was worth over $100,000. We'll peel away that story
I think
toward the
two
end of the
people,
roundup.
by the way. I think more
There
than
were
one
different
person sold.
versions of the banana.
Apparently.
Mhm.
We'll explain.
These are people who they have too much time on their hands. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for staying with us. Well, a step into euphoria. Dreamlight is what it's called. It's a nightlife beverage made from nootropics, adaptogens, and botanics. Kin is the company behind the drink, and its co-founder, Jen Batchelor, says it lifts the mind and relaxes the body. This Women in Money segment is brought to you by USAA, and Jen joins us now. Jen, thanks for being here.
Thanks for having me.
Adaptogens and nootropic. Tell us what all this stuff is. It's not alcohol.
It's not alcohol, no. So Kin was actually designed to deliver a feeling at the bar. It's the first non-alcoholic beverage that's actually functional. So you feel something from it. We designed it for folks that really just wanted an elevated experience at the bar without the consequences.
Didn't we used to just call that caffeine, though? I'm serious, like Jolt Cola.
No, it's a great point. It's a great point. Coffee, of course, has one of the most beautiful rituals, right? Of waking up, experiencing something, elevating your state, usually over a warm mug, right? You step into your day. That's what we want you to be able to do at night. You really don't want to reach for that extra latte after 6 p.m., right? So we wanted to create something that actually elevated your mood or helped you to relax after a long day. 25% of the people we spoke to that don't want to drink alcohol at the end of a night, but do want a little bit of help winding down and getting the best sleep of their life, want something different.
So there are some restaurants and bars that are serving your drinks based on Kin. I guess you call them like tinctures or
Euphorics.
Euphorics. What exactly is it? Like the adaptogens or stuff that actually are causing the mood enhancing effect? Is it just a botanical? What exactly is it?
Yeah, sure. So it's actually the trifecta of the
All mixed
three.
together, right?
All mixed together, yes. We looked at the synergistics behind how some of these ingredients affect the mind and the body. And of course, the mind-gut connection is very important when you talk about altering mood. We thought it was kind of strange that when you talk about drinking alcohol or the effects of alcohol, you're focused so much on the liver, but really mood enhancement comes from the brain and it comes from the endocrine system or the hormones, right? So adaptogenic herbs help to lower cortisol, nootropics help to nourish the mind and help you feel a little bit more cognitively together.
This stuff is not regulated, right? Is my understanding. I mean, it sort of falls into the nutritional supplement category. It
does, yeah.
And so how much research has actually been done on all of this stuff? And did you guys conduct research yourselves?
Of course, yeah. So every single ingredient in Kin has existed on the market for years. All of the ingredients from, we have passion flower in here, we have reishi mushroom, tryptophan, all of these ingredients have been tested. The FDA has a specific dosage that they recommend per drink, and that's sort of how we think about dosing with Kin. If somebody tells me, at the end of a long night, I'll have, maybe 2 ounces or a glass of whiskey. And so we'd say, okay, so with 2 ounces, that's pretty much our max dosage. And we recommend that to our customers as well.
My ears perked up when you said tested. I want to reiterate what you just said to make sure I heard you accurately. These herbal supplements have been tested? Because I know there's a lot of stuff on the market, doesn't necessarily, and it might have been there for years, doesn't necessarily mean it's safe or good for you. But so the products are tested and they have FDA approval?
So they're generally regarded as safe as the ingredients individually, right? And so we work with manufacturers that know how to bring all of these ingredients together to deliver safe and effective dosing for us.
How are these, euphorics different than like, say, kava?
Oh, well, they're in a very similar vein, right? Mm-hmm. A lot of them are plant-based. Kava happens to be a root. Instead of kava, which happens to have, for us, kava is a relaxant, but we prefer to have, a little bit more gentle ingredients like the passion flower that I mentioned or reishi that just synergizes a little bit better, we found, than kava, which can be quite potent, and it can taste quite bad as well. So really, it's just the perfect stack that we chose for Dreamlight requires different ingredients than kava, but it's one that may show up in a euphoric down the line.
And there are some other companies that are making this stuff now. I know there's one called Seedlip, which is sort of another non-alcoholic beverage. How big so if there are more entrants, that implies that there's more demand out there for this stuff. How big do you think the market could be? And how many, I don't know if you can tell us how many bottles of this stuff you've sold.
Yeah, I think the market potential is massive. We think about this, and I know you're saying it's a very trendy thing right now, and of course it is reaching the masses, but if you look at some of the research, the World Health Organization just announced drinkers over the last 10 years have actually declined by 10%. So when you're talking about a multi-trillion-dollar industry, that's a huge chunk. Where is that market share going? And that's what we were curious about as well.
All right, Jen, thanks for being here. Jen
Thanks for
Batchelor is
having me.
Kin Euphorics co-founder and CEO. Thanks for joining us for our weekly Women and Money segment.
Thanks, Julie.
Well, we are coming up on something, and that is have yourself a smelly little Christmas.
Oh, no.
KFC looks to liven up your holiday party with it's a wonderful smell if you like fried chicken. Plus, take a look at how cryptocurrencies are doing right now.
Let's take a look at some trending tickers from YahooFinance.com. Zoom is trading lower by 9% today. That's after the company's earnings report that on the face of it looked pretty darn good. The company reported a penny a share in profit, revenue growth of 85%. There might be some concern that the company's revenue growth is slowing. The growth last quarter was 96%. That could be responsible for the drop in the shares. As Jared pointed out earlier, the stock has come kind of full circle since its initial public offering. We're looking at Ulta Beauty as well, the chain of beauty stores. Now, you see those shares plunged earlier in the year after its last earnings report. The shares, though, are still up year to date, and today they're up by 13% after the earnings report. The company beat estimates on the earnings side because of selling higher margin cosmetics. And then there is DocuSign. These shares are up about 8% today. The digitized document signing platform, that company also coming in ahead of estimates and reporting billings forecast ahead of estimates as well. So those shares up by about 8%, and those shares are now up 88% year to date. And if you're following today's trending tickers, make sure you're watching the ticker. It's right here at 2 p.m. on Yahoo Finance. Edwards Lifesciences had an analyst day, investor day yesterday, and predicted sales next year will reach $4.5 to $5 billion. But the medical device maker has tried to avoid a growth at any cost mentality. Like a growing number of companies, Edwards is aiming to practice so-called stakeholder capitalism. Mike Mussallem, who's Edwards Lifesciences CEO, joins us now. He is also joined by Martin Whitaker, CEO of Just Capital, which ranks Edwards on its list of most just companies, which of course takes into account this idea of stakeholder capitalism. Thank you both for being here. Mike, I want to start with you. Your stock price, I should say, has done incredibly well this year. I know it's near record levels. And there has been in the past this sort of tension between performance and trying to behave justly, so to speak. So what kind of practices have you enacted to be a better company.
Yeah, well, thanks. We've been a publicly traded company. It'll be 20 years coming up just next year. And when we were born, we sort of put a multi-stakeholder model in place. We were born that way. And if we said, you know what, our work, if we do it right, it's going to benefit patients, it's going to benefit our customers, it's going to benefit our employees, and it's going to benefit our shareholders. And so we've kind of operated that way. It's been embedded in our culture and embedded in our strategy. And so this is actually the way we operated. It wasn't sort of a new happening for us. Yeah.
I'm going to read a quote. In 2020, we're projecting another year of double-digit top line and bottom line growth while we continue to aggressively pursue breakthrough therapies for millions of people. Is obviously the strategy that you use about multi-stakeholder is working, but that's a pretty big promise for people who are looking at this stock and looking at 2020.
Yeah, well, the good news is we have had double-digit growth for every year consecutively for more than 10 years. So this will be a continuation of the streak. So it's not really new for our shareholders. Obviously, that's a bigger deal as we get larger, but we are a very innovative company, and we've got a tremendous culture with a fantastic group of people, and so we've got a lot of confidence in our future.
So Martin, this is sort of a good poster child for you guys then if you're looking because of that performance that Edwards has seen.
That's exactly right. So as you know, we think that companies that look after all of their stakeholders, their employees, the communities where they operate, the environment, their customers, and of course their shareholders, we think they're better companies. Edwards Lifesciences epitomizes that. They're in our top 10. Mike walks the talk in all of this stuff and has done for a long time, but it's not a static thing, a continual improvement. They do well across all those things that we measure, and we, as you know, we try to let the data do the talking, right? We're all about just trying to bring an impartial measurement of actual stakeholder performance, and on all of those criteria, these guys are phenomenal.
Well, yeah, I was just going to say, you mentioned walk the talk. And I think particularly, for instance, when the Business Roundtable came out with its statement about stakeholder capitalism, for people who weren't familiar with it, there was a decent amount of skepticism.
Yep.
Especially at the current moment when there is skepticism about capitalism generally, right? So sort of explain to me, do you think companies are really committed to this right now, or do you think there is an element of performance in it for some companies?
I think the Business Roundtable statement was a marker. It said, if you're a CEO and you sign that statement, you basically said the purpose of my company is to create value for these different stakeholders, including shareholders. Behind that was a belief, I think by many, that this is not a zero-sum game. This is not, I look after my customers at the expense of my shareholders, that I can create a whole. I'm widening the aperture on what creates value. Now, companies are at very different levels of performance, as they are at different levels of financial performance across those stakeholder dimensions. That's our job to measure that. And I think what we like to do is to try and point out companies that are doing exceptionally well in those things to say, look, this doesn't have to come at the expense of shareholders. This is about investing in a long-term successful business.
Mike, you mentioned you've been doing this since your company was born. You ever get phone calls from company founders or CEOs of companies we might recognize, you don't have to share the name, about, okay, I need to change our formula right now and do what you're doing? And what do you share with them if you get those calls?
We're fortunate, and we've got a lot of friends who we're in an industry that works very closely together. But I can just say broadly, one of the things that's positive about what Just Capital and Martin's team does is to put the measurement in place. Even though we've sort of born that way and live it, we didn't measure it on every dimension, and we continually find opportunities to improve. And so this idea of actually measuring, we've got a competitive bunch that always tries to improve their performance. It puts us in a position to make ourselves better. So we've seen our own performance improve on these dimensions just by the fact that we're being measured. Yeah.
What are the one or two things that you think most exemplify stakeholder capitalism at Edwards? The specific practices.
For us, it's simple. It kind of starts with the patient. We have this very simple ethos that says, every day, every decision, everything we do, patient first, patient first. And if we do that, we're going to run a great company. It's not necessarily financials. For the financials have worked out very well, right? Do we make our customers happy? Sure, because it's our customer's customer. Does it fulfilling for employees? Do they want a job that makes them really feel great because they're doing something important for mankind? Yes. So that's what underpins it at our shop.
Right. Mike Musalem and Martin Whitaker, thank you very much for being here on The Move.
Thanks for having us.
Thank you.
Coming up, appealing artwork, the staggering amount someone or someone's just paid for this piece. Plus, take a look at some of today's losers on Wall Street. A Zoom video, as we just talked about, falling after its earnings.
So let's take a look at the top trending stories on Yahoo Finance right now. Health officials in California are warning consumers, do not eat romaine lettuce. The CDC reports more than 100 people in 23 states have now been infected with E. coli linked to romaine lettuce that was harvested in California. The CDC, along with the FDA, is investigating further to determine the source of contamination and if additional products might actually be linked to the outbreak. Employees from Ford are speaking up about the transmission scandal there. 7 current and former workers admitted that the company discouraged them from voicing their concern over the issues prior to the Ford Fiesta and Focus cars going on sale. The vehicles struck the auto company with $3 billion in warranty costs, along with mounting legal fees from thousands of lawsuits that are still playing out in court. It had to do with the transmissions. KFC is bringing back the fried chicken scented fire log. I'm not mad at that. It will be sold at Walmart for $18.99, and it's made of 100% recycled materials and burns for up to 3 hours. Can you get gravy with that? We'll be right back. Time for the buzzer beat around. 3 stories, 1 minute each. We will start with Facebook. They're expanding here in the Big Apple. The company reportedly in talks to set up shop in the Farley building in Midtown Manhattan. That's the old post office, by the way. The move would make this one of the largest corporate tenants in New York City, according to the Wall Street Journal. They're also putting in the new Penn Station in that building, but Facebook.
Well, when you come into that Penn Station now, it's really nice.
Yeah, as opposed to what it was.
I remember the first time I arrived in there and I was like, wait, where am I?
I mean, but what this story says to me is all of the hand-wringing and upsetness over Amazon not opening its big headquarters. Like, We're okay. We're okay in New York City, I think.
Someone else here, Google has a massive spread. Facebook everywhere, it seems, right? Silicon Valley,
Google's
east from
expanding
it,
too.
right? Yeah, and then the post office building is huge.
Yeah, I'm not sure we're so okay though, because I think the loss of the Amazon HQ2, and that was over in Long Island City, that was a big problem. There was an anti-business sentiment, that was the argument, against Amazon.
Well, I think there was definitely an anti-tax break for large, wealthy business sentiment. That's not necessarily the same thing as an anti-business sentiment.
All right, well, SoftBank have the last laugh when it comes to WeWork. A new report by analyst Chris Lane at Bernstein says SoftBank's massive investment could still pan out if it overhauls the startup's business plan. And Lane basically says WeWork needs to focus on getting enough occupancy in its existing properties, like fill up those spaces.
Okay, so I think this came up, WeWork came up the last time I was on with you guys. and one of the things I mentioned was that there's this maturity mismatch, right? Like they're borrowing long in order to buy these buildings and then leasing them short. So that's maturity mismatch remains. And also, even though we had great jobs data today, on a year-over-year basis, we were up 1.4%. And if you look at the beginning of the year, we were up 1.9%. So this business works really well in a long expansion. If we get a mild recession, it will probably also be okay as well if they rationalize their business. But if we get anything deeper,
I think Lane makes a good point. It's like the Starbucks of this whole office managed space kind of area. You have a good brand. You use the spaces effectively that you have. Don't grow too much, and you can make it work, and it could be a big payoff. We'll see.
We'll see. A piece by artist Maurizio Catalan titled The Comedian, which was featured at Art Basel, whatever you want to call it, it's in Miami, was just sold for $120,000. There's an expression, I can't say it, but WTF. And it's just a banana with duct tape.
What do you think, Pras? Are you going to buy one of these things?
I mean, the artist is actually a pretty wacky guy. He bought the banana at a local deli nearby and taped it. I mean, it just seems like a farce. Like it's almost like a joke, right?
The joke's on whoever bought it.
Well, it's sort of like...
We'll talk about loose liquidity conditions.
Yeah, I guess so. I mean, but this is not that uncommon in the art world, right? Where you get these sort of joke
ready-made
pieces. You brought up the toilet from Salvador Dali.
Or the Banksy that disappears.
That was great when what they spent, I forget, it was $1 million, and then as soon as the gavel came down, the self-destruct of the artwork.
Yeah, so there's this sort of self-referential
Does the banana,
aspect.
does it like spoil? Is it like preserved?
Of course.
No,
Yeah.
This is South Florida.
Formaldehyde, maybe. I don't know.
And how do you take that home? Do you untape it and then stick it back to the wall?
Or you make your own, right?
I don't know. Okay. Constance Hunter, thank you so much for being here. Great to see you, Pras. Thanks a lot. Appreciate it. As we take a last look at the markets on this rally day in the wake of the jobs report.
We appreciate your sticking through with us, but Wi-Fi PM is going to take you through the next hour of trading.
It is 1 p.m. in New York City, and all three major indices are surging today, with the S&P 500 erasing its losses for the week on the back of another strong jobs report. On tap for today, how the GM strike may have skewed the blowout jobs reading we got today, with the new hiring smashing expectations, why that could mean victory lap time for President Donald Trump and his punching bag, Fed Chair Jay Powell. Plus, a White House economic advisor, Larry Kudlow, fueling the risk-on rally with a positive update to U.S.-China trade talks, and the ad-supported free streaming service looking to give Netflix and Disney a run for their money. The CEO of free challenger Plex will join us to explain the strategy, as new data shows Martin Scorsese's The Irishman might be off to a weaker start than people expected. All that and more. This is Wi-Fi PM. Good afternoon, everybody. Happy Friday. I'm Zach Guzman, and joining me on Wi-Fi PM today is Yahoo Finance's Emily McCormick, along with Strictly Cookies CFO Courtney Comstock, back with us in studio. Guys, good to see you again.
You too. Happy Friday.
I know. What a way to wrap up the week here.
Yeah.
Green across the board when we look at the market action. The Dow up 344 points, by far the best day of trading this week we've seen. The S&P up as well, and the NASDAQ, as you can see there, up more than 1%. And a lot of that due to the latest jobs reading we just got, a strong jobs report for the state of the economy. The November jobs report smashing expectations. 266,000 jobs were added last month, beating economist estimates of 180,000. The unemployment rate ticked down to 3.5%, matching September's level for the lowest reading since 1969. Manufacturing, hospitality, and healthcare all saw strong gains last month as well. So joining us now for more reacts is American Action Forum's Director of Fiscal Policy, Gordon Gray. And Gordon, just want to get your first instant reaction to the strong jobs report, 2 consecutive months of topping expectations.
Yeah, absolutely. It was just a unabashedly strong report, a really nice report to sort of stick under the tree. The jobs number was double, essentially, what I had been predicting. So it certainly surprised to the upside. Certainly compared to the consensus forecast, it was just a really good report.
Gordon, what's your take on wage gains? Because we did see those tick a bit lower on a monthly basis, but did really beat expectations if we look at that year-over-year gain. What is really your take on that? Especially, we're staying ahead of inflation, but not really seeing a major acceleration on the wages side. So where do you think we're going?
Right. So certainly it's encouraging that we're starting to see, to the extent that there's some tightness in the labor market, we're starting to see that show up in the earnings of non-supervisory workers. So there's more blue-collar workers. You're starting to see those wage gains sort of exceed those of all workers. But you're right. I think there's some room to go there, and we would certainly like to see that number, the year-over-year gain, get over the 4% threshold. That's certainly what we would like to see. Though, when you take a step back and look at, for example, the Employment Cost Index, which is a more comprehensive measure of compensation for workers, it's sort of tracking what productivity is. So, that takes into account some of the other forms of compensation I think workers are increasingly more sensitive to. But you're right, we would like to see wage gains accelerate.
I saw something. I read your little blurb on the jobs numbers, and I had a question for you because one of the data points was really interesting, and it was that for blacks and for Hispanics, the unemployment rate has actually gone up, and for Asians, it's gone down 0.3%. I just thought that was. I've never seen somebody report on that before, so I thought that was interesting, and I don't know if you have a comment on that.
Right. Yeah, so we actually, those are figures that we track monthly. Those numbers do tend to jump around, usually a few tenths of a percentage point every month. And that's kind of what we're seeing. Every month there does tend to be a little bit of movement there. And none of the movement there really pointed to a particular trend, but you're right, those do bounce around, but we think it's important to comment on how the economy is affecting everybody.
Yeah.
Well, when we talk about how the economy is affecting everybody, consumer sentiment is one thing that people pay attention to. The University of Michigan's gauge of consumer sentiment for December rose higher this month with a preliminary reading of 99.2. That's well above November's final level of 96.8. And the consumer, Gordon, as you know, has been one of the points that people point to when we talk about the economy staying steady here. It's averaged 97 over the past 3 years, so a pretty impressive update we're getting here. Are you in the camp, I should say, of the idea that the U.S. consumer has stayed strong through all of this and is still holding up?
Well, clearly, the U.S. consumer is on the order of 70% of the economy, and when the labor market is as strong as it is, and of course we would definitely like to see higher wages and earnings for workers, but with 3.5% unemployment. I mean, the U6 number, that's the most expansive measure we have of unemployment, is at 6.9%. That's a 10th of percentage point off of its all-time low. I mean, this is just a really strong labor market. People are working. People are seeing some raises, and so clearly that's buoying the economy. So I am in that camp.
There were a couple interesting, I don't want to say devil's advocates out there, but a couple interesting points we got from some people. A couple of them, Pantheon noting that it's hard to square the leading indicators, all of which tanked in the late summer and early fall, with the strong numbers we're getting now. And then also Grant Thornton's chief economist Diane Swonk given the fact that the manufacturing sector actually appears to have lost jobs after adjusting for the return of GM striking workers and those laid off due to the problems that they had there. So, I mean, what do you read into that? Because a lot of the concerns that still exist when we think about the economy are over the trade talks and where things go on that front and how companies are thinking about reinvesting in their companies. So without that answered, what are your thoughts, at least in manufacturing?
So I definitely agree with that view. If you look at the industry breakout in the jobs numbers, to be sure, goods producing, added on the order of 50,000 jobs last month. But let's recall, we're now putting back those 40,000 GM workers that are back to work. And so when you net those out, it's about flat. And that's pretty good when you consider the disruption from the trade front. But the ISM index clearly showed that manufacturing is continuing to have distress. It's just the case that the U.S. economy doesn't have a high the concentration of workers isn't in manufacturing anymore. So it doesn't quite show up at the overall top line jobs numbers.
Well, we got that update today from Larry Kudlow on the China trade talk front. He was a little bit more optimistic than what we've been hearing lately. I want to just play a piece of his interview on CNBC this morning for what he had to say.
The deal is still close. It's probably even a wee bit closer than when I first made that statement in November. The reality is constructive talks, almost daily talks. We are, in fact, close. There's no arbitrary deadlines here, okay? There's no arbitrary deadlines. But the fact remains December 15th is a very important date with respect to a no-go or a go on tariffs.
So there you go, no arbitrary deadlines, but still very much a deadline to keep in mind here. And it comes as China said it's in the process of waiving retaliatory tariffs on imports of U.S. pork and soybeans. So, Gordon, I mean, you listen to that. Is that all signs in your mind pointing to positive updates on U.S.-China trade, or still concerns about that December 15th? Don't want to call it a deadline, but deadline.
Well, we know eventually China's going to need to buy soybeans and pork. Certainly they've gotten quite a bit. They've managed to shift some of their demand for soybeans to Brazil, but that can't persist forever. So they're going to need to satisfy that demand in their economy. So eventually they're going to need to find some kind of accommodation there. But let's also take a step back and recall that this doesn't get at sort of the totality of our disagreements with China on trade. It doesn't get at some of the new fronts that the administration seems to be embarking on to fight this trade war with Europe. So I am still one of those observers who's considering that trade remains, I think, a drag on economic growth.
All right, and we'll see what the latest jobs numbers might do for Fed thinking next week. But for now, seemingly strong showing and more support for holding steady here. But Gordon Gray, thank you so much. Appreciate you taking the time. All right,
Thank you.
Coming up, Uber releasing a troubling report documenting more than 3,000 sexual assaults allegedly committed during U.S. rides last year. Why it's also a problem for Lyft, with 19 women filing new lawsuits for those same issues as well, when Wi-Fi PM returns. Welcome back. In a new safety report, Uber is revealing the company has received over 3,000 reports of sexual assault related to its 1.3 billion rides in the United States last year. And Yahoo Finance's Alexis Keenan joins us now with the details of the report. I mean, that's troubling information, more than 3,000.
It is, and it's hard to contextualize these numbers, so we have that to grapple with, and I'm working feverishly to try to put it into context based on some of the national numbers, not quite there yet. Though this report is over a 2-year period. It's 2017 and 2018, so the number jumps up, of course, to almost 6,000, the actual number that Uber is reporting of sexual assaults. For those 2 years, 5,981 reported incidents, and of those, 464 are reported rapes, 587 are reported attempted rapes, 3,000 incidents of touching of a sexual body part, and approximately 2,000 incidents of reported kissing, non-consensual kissing incidents. So breaking out the sexual assault portion of that, there are also fatalities that are listed that are ride related. And this is just in the U.S., okay? This is not abroad. This report is just specifically to the U.S., both drivers and passengers we're talking about here. As far as fatalities are concerned, for those 2 years, there were a total of 107 fatalities. Some of those inside the vehicle, sometimes, pedestrians and people getting in and out of the vehicles. So this is a very comprehensive report, and Uber did not have to release this information right now. Uber and Lyft, both subject of litigation in the United States based on sexual assault claims. Lyft has quite a few, over 50 different plaintiffs are currently alleging that they are the victim of some sort of sexual assault in connection with a ride. Lyft has not released these numbers. We have asked repeatedly, and they have not yet responded to our request for, just a response to Uber's release of this information yesterday.
I'm wondering what this actually means for Uber's business, because of course we want that number to get down to zero, and we are seeing the stock off in the wake of this report today. But what more needs to be done? Because they do have that emergency button in-app. They do have ways to report this. Of course, sexual assault on the whole tends to be chronically underreported. So what should Uber be doing here?
Right. So if you ask the victims, and many of who stood up and put their name and their face on this yesterday in a lawsuit that was filed, another lawsuit against Lyft. There are 19 alleged victims in this case. They held a press conference. If you ask them, they say, we want live streaming video inside of these cars, and if the video is not activated, they do not want a driver to be able to pick up a passenger. Both companies have taken similar steps in order to boost up their safety protocols. However, they both yet do not do fingerprint-based background checks. They're name-based background checks. So that's just another step that they'd like to see these companies take so that they are more robust and that they more accurately reflect what a taxi service, for example, would do. Those would be fingerprint-based background checks.
Yeah, and it does seem, we were talking about this yesterday when Dara Khosrowshahi was saying that Uber is going to try and be more transparent, at least today. This being a proof of that, because they put this report out that they didn't need to expose.
They did not need to.
But it does highlight some of the issues. But you did kind of put that in context when we think about those issues, particularly the problems we're highlighting here on a minor fraction of total U.S. rides, 0.0002%.
Yes, so Uber does say, keep in mind that 99.9% of Uber rides happen without any safety incident at all. To try to look at just the national numbers of those reported sexual assaults for those who are over the age of 12 in the U.S., on average, it's 433,500 alleged victims. That's according to RAINN, the organization that supports victims of sexual assault and sexual violence.
All right, so highlighting a very important issue and one that both ride-sharing giants are trying to address in their own ways. But Alexis Keenan, thank you so much for bringing us that.
You're welcome.
All right, well, just after the break, new streaming statistics out for Netflix's The Irishman. We'll have how it did so far, and the new free ad-supported streaming service, betting it can take on paid options. The CEO of Plex joins us next to explain that. Wi-Fi PM is back in 2. Welcome back. Checking the market action we're seeing right now. Strong, a boost after that strong jobs report. We're seeing all three major indices in the green. The Dow up 350 points, and the NASDAQ, as you can see, they're up more than 1%. Well, viewing numbers are out for Netflix's The Irishman, and Nielsen reports during the first 5 days of its release, the Martin Scorsese mob film pulled in an average minute audience of roughly 13.2 million viewers, with a reach of over 17.1 million unique views domestically. And for comparison, Netflix's Bird Box scored nearly 26 million US views in its first week of availability. So those are all things to keep in mind here, guys, when we look at the kind of, it's always hard to put this in context, right? When we think about Netflix films, because it's so hard to dig through the numbers. But just based on that, maybe not as good as Bird Box.
My question is, do they count, do you have to finish the movie for it to count? Because I didn't finish the movie. I started
a lot of people
watching
didn't.
it. Do
That
I
was the other
count?
thing.
Or
You start it.
okay, if you started, it counts.
Well, so I believe with Nielsen, they actually take a longer view time into account. If we think of Netflix, it really is only a smaller portion of either an actual TV show or a feature-length film, or just a portion of an actual series. So that's why so many times when Netflix has these self-reported numbers, those are called into question. I mean, Bird Box being a good example of that is, you know, how many people actually finished this movie versus how many started it.
And it's a bit of an apples and oranges comparison. We're talking about 5 days versus 7 days.
Right.
The Irishman coming out over Thanksgiving, but nonetheless, 3.42 million per day when you average it out, compared to Bird Box's 3.71 million per day, would make you think that The Irishman perhaps off to a little bit rockier start. But I want to talk to a man who knows these numbers maybe better than I do, a person who is very connected to the idea of spending money on content to get people to watch. I'm going to bring in Plex CEO Keith Valery. Keith, Plex is obviously what you're here to talk about. You launched its own TV streaming service recently for free ad-supported streaming. Want to get your take on the idea of Netflix shelling out for a very expensive Martin Scorsese film that seemingly is off to a shaky start, I should say. What do you think of the initial numbers we're getting?
Well, they look good to me. Honestly, I have not watched the movie yet, so hopefully I'll get some time to do that this weekend. But I wouldn't be too bummed about that if I were them. It looks like pretty good numbers.
Yeah, you're right. I mean, Bird Box is already a success too. And obviously, that's why Netflix was flexing it. So maybe thinking that it could repeat the success of Bird Box right from the get-go might be too much to ask. Plus, it's also just a name that they want to boast here when we talk about what is actually on the cachet of Netflix. But also want to talk about the way that you're building up Plex right now to do something similar, because you guys have a lot of different titles on there, but you're going up against some extreme competition, not just Netflix, but Disney. And we're also looking at a new survey by ExpressVPN that finds that 23% of Disney Plus subscribers are very likely to unsubscribe from the platform within the next 6 months. Perhaps some of that might be due to the cost. And starting out with a free trial and then having to pay might make you want to cancel something. So what's your take on that and the idea of introducing a free streaming option like the one you have in Plex?
Yeah, so I'll start with those numbers from Disney. I also don't think they're too surprised by that. In this business, there is a lot of churn in all of these businesses, and my guess is their feeling is like, well, they're going to certainly be able to add more new users than they lose over time. And as people try these services out, sometimes it's a price issue, sometimes it's a content issue, but I wouldn't be too alarmed about those churn numbers if I were them. I think the content that they have, Disney's portfolio is amazing, and that price point is probably the best in the business. So I think Disney is in very good shape to compete for a long time in the so-called streaming wars. I think they're going to be just fine.
Yeah.
With Plex's new streaming service, you guys are ad-supported. What really informed that decision? Because we're seeing all these new streaming platforms coming out and being relatively cheaply priced, but mostly moving away from that ad-supported model.
Yep. Well, I think, we've seen with NBC and Peacock, there's a good chance that they're going to be including ads in their service. I think Hulu obviously has ads. I think over time, you're going to see more and more services that will include ads as we move away from cable into a pure OTT and streaming world, and that's going to take probably a decade for us to get there. But certainly, I also don't think that there's this kind of massive war going on between streaming subscription services and ad-supported services. I think both of those things can coexist. So over time, you're going to see both of those things coming together in a nice way. What we're trying to do at Plex, frankly, over time, is that the vision of our company is that you shouldn't have to go to a whole bunch of different apps to get the content you care about, right? So while this is a really important step for us, bringing in ad-supported content. Over time, you're going to see us bring in subscriptions into the platform as well, so that, and it's not our own subscription, but subscriptions for other services, so that again, you can kind of have your own continue watching can cover all of the content you care about, not just the content that's in the one app that you happen to be in at that one time.
It sounds
So,
like, I mean,
again,
it sounds like you're describing kind of a bundling there of services would kind of sound like cable, which is very interesting because we hear that all the time about all these things, seemingly cheaper alternatives to cable, but now what you're describing sounds like rebundling them all back together, and we've heard that joke a few times when we talk about the streaming space for sure.
Yeah.
I mean, is that where you think we're headed right now? And also having ads in between movies also again sounds like cable, though I know that your ad breaks are seemingly shorter than what you might expect from a movie being played on cable.
Right. Yeah. So I think the kind of the great unbundling, as it were, is absolutely in full swing. And if you kind of think about this as a share of wallet problem. So, you know, in the past with cable, you were spending whatever, $100, $120, $150 on cable. And now that money is being unbundled. Certainly people have, if you're looking at that share of wallet, there's plenty of, I'm seeing on screen, the different services. All of those put together are cheaper than you would pay on that cable. So the dollars are there and available, but certainly being able to bring in ad-supported content to fill in the blanks and to certainly address price points that are lower than that for certain individuals is going to be a part of the mix over time.
Yeah, so a growing size of the pie for everybody competing for it as well, and potentially also cheaper if you don't have to pay more than $100 million for films like The Irishman as well. But Keith Valerie, thank you so much for joining us. Plex, the name of the company. All right, well, since we're in the last month of the decade, let's take a look at some of the biggest corporate busts in the last 10 years. Emily, I know that you've been digging into that.
That's right. So Brian Sozzi and I compiled a list of 20 companies that went bankrupt, went out of business, are now defunct in the past 10 years. A lot of those, unsurprisingly, were retail names. So think of things like Sears, Bon-Ton, Wet Seal, some of these, stores that were very closely levered to malls and the rise of just sort of foot traffic, really seeing those go out of business over the past decade, just because of changes in shopping trends. A lot of times, a lot of these companies had been subject to a major leverage buyout by a private equity firm, were under mass amounts of debt, and ended up completely going under because of that. But really identified three major themes here. I mean, one was competition, of course, that exists for companies today as well. But then second was a failure to really respond to a lot of this competition and make the technological advances or pivots necessary to continue. And then a third of all was really that debt load. So those are some of the main characteristics we saw of these companies that failed.
Blockbuster being on that list, a perfect segue into what we were just talking about.
Oh, what a bummer.
Yeah, I know, but that's a perfect example of a company that didn't change.
Exactly. Yeah, and they should have, because Redbox came in first, and then Netflix, and then they were just toast.
Right, and Blockbuster actually had an opportunity to partner with Netflix back in 2000, right at the end of the dot-com bust. It was only like $50 million, would have really accelerated the business, but they turned that down, really focused on their brick and mortar locations, didn't make that pivot into the online space. And if we think about the rise of DVDs, that really enabled Netflix to get its start, because those were much more portable, could be mailed out as opposed to VHS cassettes. So just a lot of technological changes that we've seen over the past couple of decades that really has started to see this shift and this paring down of some old age companies.
Yeah. And Theranos on that list as well, in a league of its own for its own issues, perhaps outside of those. Also a very standout name on that. But we're talking about brands that died in the 2010s. And with that, I mean, there are a lot of questions about what might happen in the next decade. Maybe not companies that will follow suit and explode, but on the flip side, actually see some success in the next decade. It's a question worth asking. Who will be the fastest growing brands in the 2020s and beyond? And Morning Consult is out with a new ranking of just that. The data firm looked at the brands with the biggest jump in consumers saying they would consider buying from a specific company. Over the course of 2019, they looked at it at the beginning of the year and subtracted the difference now, and the fastest gaining brands were dominated by food and beverage, with food delivery company DoorDash taking the top spot. The SoftBank-backed startup has been in full-on growth at all cost mode and stealing share from its competitor Grubhub for most of the year, so maybe that's not all that surprising. But at number 2, White Claw is there, the millennial favorite hard seltzer. White Claw exploding on the scene in 2019. Another food delivery company, Postmates, in at number 3. Plant-based meat maker Impossible Foods and payment app Venmo rounding out the top 5 guys. I mean, all of those brands we talk about a lot. Surprising to you?
A little, I mean, not really, I guess, because they're none of them are retail, and so basically, like what you just said. But Venmo shocks me. What can you buy from Venmo?
Actually, I think Venmo and Cash App, both in that kind of fintech payment space, I think what we're really seeing is sort of this move for more frictionless transactions, peer-to-peer. You know, people, splitting rent bills, saying, hey, you ate, 5 of my strawberries, now Venmo me for that. But people really really break down their payments with their peers now. Splitting bills at restaurants, and it really makes it a lot more seamless.
It becomes kind of it's a verb. Venmo me for that, Uber here. When you're a verb, it's always a big deal, and it catches on very quickly, especially when we talk about the network effect. Once people are on Venmo and you need to interact with people. Strawberry is a weird thing to Venmo someone for, but I can see why that might make sense.
If you're really detail-oriented with your roommates, like how many of this?
But all of those are very strong when we talk about brands with younger users as well. White Claw specifically with millennials and DoorDash, I guess, as well. But the same report also ranked brands that had the highest jump in brand identification, where people said they were familiar with the brand, which mirrored roughly the same list we just showed you, with one noticeable exception. We're showing you that now. Vaping giant Juul Labs actually had the highest jump in brand identification, people saying they're familiar with what Juul is and what they do, but it did not correspond with a positive jump in favorability, mostly because the negative headlines of 2019.
Right, I think surprises me a lot because Juul seems so popular walking around the city. It's like everybody has their little Juul.
Yeah,
so
right.
I'm like, how is that? Maybe they've already experienced all their growth and now there's so many regulations coming in.
And all the negative aspects of vaping, all of that.
Well, another company that is now turned into a verb, you Juul.
Yep.
Yeah.
True. So we'll see what 2020 holds when we think about regulation regarding vaping. Of course, the CDC and the FDA constantly looking at that, as well as multiple state attorneys general as well. So who knows what is in store for Juul in 2020, but we will bring that to you come next year. But coming up, the House overwhelmingly passing a bill clarifying insider trader laws, why it was so necessary to clear that issue up in the first place, right after this. Welcome back. Lawmakers are tackling insider trading with the House of Representatives passing a new bill that explicitly defines and bans it, which is very important because this issue's come up quite a bit. And Yahoo Finance's Jessica Smith joins us now with the details. Jessica?
Well, right now, there is no specific insider trading statute, and that is the problem, according to Congressman Jim Himes, who is the lawmaker behind this bill. I talked to him today, and he said right now people are being prosecuted for insider trading based on anti-fraud provisions. And he says fraud and insider trading aren't exactly the same thing, but it's complicated when there is no explicit definition of insider trading. It leaves prosecutors to rely on previous court rulings. Let's watch.
You have a big body of court-made law. That's a problem in and of itself, right? If we're going to send people to jail, we ought to actually write specific laws about why that happens. But it also means that there's been all sorts of churn in the courts. Just in the last 5 years, there have been a number of decisions and convictions have been overturned. And so this was just a moment to say, look, this is a crime. Let's make it very clear that it's a crime because we write the law and just create some clarity out there.
So this bill makes it clear that someone cannot trade while they have material, non-public information that they're aware was obtained wrongfully. And the bill also goes on to define wrongfully. It's bribery, theft, espionage, breach of contract, etc. So that's how this insider trading is going to be defined going forward if this bill does become law. It did pass the House with broad bipartisan support. Only 13 lawmakers voted against it. One of those lawmakers was Congressman Thomas Massie of Kentucky. And in a statement to Yahoo Finance, he said he opposed the bill because insider trading is already illegal under those anti-fraud statutes. He says this bill creates another definition of insider trading and opens the door for frivolous lawsuits. Himes told me that he was pleased with the bipartisan support. He says it made it a better bill, not just a compromise bill, working across the aisle on this. Now it does move to the Senate. I did check in with the Senate Banking Committee to see if the chairman has plans to take it up, but the chairman's office did not have a comment for us. Zach.
All right, Jessica Smith from Washington, D.C. Thank you for bringing us that. Appreciate it. Next on Wi-Fi PM, the creator of the internet as we know it, calling for a new contract for the web to protect humanity from misusing our personal data. The CEO of the Web Foundation joins us to break down why Facebook and Google are already on board. We're back in 60 seconds. Good afternoon and welcome to Wi-Fi PM. I'm Zach Guzman, and joining me today is Yahoo Finance's Emily McCormick, along with Strictly Cookies CFO Courtney Comstock. And guys, it is a strong way to wrap up the week of trading we're seeing right now. Green across the board, the Dow up 342 points, the S&P up by about 31, and the NASDAQ up more than 1%. We'll see what happens later on in an afternoon of trading to wrap up the week. But right now, a very nice start on the Friday. Something else we're watching is a call to change the rules of the web. The inventor of the World Wide Web is calling for major changes on the internet. In the age of misinformation and bad actors lurking online, Tim Berners-Lee wrote an op-ed in the New York Times, which reads in part, quote, "We're at a tipping point. How we respond to this abuse will determine whether the web lives up to its potential as a global force for good or leads us into a digital dystopia." To join us now to discuss is Adrian Lovett, the CEO and president of the World Wide Web Foundation. And Adrian, you're the head of a nonprofit that was created by Tim Berners-Lee, and you advocate for an open web as a public good and a basic right. So what is the push behind changing some of these things to make the web assuredly a much more positive place?
Well, Zach, I think the place we're at right now is at a real crossroads. You know, on the one hand, we can see an incredibly exciting path for the World Wide Web, which is nurturing, that is creative, that is liberating, that it enables people to build businesses, to claim their basic rights, you know, all of the very best of the web that we've seen over the last 25 years or so. But there's another path that we're all more than familiar with, which is a much more dystopian, dark path where we have increasing numbers of data breaches, the further spread of disinformation and misinformation, further action by governments to shut down in different parts of the world parts of the web and to censor it. So all of those things, add up to, we think, a moment of opportunity. And what Tim Berners-Lee, as you say, has proposed is that there should be what we've called a contract for the web, something that recognizes that there are different interests, as a contract does. There are companies, there are governments, and there are all of us as citizens, and we all have a role and responsibility to ensuring that the web is maintained and hopefully even enhanced as a public good.
I mean, it's interesting to see this all play out, too, because we've heard from companies that have been supportive of change, and also your guys' specific contract for the web, which already has support from companies like Google, Facebook, Twitter, and Microsoft. And we've heard people like Mark Zuckerberg come out and say that there needs to be change, but there hasn't been any yet, no substantive change. So how does that actually happen? Because right now it just sounds like tech CEOs talking and feigning support for change, but not necessarily working with the government to get that done.
Well, I think that there's a number of stages to the process as we see it. First of all, we set out a year ago, in fact, a set of top-line principles that everyone could agree on: the right to privacy, the need for everyone to be able to access the web, and so on. Then, just in the last week or two, we've announced the full contract for the web, which has actually 76 different clauses. So there's a lot of very tangible requirements and commitments to be made by governments, by companies, and by citizens too. But the third stage, I think, is the one that really addresses your point. That's where it gets really serious, and that's the accountability phase. So over the coming months and the next year or two, we will see all of those who have endorsed and signed on to the contract, including those companies that you mentioned, being expected to report on their progress, to show us their homework, if you like, to report on where they're doing well and where they're not, and for that to be a very public process, so that people can judge for themselves who's taking those commitments very seriously and who perhaps are not doing so.
Adrian, I'm wondering, with some of the internet giants at the size that they are, things like Alphabet, Google, Facebook, would really breaking them up, as some politicians have called for, alleviate some of these concerns that you're talking about, or is that just putting a Band-Aid on some of these issues?
Well, our focus with the contract for the web is a little bit less on structure and more on substance. We're judging companies and governments too, actually, by the actions that they take. And of course, there are always going to be processes to look at the power of companies and normal, well-established processes around market power and so on. But our real focus with the contract for the web is to say, what are the outcomes we're looking for? And first and foremost, we want to see a web that brings out the best in humanity, and that can sound a little bit glib as a top-line comment, but it's also very much about boiling that down to companies and governments taking very concrete steps around privacy, around human rights assessments of the work that they do, and so on.
And how do you see this impacting countries like China, where, as you know, many newspapers are blocked online, even Google is blocked? Will it help that people in that country have access to news, or will it just make them aware that they're not getting news that's out there?
Well, I think the first stage is to try and put our own house in order. And, the web that we know in North America and in Europe and in many other parts of the world is a web that first and foremost was founded on a principle of openness, of a permissionless space, if you like. That's how Tim always talks about it. And we want to make that better. And I think as we do that, as we address some of the challenges that we all know are there with the internet as we experience it, that's then a better model for other parts of the world potentially to follow. So it's one step at a time. Let's get the web to be everything it really could be for business, for all of us as citizens. And then build from there.
I feel like we're there a little bit. I mean, you could argue that we're already at that point, right, Adrian, when we're getting to the point where now we're getting into the difficult questions to answer, and we're kind of seeing that play out with Mark Zuckerberg and his stance on political ads and repeatedly defending the right for politicians to present misinformation in ads and saying that they're not going to take that down. I feel like we're at the point now where we're getting into those tough questions. What's your take on the idea of Facebook continuously pushing the idea that politicians should have that right to free speech there to present this case to voters, and the thinking that maybe at some point the contract shouldn't be to protect citizens of the world and put the issue back on them to say what is right and wrong?
Well, I think on that specific point, I'm actually speaking to you from the UK, where, as you know, we have an election campaign on right now, and we at the Web Foundation, with a number of other organizations, have been clear that in this particular election, because of the risks to democracy from misinformation, that there should be a ban, at least a moratorium for the period of this election campaign on political ads. Now, that's not something that Facebook have agreed to at this stage. Google have taken some steps in the right direction. Twitter, as we know, have outright banned political advertising on their platform. But we are seeing some steps in the right direction. It's not a straightforward question, as we know, and we would be as clear as anyone that freedom of speech is a hugely important right to be protected. So it's not as black and white as being as saying, total ban or total free space. There's always going to be a complicated solution to be found, but we're determined to find it.
Yeah, don't be evil and move fast and break things. Sounds simple enough when you're starting out, maybe a little bit more complicated the bigger that you get. But Adrian Lovett, thank you so much for joining us. Appreciate it.
Thank you, Zach.
All right, well, after the break, there's a growing pie of money to be had when it comes to profiting off your music choices. And we're breaking down the top earning musicians of the year when Wi-Fi PM returns. Welcome back. Forbes is out with its highest paid musician of 2019 report, while Spotify unveiled the most streamed artist of the decade. And we're breaking down who's singing those high notes in this week's Fame and Fortune. Joining us now, as always, is Yahoo Finance's Alexandra Canal. And Alexandra, the anticipation is killing me. Which artist got paid the most in 2019?
I want to get your guesses first. What do you think?
I think it's
Taylor
Post
Swift.
Malone. Is Post Malone still listened to? I don't even know what top 40 is.
It's Taylor Swift,
Okay.
everybody.
Okay.
Yes, good job, Courtney. So Taylor Swift, she's the most paid artist of the decade. You're seeing that right on your screen. 180, I'm sorry, not the decade, the year. 185 million for 2019. That came from her new record deal, endorsements, the tail end of her tour. Kanye West right behind her there at 150 million due to a spike in Yeezy sales, actually.
Heyo.
And then we have Ed Sheeran, the Eagles, and Elton John of rounding out the top five. And a lot of that revenue came from a ton of gigs, performances, stadium tours. But this is an interesting list. If we compare it to last year, U2 actually topped the list last year, and they're not even on the top 5 this year, and it's nice to see a lady up there because there's not a lot of female representation in that top earning musician numbers.
Yeah,
Sure.
good tag.
Well, squaring up the data that we just got from Forbes and then with Spotify, is there a correlation between artists who are getting paid the most and the number of streams that they're getting? Because a lot of times, right, these artists have other business endeavors, they're touring, they're doing other things.
Yeah, because I guess Post Malone, but I feel like he did much better in the streaming data, maybe.
He did, and if we look at those streaming numbers, the number 1 person was Drake. And remember, this is over the past decade, so there's some artists on this list that really haven't been around recently, but Drake, obviously a big name, one of the most recognizable names in hip hop. Ed Sheeran, now he was on the top earning musicians of 2019 and also killing it in terms of streams. His song Shape of You was the most streamed song of the decade.
Yeah.
And then we have Eminem in at number 5. Now he hasn't done much recently, but obviously people are still listening to him today. I know I listen to him whenever I want to get my workout pump up on.
Wow.
So he's doing really well. So I was really happy to see him.
And Post Malone's in there, so clearly
And
I'm
yeah,
not.
you're not totally off.
No, I'm not totally off. I was pretty close. But I mean, when we're talking about touring, that has to be a big piece of it too. Then it's not just streaming when it comes to earning. It's also, as Emily's getting to, touring is a big.
Exactly. I think those big stadium tours, that's when you see a lot of people earning a lot, and that's why U2 topped the list last year because they had a giant tour. That's why Elton John was really high up on here as well because he had his farewell tour. So stadium tours, those are always big drivers in terms of revenue.
I mean, streaming, though, when we talk about it, everyone has their take on it. I tend to think that it's much better for those people, some of my friends even, who are kind of start-out musicians that are getting their start much easier because you can get found on those platforms as opposed to needing a studio label to put out a CD. In the olden days, just 5 years ago, 10 years ago.
Downloading it on the iPod.
But now, yeah, but Spotify just kind of changed the game when we're talking about streaming. How has that impacted the music industry overall when it comes down to artists making money?
Yeah, it's had a big impact, and this is something that we've seen recently. That's one of the reasons why Taylor Swift, a few years ago, she famously pulled all her songs off the Spotify app because of this debate over how much artists are getting paid. Beyonce and Jay-Z came out with a rival streaming competitor called Tidal, but then just yesterday, Jay-Z re-released his 444 album on Spotify after 2 years of not being on the platform. And he didn't really give a reason for this, but I think that's because this is unavoidable. Spotify has the market share here. About 36% of total US subscribers are on Spotify. That's followed by Apple and Amazon. So they're all gaining here, but Spotify is really where you want to be. And if you're a musician and you're not on this platform, you're really missing out on a lot of revenue. And how Spotify and Apple really divvy up this revenue, they use what's called a pro rata model, which means right holders are paid according to market share. So more streams equals more money. And this is a breakdown of how that's divvied up. You have your record label and your producers earning about 55 to 60% of that total pot. Then composers, lyricists get 10 to 15%, and the streaming service itself gets 30%. That's a lot of money. So if you're an artist, you're only seeing about 12 to 15%.
Yeah.
So it's really more tilted towards those bigger name artists and bands that have the resources behind them to really get a lot of streams there. And if you're an indie band, if you're one of the bands on those smaller scale, you're not going to see a lot of this money, and that's going to be an issue.
And perhaps not surprising to see all the artists wanting to get out there and tour as well to kind of make more money on that side if they're not getting it on the streaming side necessarily. But I'm also sad just because Spotify's year in review is going around and going viral right now, and as an Apple Music user, I don't even.
Oh, you don't have it.
It's big FOMO for me, so I don't want to talk about it.
No, it's all my friends have been talking about.
I know, it's very sad. Alexander Canal, thank you so much for bringing us that in Fame and Fortune. But coming up, dating app giant Tinder out with the biggest ways younger users have changed their dating profiles in 2019, why Gen Zers are leading the charge with emphasizing social causes they care about right after this. Well, Tinder is out with new data that takes a look back on how the dating game changed this year with its The Year in Swipe report, and the most terms used in Generation Z's Tinder bios, offering some interesting insights, including a love for words like real, lit, and stan. Gen Z also more likely to mention causes or missions than travel in their bios compared to millennials, who were 3 times more likely to talk about travel. So very interesting there, guys. I mean, I'm not necessarily sure that climate change or social justice maybe gets too many people peaked, but it's on Gen Z.
But it could start a lot of arguments, so maybe they're trying to preempt that. And
True, screening.
Right. Well, I think with dating apps on the whole, there's just more information being put on profiles. Like, people actually want to come across as like a well-rounded person, I think.
Yes.
Like, it is becoming less and less just about that initial swipe right, swipe left. I mean, of course, yes, that is still a main driver of it, but I think this push, like with things like Hinge, things like Bumble, boosting the amount of information you can put on your profiles to look like a 3-dimensional person.
It's a very important fact, and I think it may have come from the fact that Tinder is being pushed in that direction from a lot of different competitors as well. Also interesting to note the fastest growing emoji used on things was the facepalm out there as well on Tinder bios. So maybe a tough year for everybody. A lot of people using the facepalm on there. But Courtney Comstock and Emily McCormick, thank you guys so much for sticking around. Happy Friday to you. We'll wrap there. Don't go away, though, because we're headed to the New York Stock Exchange in 60 seconds time. All right, let's check in with Scott Gamm on the floor of the New York Stock Exchange. Scott?
Zach, thank you. I am joined now by Alan Valdez of Silver Bear Capital. Alan, good to see you. Market is surging on the heels of this jobs report. Is that your assessment?
Oh, without a doubt, the best numbers in half a century up there in the jobs number. And of course, even wages were up. So, I mean, overall, that was a great number. And it wasn't just because, Ford came back online. If you look at it right across the board, it really was transcended a lot of industries. So it was really a strong number.
Yeah, even without the impact from the ending of the GM strike, you still had some solid numbers. And then, of course, the 3-month average of job gains is now back above 200,000, 10 years after the recession.
Incredible, and this is with a government that's being besieged by impeachment talks, by the tariffs. So, I mean, it's really, can you imagine when the tariffs, and they will come to an end, and I don't know which way the impeachment goes, but I mean, the market's going to stay strong 2020.
And we're above 28,000 in the Dow, getting closer to your 30,000 target that you've had for quite some time. Is that more of a 2020 possibility at this point?
Yeah, it's getting close to I don't think we're going to make it by the new year, but I think by 2020 for sure we'll be there sometime in the early part of the year. You don't hear any more recession talk, you see.
So I guess would now be an opportune time to be putting new money to work, even though we're near record highs?
We are still putting money to work. A lot of overseas money's coming here because there's nowhere else for them to go. They see what's going on. I mean, we do a lot out of Germany, and Germany's basically in recession. So they're putting a lot of money here in the United States. A lot of these big insurance companies we deal with are putting it here in the United States. So a lot of money still is coming in at this time.
You mentioned trade earlier. Clearly we're waiting for that phase 1 deal, whether it happens this month or sometimes later. When do you see the deal coming?
Sooner than later. I do see it coming, probably early part of 2020. You could see it happen. I mean, I saw today some olive branches out of China coming across the tape. So I think you're going to see it pretty soon. And they need it just as much as we need it. So it's a two-way street here, and I do believe we're in a better position. We're a stronger economy now, and that definitely bodes well for the trade deal, too, when these jobs numbers came out. Because you think with the tariffs and everything, jobs numbers might be bad. Strong.
All right, Alan Valdez, thank you so much. As always, Zach, back to you.
All right, coming up, stocks climbing after that jobs report smashes expectations. Two experts break down the results next. The ticker starts at 2.
Good afternoon and welcome to The Ticker on Yahoo Finance. I'm Shauna Smith. Let's check in on the market action this Friday afternoon. We are seeing green across the screen with the Dow up 332 points. The biggest gainers in the Dow today, 3M and Goldman Sachs. Those two stocks up just around 3.5%. 3M actually almost up 4%. We're also seeing some gains here in American Express and JP Morgan. S&P and NASDAQ also firmly higher with the NASDAQ and the S&P both up just around 1%. Well, first, let's get to the big story of the day, and that is jobs. Now, the November jobs report crushed expectations. The U.S. economy added 266,000 jobs last month. That beat expectations of 180,000. Now, the unemployment rate ticked down to 3.5%, matching September's level for the lowest since 1969. In terms of sectors, manufacturing, hospitality, and healthcare all saw strong gains last month. Joining us now is Joe Song. He's U.S. economist at Bank of America. And we also have Calvin Schnurr. He's a senior vice president at Nareit. Thank you both for being here. Joe, let me start with you. A very, very strong report that we got this morning, handedly better than what we were expecting from economists. What does this tell you about where we are really in the markets right now and really just the overall U.S. economy?
Yeah, when you think the cycle might be turning, you got this really strong jobs number, right? 266,000. We knew that the number would be stronger because GM workers were returning to the factories. But even if you exclude that, you're looking at roughly plus 200K jobs created in November. In addition to that, you had the 10-month the net revisions to the last 2 months being positive, which means the momentum of job hiring activity was actually stronger heading into November. So all those things suggest that the economy is probably in a better spot than we thought heading into this November report.
Calvin, lots of talk just before this report, really over the last several months, that this bull market that we have been in right now is a little bit long in the tooth, fear that maybe it could be coming to an end sometime soon. When you take a look at this report, does this demonstrate that we're not, in fact, at all in the late cycle?
That's true. That's actually showing that we have quite a bit of room to run. This economy does not, outside of the jobs report, it does not show the types of excesses, the overbuilding or overheating that typically happen in a late cycle. But if you look inside the report, we were talking a minute ago about the unemployment rate. If you look at the discouraged workers, the people who are out of the labor force because they just can't find a good job, that has continued to decline as a percent of the labor force, but it's actually still above where it was at the end of the 2000 boom. So that suggests that the economy is still improving. We're not close to hitting a wall on this. We still have a lot of room to run.
Joe, the big question here is also what the Fed is going to do next. Or that meeting next week, when you take a look at these numbers, do you think that this is going to be an example or an opportunity for the Fed to say, hey, the U.S. economy and the current monetary policy right now is in a pretty good place?
I think they'll agree with that, but it doesn't necessarily change their view on the stance of policy moving forward. We expect them to stay on hold throughout 2020. They want to overheat the economy. They want to see better inflationary pressures, both in the labor market and in prices. And this is the way you get there, right? You get strong job numbers. You start to see the wage numbers pick up slightly and gradually, and that's exactly what you want. They want to have sustained gradual increases in wages that could potentially transfer into better inflationary pressure in the overall economy.
Kelvin, a big macro story that we have been watching, obviously, over the last several months has been the back and forth between the U.S. and China in regards to trade. Lots of fear that eventually the U.S. trade war with China is going to have some sort of effect on the U.S. economy. Eventually, does this report kind of show that maybe President Trump has the upper hand in these negotiations?
I'm not sure. This report does show that the trade wars are having an impact on the U.S. economy. If you look at the growth of total private employment compared to 12 months ago, it's up 1.6%. If you look at durable goods manufacturing, it's up less than 0.5%. That translates into a difference of 130. If you look at total manufacturing, it's 130,000 fewer manufacturing jobs than if manufacturing kept pace with the rest of the economy. We are seeing an impact from the trade wars, and that's hitting a lot of politically sensitive groups in the U.S.
Joe, what do you think the potential impact will be on the trade war in terms of jobs? We had Jeffrey Kleintop on the show yesterday, and he was basically saying that we could see job losses as a result of this trade war if something is not resolved soon. What do you think?
Yeah, it's very possible. If we think that if the next round of tariffs go into effect, that would have a chilling effect both on investment and hiring activity. But our view is that we will get some sort of phase one or a skinny deal down the road. I think one negative about today's jobs number is that it might mean that the negotiation go on for a little longer because, as you mentioned, it shows that the U.S. economy is doing a lot better than what we had previously thought. That might mean that President Trump is going to look for more concessions from the Chinese, which means that the negotiations could take a little longer and take a little steam out of the economy.
Calvin, when we look ahead to 2020, what are you expecting in terms of strength of the U.S. economy?
You know, as I mentioned earlier, you don't see the types of red flags that normally give an indication of a downturn. We're not seeing overbuilding. Our sector, the commercial real estate sector, is seeing a good balance between supply and demand and low vacancy rates. That suggests we're going to have moderate GDP growth. The real estate sector should do pretty well. There have been some concerns about real estate, but it's actually a well-balanced sector. I could see another economic year pretty much similar to what we had this past year, something around 2%, 1.5% to 2% growth. Not stellar, but good enough to keep moving forward.
Joe, do you agree with that? Do you expect to see maybe 1.5% to 2% growth next year?
Yeah, we're in the same camp. We just put out our year-ahead report. We're looking for 1.7% for 2020. We think that we're probably operating at trend growth by next year.
What do you think is the biggest thing or most important thing that the street is watching heading into 2020? Is it the trade talk? Is it the Fed? Is it something else that we haven't even mentioned yet?
2020 elections will be another key catalyst for next year. We also have a lot of near-term risks as well, right? There's a potential for a government shutdown. We're keeping an eye on the holiday shopping season. So all those things could trip up the economy and the markets. So I think there's some near-term risks that we have to keep an eye on.
All right, Joe Song and Calvin Schnurr, thanks so much for joining me today. Well, coming up, the aftershocks for Uber after it releases a passenger safety report with some stunning revelations. We've got the details next. Let's get to our first big three tickers of the day. We have Zoom tanking despite beating estimates for its latest quarterly results. Ulta Beauty is shining after delivering an unexpected surprise to investors. We also have Uber releasing an eye-opening report with details on its passenger safety. Well, first, let's start with Zoom. Now, shares are sinking today despite the video conferencing company beating on both the top and bottom line. Now, Zoom saw customer growth of 67% from a year ago. But it's important to point out that that was actually lower than last quarter's 78% growth. Dan Halley is with me. And Dan, when you go through this report, I mean, it was a strong beat, but it doesn't look like this is enough for the street. What was the street looking for that it didn't see in this report?
Yeah, you're right. This was a really strong earnings report for Zoom. They basically killed it across the board in terms of revenue as well as earnings. And if you look, their projections for the next quarter even beat as well. But the issue here is growth. Their user growth versus the prior quarter isn't as strong. So that's why we're seeing this or potentially why we're seeing this downturn in the stock. It looks like what Zoom is saying is that they want to focus on the customers they have right now to try to make them as happy as possible. That's all well and good, but it could just be the company's way of saying, look, we're not getting as many new users as we were, and so we want to kind of focus on the ones we have to make sure that they're happy and they don't flee. The big problem for Zoom, and this is something that should have been obvious from the get-go for a company like this, is that there is another company that does corporate communications already, and that's Microsoft with Skype. They do that regularly. You also have built-in communications with Microsoft's Office and its Teams software, which is already beating Slack as far as overall user strength. And then Slack can do its own form of video. So it's really strange that people jumped so heavily on Zoom, but they still could turn this around. Obviously, this doesn't mean that it's an end for the stock or for the company. It's just that maybe that user growth that people originally thought would be there won't be.
Yeah, Dan, that's interesting when you talk about the competition, because I was going through some of the analyst notes on the heels of the earnings report last night. And one thing that stuck out to me was just the fact that these results maybe could suggest the fact that Zoom is not deploying its capital as effectively as some of its competitors, like you just mentioned, like Microsoft and Slack. What do you think? Do you think Zoom needs to do more just in terms of differentiating its product from what else is out there right now?
I think that's really the key, and the issue is that something like Google, for instance, which offers video conferencing, or Microsoft, which again uses video conferencing, is that they have other pieces of software that feed directly into that video feature. So, for instance, you can jump directly from your Google Calendar to Google Chat, or from your Outlook calendar to your Skype or Teams chat. So it makes it more of a cohesive ecosystem. Adding another bit to that via Zoom might not necessarily be helpful for some businesses. For Zoom's part, they have to kind of copy almost that model that Microsoft and Google have. If not that, then figure out a way to differentiate themselves more so than just coming out and being the other video offering out there. I think if they can make themselves look more attractive and separate themselves from that idea that they're simply a video company, that would be really good for them.
All right, Dan Halley, thank you. Well, another earnings report that we are watching today, and that is Ulta. Now, shares are surging after the beauty retailer posted a strong full-year outlook. Same-store sales rose 3.1% during the quarter. Jared Blickery is with me. And Jared, when you take a look at the stock, shares are up just around 13% so far today. Are people cheering the result, or is it almost a relief rally that we're seeing in the market today?
Yeah, I think it's really relief. It was better than feared, and the numbers weren't that bad, and they did narrow their full-year guidance to an amount that was better than what the street hoped or thought would happen. Really better than feared is the name of the day here. They're having problems competing in what's called the prestige cosmetics line, and the makeup makes up 50% of their sales or thereabouts, and there's a lot of cost cutting, so their margins are under pressure a little bit. And because of the product cycle, probably not going to see this get better until about 2021. So another year, in other words, before things look up. And it's only 3 months since this disaster right here. They were down about 30% in one day. You can see they erased their full year gains. They had been up about 50%. And that was when they first drastically lowered their full year guidance. And so Wall Street didn't come into this report with very high expectations. And I think that's why we're seeing the relief rally here. But I should say up 10%, or excuse me, up 13% on the day. That's the best day in nearly 4 years.
Yeah, Jared, that drop that we saw was just around 30%. You're talking about the end of August, beginning of September. When we take a look at what they have done, maybe to reassure the street, what are some things that Ulta is doing to get the street back on its side?
Well, they were pretty vague in their conference call because of the troubles that they're going through in their makeup line and cosmetics. They said they're going to do some interesting things to get their investments up, to return capital to shareholders or to boost investments. It was just kind of bizarre how vague it was. So I don't think they have an exact plan right now. They're just kind of hoping for the best, reshuffling things. And in the meantime, the stock's probably going to remain under pressure here. We see the resistance level of about 270. Just about to climb out of this, but anytime you see a stock drop about 30%, it's broken. It has to base for a while. That's what it's done. But in order to get back above 315, 320, it's going to take a lot of impetus.
All right, Jared. Well, one thing, though, that Ulta has done right was their partnership with Kylie Jenner. That's gotten some people through its doors because of that. All right, Jared.
Can't go wrong there.
Thank you. All right, let's move on to another story today, and that is Uber's shocking report that was released. Now, the ride-hailing company releasing its first safety report with details surrounding sexual assaults, murders, and crashes. Over 3,000 sexual assaults were reported in the U.S. last year. Dan Roberts is here with me. And Dan, it was over 3,000 assaults, 9 murders, 58 people have been killed in crashes. What does this tell us about Uber's business, and where do they go from here?
Well, so these numbers are troubling out of context. I mean, they're troubling in any context, but let's just consider a few things. In terms of the percentage of Uber's rides, it's like 0.00000%. I mean, these are still rare when you look at the overall number of people who are taking frequent rides. And the spin from an Uber executive on this report is that the numbers are troubling, and the legal executive that was behind the report says that, but they reflect the larger society. So that's sort of the angle here. And, you know, look, Dara Khosrowshahi, who's the Uber CEO, and we know that he inherited a company that had a lot of cultural issues. This was pre-IPO, and he has received a lot of praise for fixing a lot at the company. He tweeted and said, doing the right thing means counting, confronting, and taking action to end sexual assault. Our work will never be done. In the long run, we will be a better company for taking this step today because I firmly believe companies who are open, accountable, and unafraid are ultimately the companies that succeed. So the idea being a little bit patting ourselves on the back for releasing these numbers, which the company didn't have to do and it hasn't done before. But still, the numbers are upsetting. As you said, 3,045 reported sexual assaults. And by the way, if you look at the past 2 years, it's 6,000 something. But it's hard to do an apples to apples comparison of this because that's usually people's first question is, well, doesn't this happen in yellow cabs? The closest thing is, you know, New York City gives the number of sexual assaults that happened on public transport in the last year, and that was 500 something. So the number in Uber rides was much higher, but we're also talking globally. Kind of hard to get an apples to apples comparison. So what does it really mean for the company? Well, look, I mean, we know that Uber and Lyft are dealing with these claims. We know that separately, 19 more women in the last couple weeks signed on to a class action lawsuit against Lyft for sexual assaults that happened in Lyft rides. Now, Lyft, the moment that the Uber report came out and said, we are working on our own report. We are preparing our own report.
So they're going to feel pressured in order to release a similar type of report.
Look, they both follow each other. Sometimes it's one leading, sometimes it's the other following. But I think that the two companies are kind of trying to spin this as transparency. We know this happens. We know it's bad. We're working on it, but we're being transparent.
Well, they're going to be pressured to, I think, even release more information going forward just because trust has been so critical with these companies. Both Uber and Lyft have, like you said, have each had kind of their own problems in the past. But going forward, they need to be able to win back, if they've lost some of it, customers' trust in order to be successful.
They do, although, you know, the cynic in me, and this isn't at all to lessen these stats and figures, but when you see this report, does it make you, Shauna, less likely to order an Uber car?
No, but it did make me think twice. I see what you're saying.
But yes, I mean, it matters. It's important. I would say, look, it's not the reason these companies have struggled since going public. At all. It's an additional thing. Issue, But we're talking about profitability here. I mean, that's what the company has to handle. But of course, it's all part and parcel of the same thing because if there are customers who, unlike you and me, do feel that they don't want to touch these services because of these reports, although again, side note, these horrible things can happen on the subway, they can happen in a yellow cab, they can happen on a bus, they can happen on a plane. If there are people who are not using Uber and Lyft for that reason, well, then it is a problem, and it does relate to profitability because they need to get more customers, they need to have loyalty, they need to be sticky, but they also got to start making money. My goodness.
They do. Well, yeah, that's a huge problem when they're going to turn a profit. All right, Dan Roberts, thank you. Well, coming up, why the trend of steady mortgage rates may soon be coming to an end. A top expert joins us with the details, and that's ahead. Welcome back to the ticker. Let's check in on the market. We are still seeing green across the screen with the Dow up over 300 points. S&P and NASDAQ also up just around 1%. Scott Gamm is standing by on the floor of the New York Stock Exchange. And Scott, 3M and Goldman Sachs are the two clear winners so far today.
In the Dow, Shauna, and you also have the Dow hanging above that 28,000 mark, not quite back at record highs, but certainly on its way. And yes, as you mentioned, 3M, Goldman Sachs, American Express, and Dow Inc. are the best performing stocks in the Dow. Now, all this comes amid optimism from this morning's better than expected jobs report, which really helped to calm fears of some of the mixed economic data we've been seeing over the past couple of months, especially out of the manufacturing sector. This was enough evidence to really say with authority that the economy is on strong footing, at least for right now. Also, take a look at some of the energy names within the Dow. Exxon and Chevron, those two stocks are up about 2% after OPEC has agreed to additional production cuts to the tune of 500,000 barrels per day. These cuts, of course, will expire in March, but OPEC at least increasing the intensity of the cuts. And so with that, you've got oil prices, at least for West Texas Intermediate, that's the U.S. benchmark for crude, crossing $59 a barrel today. It was just a few days ago at the start of the week that oil prices were just above $55 a barrel. Shauna.
All right, thanks so much, Scott. Well, straight ahead on the ticker, steady mortgage rates have been enticing new home buyers, but that may soon be about to change. We've got the details. Stay with us. Mortgage rates holding steady over the last week despite mixed economic signals during the holiday season. Now, the 30-year fixed rate mortgage averaging 3.68% during the week ending December 5th. This is according to Freddie Mac. Now, this comes as Freddie Mac's chief economist says that home buyer demand continues to grow, rising 8%. Joining us now to talk all things housing is Rogers Healy from the Rogers, Healy & Associates Real Estate. And Rogers, when you take a look at this, what's been happening in the housing market recently, what do you make of it?
It's pretty standard, right? And people tend to freak out this time of year because houses have been on the market longer or there's not as many buyers, but that's the seasonality of it. And the fact is, and you just mentioned it, our interest rates are still significantly under 4%, which is very, very positive. So yeah, you know, I'm very optimistic about the real estate market, not because I do it as a career, but just because I've studied it for a long time, and this is just normally how it goes.
In terms of refinancing, we talk about how rates are so low right now. Are we seeing a strong demand for refinancing still at this point?
You know, yes and no. Typically, the cycle of somebody living in a property before they go to sell is 3 to 5 years. Mm-hmm. So right now, what we're going to see, there's going to be a nice intersection with millennials and people in Gen X, which they never seem to talk about, wanting to go buy baby boomers properties, which means they might want to go and get out of something quicker than they normally would. So yeah, the refi boom always happens when you have a significant decrease in the rate, but it's not like we saw 5 or 6 years ago.
Is it a good time to buy right now?
It's always a good time to buy, right? And I heard this a long time ago that the definition of a good deal is a deal that makes you feel good. And it doesn't matter how many times you tell somebody that. Sometimes they want a deal that's just going to save them money. So historically, the fourth quarter and really November and December, that is when inventory has been sitting the longest, which means people can get relatively, you know, a quote unquote better deal on the price. So it's a good time to buy, and you couple that with low interest rates. Yeah, this is a great time to purchase property in our country.
Well, Roger, speaking of inventory, housing inventory fell to a record low of 3.9 month supply. It's running out. Why is this the case?
Well, I mean, yeah, I'd like to say that it's running out, but then I'd be selling myself out of a job. But, people are gung-ho, and no matter what happens, the American dream is always to go and own your own real estate. And I think what's going to continue to happen is people are going to want to go and own a bigger piece of real estate, which is going to give us, that much more security. So, yeah, low inventory is great, but what we're going to see happen, too, I think, in the first and second quarter of next year is rent rates have taken a really, really strong increase over the past 5 or 6 years, which has given people the inability to go save money. So I think that people are going to be moving more to the outside the urban core with rental properties, which will give them the affordability ability, in a year's time to go buy something, close to where they want to be.
So you're not at all concerned about the fact that the affordability issue, which has been keeping a lot of first-time home buyers on the sideline, that won't still be an issue going forward?
Yeah, I mean, it's a catch-22. You either go and rent in the coolest area, or you save money and you don't live in the coolest area, and then you eventually buy in the coolest area. So, it's got to be user preference. But millennials, and we keep talking about them, and we always forget about Gen X. I'm 39, right? I'm a Gen X. Millennials are turning 30 this year. There's over 5 million millennials turning 30, and a lot of people want to go and do something with their finances in a property, right? And with that being said, too, we've seen people get married at later ages these days, to where now, like someone like me, I'd buy a property for my dogs. So the factors are changing, but it still all revolves around the real estate market in our country, and that's going to always be the heartbeat of what's keeping us alive.
So overall, what's your outlook for 2020 as we head into the new year?
I think it's going to be interesting, and I'm still very gung-ho, and obviously this is what I do for a living, but I think any election year, people tend to go and sit on the sideline maybe a few steps back. And I think once they go and realize everything's going to be okay no matter who gets elected or reelected, that our market's going to stabilize again on the real estate side. But low interest rates are going to always drive first-time home buyers, and with rental rates increasing, that's going to make our sales cycle that much stronger.
All right, well, we'll leave it there. Rogers Healy, thank you so much for joining me.
Thanks for having me.
Well, coming up, the most influential companies of the decade. Details on Yahoo Finance's exclusive rankings. We've got that next. Welcome back to The Ticker. I'm Shauna Smith. Let's give you a quick recap of the tickers that we've covered in the show today. Our first was Zoom. Now it's tumbling in the wake of its third quarter results. It beat estimates on both the top and bottom line, but it's also reporting a slowdown in revenue growth, and that's what has the street a little bit concerned. You can see the stock off just around 9.5%. Our second ticker was Ulta Beauty. Now it's leaping after reporting unexpectedly strong results in the third quarter. Ulta says that sales were driven by notably good demand for its higher margin cosmetic products, and that stock up just over 13%. Our third ticker, Uber, it released a sweeping report on passenger safety in 2018. Now, among the findings, there were more than 3,000 sexual assaults during U.S. rides in 2018. For context, that's 0.0002% of Uber's total 1.3 billion rides in 2018. We just heard Dan Roberts telling us about that in the last block. Now, Uber also says that 9 people were murdered and 58 were killed in crashes in 2018. We're also checking in on the closing price of oil and taking a look at crude and where it is trading today. It's up slightly, up just over 1% at $59.19 a barrel. Now the jump in oil prices coming after OPEC and its allies officially agreeing to slash production by 500,000 barrels a day. This is in addition to its current reduction agreement, and that will, of course, begin in January. Now, we are just 3 weeks away from the end of the decade. Can you believe it? And with 2020 just around the corner, today we're going to break down some of the most companies from the last 10 years. Fill in that word that's missing.
innovative, influential.
There we go.
Whatever we want, we can use.
So what is the most innovative or influential?
Well, so if we think about the past decade, I think it's really hard to think about that and not think about kind of the big companies that were in play already that made an even bigger mark. I'm talking about Apple, Amazon, Facebook, all these sort of big players, Google, of course, that really tightened the vice in this decade. But also what happened, I think, is, besides these incumbents, they sort of built this layer of internet and connectivity that a bunch of other new companies built over. Like Uber, one of the tickers on this show,
yes,
we must remember, is a big example of that. When you put GPS and internet phone connectivity in the pockets of everybody, you can do all these really new, interesting things that really, I would say, have significantly changed our lives. We see this sort of in a myriad ways, from Spotify, having changed the entire, way that we consume music. Before Spotify, we used to own these, own songs, and that had this just kind of crazy effect through the industry. We've seen this in other industries as well. I put Betterment on there. Mm-hmm. That's changed the personal finance industry and investing in a very significant way, as a robo-advisor provides another alternative. And we've seen all these other companies follow suit in that same industry.
So Ethan, one of the names that stuck out to me when you just talk about the fact that it's all around mobile, or really just convenience, because a lot of these companies make everyday life a little bit more convenient. One of the names that stuck out to me was Peloton. And really, we've talked about the fact that boutique gyms now for quite some time have been so popular, but this is really one of the first companies that has been able to almost bring that concept into your own home.
Yeah, the thing that's so interesting about Peloton is adding all of these little elements of technology, from kind of having a community, having a device with a screen and easy sort of power measurements, allow this sort of scalability that we haven't seen before in the same way. Taking sort of the physical real estate locations of like a SoulCycle and bringing that to this platform in a kind of new way. I think we're going to see the future of exercise having a lot more of these things. We already have stuff like that Mirror. We have Zwift, which is kind of a thing for a bicycle trainer as well. All of these sort of technological advances, specifically driven by community. This is a sort of theme that we see through all of this. With e-commerce, largely by Instagram, which I think is probably the most influential, or one of the most influential new companies. That was 2010. Facebook bought them in 2012. That really changed everything in terms of how we consume actual goods, how we find the goods. The whole influencer culture really bloomed from Instagram, and now we're seeing ways to actually buy through Instagram. And so I think that, as well as sort of the communities and having relationships between consumer and brand that are far deeper and more meaningful than they used to be. There wasn't always an actual relationship in the first place. It was you buy something and that's it. Mm-hmm. But that's really changed.
And what's also interesting was when we were originally going through these companies before this show, so many of these you use in a day-to-day life that you almost think of before 10 years ago, what the heck was I doing?
It's hard to imagine.
It's hard. You have Spotify on here, Venmo, use that all the time, Lyft, Uber, Slack, Yahoo Finance uses that on a day-to-day basis. So.
I had a flip phone in 2010.
Yeah, me too. I know. You couldn't really take pictures as easy with the iPhone. I know. A lot of things. All right, Ethan Wolfman, thank you so much for breaking that down for us.
Thanks.
All right, well, coming up, Tesla is winning yet another major bullish call in the wake of its Cybertruck debut. We've got the details ahead.
Welcome back. Let's get to our next group of tickers. DocuSign is soaring as demand booms for its software. We also have Tesla getting another bullish call from one of the biggest banks on Wall Street after its debut of the Cybertruck. And Chipotle is scoring a major upgrade as it beefs up its digital platform. Well, first, let's get to DocuSign. Now, shares today are surging after beating earnings estimates on both the top and bottom line. You can see the stock up just around 8.5%. DocuSign saying that billings rose 36% in its third quarter. Dan Halley is back with me to break all this down. And Dan, when you take a look at DocuSign, what was the main driver in its results this quarter?
Yeah, it's not only just the idea that you can sign documents with legal backing behind it, but it's also that you're able to kind of do the entire workflow of a contract, and that's really the emphasis for the company. Basically, telling small, medium, large businesses that they're going to take the burden of doing paperwork off the table, let them do everything digitally, and then have access to paperwork all the time. And that's kind of really what's driving this company. It's interesting because you see fewer people using things like paper, or I don't know how often I've used a printer in the office. I can probably count it on my hand as many times as I've used it in the past year. But I think this is really kind of the main driver, is the convenience factor and the ability to constantly have access to documents that are important for small, medium, and large businesses.
Where does DocuSign go from here? Because in terms of its potential growth opportunity, how is the street evaluating that?
Yeah, I think that's really the question that is on everyone's mind, is what do you do after this, right? You already have the market cornered. Your chief competition is coming from Adobe, but really DocuSign is the go-to here. And, there are other services that allow you to capture images of objects or pieces of paper and then sign them. But, DocuSign is built into a bunch of different applications, giving you access to it. Adobe, on the other hand, it really needs to catch up to be at DocuSign's level. The adoption for it isn't the same, obviously. I think one of the things that DocuSign needs to do is improve the workflow overall of just handling paper, or not having to handle paper. And that's really where they're going to continue to move. That's the idea with their new contract workflow, where you can basically more or less automate working on contracts with companies like Salesforce, for instance. And that's essentially what they're going to continue to do with the company, is try to streamline as much as possible the process that paperwork used to entail and make it much more seamless for users.
Hey, Dan, what about international plans? Because one thing that stuck out to me, Wedbush analyst Dan Ives today, he has an overweight rating on the stock, but he was really pointing to the strength of its international business as one reason to be bullish on DocuSign.
Yeah, basically the idea is they're going to push outside of the U.S. and North American markets more, really grow that international space. And once they're able to do that, they could be the real, truly dominant e-signature company in the world. I think that's really where they want to go. That could be the answer to where they go next. But I think as far as the technology goes itself, it needs to give us more of a balanced workflow, or more of a seamless workflow, getting from paper to digital, or just eliminating paper altogether. That's one of the things that they like to point out, is they completely eliminate paper from the equation. So they like to market the fact that they save trees and water.
All right, we'll leave it there. Dan Halley, thank you. Well, next up, a very bullish call on Tesla. Now, shares are in the green today after Morgan Stanley raised its bullish case on the stock to $500 a share. But to get there, analyst Adam Jonas says that the Cybertruck needs to become a success. And then he also mentioned the fact that sales in China have to pick up pace. Dan Roberts is back with me. And Dan, he's very bullish in his bull case scenario, saying that it could reach $500 a share, but he's not saying buy right now, because I guess that's because Tesla probably has a lot to do in order to get there.
Well, so he's not saying right now, but he is saying more shorter term than long term. I thought this was really interesting. This analyst, who is known to be a big Tesla bull, one of the earliest Tesla bulls, which means already you have to take this bullish note with a grain of salt. And then he clarifies, to be clear, we are not bullish on Tesla longer term, especially as over time we believe Tesla could be perceived by the market more and more like a traditional auto OEM. That to me was very interesting. That is original equipment manufacturer, meaning not very sexy, the companies that have been around forever that everyone knows, the auto names. And that's fascinating to me, because I think we are seeing that, whether you want to give credit for Tesla as being the biggest trailblazer in EVs, the other guys are coming. And the other guys are all working on their own EVs, and the other guys have much more experience, years of knowing how to manufacture cars. That, to me, is the interesting Tesla push and pull right now. Yes, you still have the big bulls who are obsessed with Tesla and Elon Musk. They worship at the cult of Musk. But, if you are a regular person who's not an Elon Musk or Tesla fanboy, and you decide that you're interested in a luxury electric vehicle, in just a couple years, soon enough, Tesla's not going to be the only hot option. I mean, BMW is going to have one, and Mercedes and all these different companies are going to have an EV. So that will be a headwind for Tesla eventually. Now, this bullish note also highlights the Gigafactory in China, as you said. So they think things are going to go well with that. Cybertruck, another thing that is mentioned in this note. But that has also been a little bit of something that has been pulled apart since the initial reports. Elon Musk tweeted out and said we have 250,000 pre-orders for the Cybertruck. Well, guess what a pre-order is? A $100 refundable deposit. That means nothing. That doesn't mean that person is going to buy one, obligated to buy one.
Well, and also they could run into the same problems with the Cybertruck as they did with the Model 3. They had so many production issues, delays. People were waiting years to get their hands on their vehicles. So there is a possibility that that could happen again with the Cybertruck.
Right. You want to put down $100 on a truck that doesn't come out till 2021. By the way, we were showing some of the B-roll from the infamous demo where he said, let's shoot a metal ball bearing at the windows and it won't crack. Oh, it cracked.
And he threw it.
But then he said, well, it didn't go through, at least. But man, I encourage viewers to watch the video with the original audio because you hear loudly Elon Musk's uncut verbal reaction. And so clearly he did not expect this. I think there's got to be a significant number of people who put down the $100 deposit because that's kind of fun. Oh, look, I put a deposit on the Cybertruck. It's $100. So there are even some outlets, not Yahoo Finance, that have come out and said, we're not going to call these pre-orders. Because the term pre-order is just too generous.
Well, and he's doing something that he has been successful in doing in the past. It's all just to generate hype. So you generate all this hype about these new vehicles. You only make people put down $100. You're going to get a lot more people signing up for a potential Cybertruck, a lot more people talking about it, which in the end, there's question marks because we don't really know materially what this could mean.
Yeah, and this note says, okay, let's assume that it sells 100,000, which is still fewer than the number that Musk has said pre-ordered. At 50,000 bucks a pop on average, that's a significant infusion of capital. So that would be a bull case, but I don't know, even if they sold 50,000 of these things, I think people would and should be impressed. Oh, look, here's video where it doesn't break. Okay, maybe they brought it back to the lab. But I will say, because we've spent most of this segment saying the but on the other hand, I will say Tesla has really bounced back this year from May or so when it dropped like crazy. Now for the year, it's up 8%. But man, it had dropped down off a cliff in like May and June.
It had. We had the 3-month chart up not too long ago.
It has in the end
year to date.
salvaged
It shows it shows salvaging its year. But over the last 3 months, the stock has climbed almost 50%. Ooh. Perspective. All right, Dan Roberts.
500 would be quite a bull case.
It will be, yes. All right, moving on here, another company that we love to talk about in the ticker, and that's Chipotle. Credit Suisse maintaining its outperform rating on the stock, noting that the fast food chain has a, quote, strong runway for growth to return to peak levels. It's also confident that Chipotle's delivery and digital strategies will actually pay off for the company. Jared Blickery is back with me. And Jared, what do you make of this bull case scenario for Chipotle? Do you agree with it?
Well, you can't argue with the stock. We can take a look at the chart and show it's one of the best performers, if not the best performer in the S&P 500. This is today's price action. Here we are year to date, up 91%, close to record highs. Now, the case for Credit Suisse here is that same-store sales should continue to improve, and that's really a function of digital and delivery. That's about 80% of that growth right there. They're also getting their act together with respect to their second make lines. Now, if you go into a Chipotle, the first line you see is they make your burrito or whatever you're having in front of you, and it's not prone to errors. However, they have a second line in a lot of restaurants where they have to read the tiny receipts, and they had some initial problems with that. But they're working through that right now. And separately, Bloomberg is out with an interesting analysis of 2020 and 2021. Next year, they have significant labor increases, labor cost increases. That's because minimum wages are rising in 23 states, plus Washington, D.C., especially in California and New York here, where there's a heavy concentration. But they say Chipotle is one of the better positioned restaurants to get over that hump.
Jared, how key do you think menu innovation and technology will be going forward? Because Chipotle has done a lot, like you were just saying, in order to separate itself from some of the competition, but now a lot of its competitors are doing the exact same thing.
Yeah, you look at McDonald's, practically a tech company, right? They've made some high-profile acquisitions, and it's all about using big data and artificial intelligence to suggest menu items and complementary menu items, and also be able to decode speech. So there's tons of technology involved here, and this is really where the growth of digital sales is. Like I said, 80% of their growth now is in digital, so that's really where we're headed. Now, if the economy rolls over, that's also going to mean that these restaurants are going to take the biggest hit, because as soon as consumers retrench, they're going to be making a lot more food at home, and they're going to be cutting costs and probably not paying for these delivery options.
All right, Jared Blickery, thank you. Well, straight ahead, how a new startup is firing a major shot at the women's lingerie industry and taking on giants like Victoria's Secret. We'll talk to their co-CEO. They join us next. A lingerie startup taking aim at Victoria's Secret. Now, Harper Wilde is a direct-to-consumer bra company that is looking to disrupt the intimate apparel industry. The business even has the help of a former Victoria's Secret CEO. Joining us now is Jane Fisher. She's a co-founder and co-CEO of Harper Wilde. And Jane, I first want to ask you just to zoom out a little bit. When you created this company, why did you see an opportunity here?
Yeah, my co-founder and I were at business school. We weren't in the bra industry beforehand, but we were looking at the market dynamics, not only within lingerie in particular, but more broadly within retail. And there was this huge paradigm shift underway to simplicity and just core products. And what we noticed was there was a cool millennial brand out there for every commodity product, from razor blades to mattresses in your life, but not for bras. And Victoria's Secret really dominated the market, and we didn't think that that brand really resonated with the modern consumer.
So right now, though, there are some other startups that have been gaining some traction. You have Third Love, Lively, there's also Everlane. So how does your company differentiate from what's also out there in terms of direct to consumer?
Yeah, when we started, there were all those companies out there, and we still thought that there was an opportunity for us to enter. And really where we saw the place to enter was across a number of different areas, primarily price. So women are super price sensitive on this product. It's kind of like your razor blade. No one walks up to you and says, hey, that's a nice shave, where'd you get your razor? It just really needs to function properly, so women don't want to spend a lot of money on it. So we're half the price of a lot of our competitors with an exceptional quality bra. And then secondly is really, really simple options. Same as razor blades. When you walk into the CVS aisle, you don't want to be faced with all those options. Same with bras. Simple options, and then really, really seamless online experience.
How are you able to keep the costs so much lower than a lot of your competitors?
So a lot of different bra companies put embellishments on the bras, and what we did was we surveyed and talked to hundreds and hundreds of women, and we invested in things that they really care about, like the softness of the fabric and the cups. Our straps adjust from the front, but we didn't put any money towards the stuff she doesn't care about, like any of those added rhinestones or the hardware being gold or anything special like that.
Direct to consumer right now is how your product is sold. Do you have any plans to
go beyond that, maybe be available in some department stores or even open your own brick and mortar store?
Yeah, we've talked about it. We really look to our consumers and see what is the way that they want to purchase today, what is the simplest option for them. So we're exploring a number of different ideas on how to offer them an easier way to buy their bras.
What kind of growth are you seeing in your business right now?
We've seen over 300% growth this year. So we saw, a pretty exciting year, and we're looking ahead with a bunch of different product expansions next year to see even more growth.
And how are you getting your name out there? Is it all social media based? I know you have a pretty strong presence on Instagram, or are you also allocating some of their money there in terms of Third Love, one of your competitors, tends to send out flyers?
We allocate our marketing spend across a number of different channels, from direct mail, we do Facebook ads, podcast advertising. Really, we're reaching customers in a number of different ways. We see one of the most organic virality aspects of our business is the brand and the humorous aspect to it. So we recently got funding from CAA, the talent agency, and that's kind of a strategic move on our part to think about how to spread the brand in a more organic way.
And a member of your board is the former CEO of Victoria's Secret, Sharon Turney. When you're deciding who you're going to have on your board, what kind of experience or what does she bring to your company that has really helped you in terms of planning for future growth?
Yeah, Sharon is just, she is amazing. She covers so many different aspects. I mean, we look for help in every functional division. So we have someone who helps with finances, someone who helps on the PR front, and she has such specific retail experience, as you can imagine, and she helps from everything from, she works at the same factory that we are working with, so she helps us think through how to work with them better, all the way down to the technical designs of our products, to thinking bigger about what's the long-term strategy for the company.
All right. Well, Jane Fisher, thank you so much for joining me today.
Thank you.
Well, coming up, how KFC is bringing finger-licking good to your fireplace just in time for the holidays. We'll have the details of what we're talking about. That's next. Well, it's time for our last tick of the day, and it's Amazon. Oppenheimer lowering its margin estimates for the e-commerce giant, saying that the firm is now saying that Amazon Web Services, that's AWS, faces increasing competition from Microsoft and Google. Yahoo Finance's Dan Halley, Jared Blickery, and Dan Roberts are all back with me to weigh in. And Halley, I'm going to start with you here. Now, one of the things that Oppenheimer pointed out was the fact that they're saying that Amazon is misjudging its competitors. What do you think they mean here?
I think basically they realized that they were the big dog, Amazon, and so they didn't really pay any heed to what Microsoft or Google might have been doing on their own. Now, it is worth pointing out that while we talk about Microsoft and Microsoft's Azure and Google and its cloud capabilities, they are still way, way, way down the totem pole as far as size when it comes to the cloud. Amazon just outstrips everyone. But that being said, Amazon's market share is slowly being eroded by Microsoft and Google, as well as Alibaba. So they really need to just kind of understand where their competition is coming from. And it seems like, at least according to Oppenheimer, they haven't been doing that.
Dan, one of the things that stuck out to me in this note was the fact that the analyst said that one day they believe AWS will be spun out from the company. What do you make of that?
Yeah, that is by no means a widely held consensus, and Amazon has not really historically spun out basically anything. I think there's still a lot of room to run here, so maybe that happens eventually, but that would certainly be a huge divestment. That's something that I would see Amazon doing kind of only if it has to. Now, of course, there are sort of legal and regulatory conversations around Amazon's size, and every couple of years people start to complain and they say, what about antitrust laws? But if you understand how the antitrust works, that's not an issue for Amazon right now. It's not about how many different businesses you're in, it's about competitive pricing. So maybe if Amazon were forced to, but for now, even with Azure and Google Cloud really growing and being big competitors, I think Amazon Cloud, AWS, can still grow a huge amount. So it would take a while for them to want to sell that off.
Jared, what do you think the street's reaction would be if Amazon eventually did decide to spin off AWS?
Ooh, that stock would take a hit because think about it, AWS is a profit center, and that allows Amazon to operate their other businesses, not the least of which is Whole Foods, on a loss leader basis. So without that, Amazon is just toast. I don't see them getting rid of it.
All right, we'll leave it there, guys. Time for our last, or we're going to go beyond the ticker to KFC. Now, the fast food chain is selling fire logs that smell like fried chicken. They're available at Walmart for $18.99 each. Dan Roberts, KFC did this last year, too. It actually sold out.
Sure.
That was a little bit surprising to me. What is there? Is there demand? I guess there is.
I think absolutely. Look, I have a fireplace in my home. We love making a fire. I would be interested in burning one of these. Yes, I'd be interested, but really only for the novelty of it. I think just like all the crazy new food inventions, they sell for the novelty effect. It's a gimmick that everyone wants to try once.
Dan, Dan Howley, do you think that this pays off for KFC just in terms of getting their name out there, kind of sparking some conversation revolving, I guess, one of their new products?
Yeah, I absolutely do. This is the exact kind of routine that Domino's uses when they went out and they were paving potholes a while ago with their truck, or they go out and they have a robot that runs around delivering pizzas. It's all a marketing scheme. That being said, if I started a fire with this, I would go out and buy fried chicken. So I think they kind of, got a good idea going.
Jared, would you ever think of maybe buying one at some point?
I'll give you one guess there. I think you've asked me enough of these questions before. I would make fun of somebody in line.
So is that a no?
That's a no. Come on.
Come on. Dan Roberts, Hallie, you said maybe.
I love the smell of fried chicken as long as I can eat it.
All right. Well, all right. Well, we'll leave it there. I don't know. I think I would give it a try. I just wouldn't want it to linger around in the house. All right. Dan Roberts, Dan Howley, Jared Flickery, thank you so much for joining the show today. Let's take one more look at the markets before we let you go. The Dow is up 340 points. S&P also posting gains, with the S&P and the Nasdaq up just around 1%. So stay tuned right here on Yahoo Finance. The final round is next.
I'm Jen Rogers in New York, and this is the final round. Stocks soaring here with the Dow back above 28,000 following a blowout jobs report.
I'm Miles Sutherland. The economy adding 266,000 jobs last month. The unemployment rate back to 3.5%, matching a 50-year low. We'll have more on that in the market reaction coming up in just a bit.
Plus, Wall Street getting bullish on Tesla. It's our call of the day. And how does today's jobs number affect the Fed ahead of next week's big policy meeting? TD Securities. Priya Misra. I had it in my head that I was going to say it wrong, and then
that's what happens.
Guy sitting next to me, I say it wrong.
It's my read. You've got
Plus, Rick Newman grades the week that was for Trump with your Trumpometer score. You're not going to want to miss that. Stocks holding on to gains right now with all the major averages up at least 1%. Check out the Dow above 28,000 right now. This is jobs. This is all jobs here. NASDAQ also on pace right now to be a little bit flat for the week. S&P 500, Russell 2000 on track for some slight gains. Mm-hmm. You were here when the number broke.
Sitting right over there.
And when that print happened, This is 25% above even the top estimates that we were getting.
Yep.
So this is not a small number. You cannot just push this aside and try and find some, the average hourly work week was down.
Right.
Is there anything bad in here?
It's a good jobs report. I think that we got so excited about worrying what was going wrong in the economy. And the economy was sputtering to some extent late summer and into the early fall. And I think there's been so much buildup all decade, really, but especially this year, the inversion of the yield curve, I think, got everyone very excited about not missing the next recession, right? Nothing the business press wants to do more than make sure they definitely get the next recession right.
We got to get it.
Because everyone got killed for missing what happened during the financial crisis. And what it's led to is a series of events, a series of turning points. And I think we clearly had one in November where we started to see European manufacturing bottom out, turn higher. A lot of that data was turning higher in October and November. And, the U.S. economy is doing a little bit better now than it was, but it didn't deteriorate perhaps as much as folks were believing, as much as the bond market was telling you. And so here we are once again, the stock market rallying on a jobs report that's stronger than expected. We've had 120 months in the decade. How many months have we sat here and said that? More than half, it seems like, right? This seems like in so many ways the story of the decade is a day exactly like this. Waiting for the worst, and it comes through, and it's actually okay.
Not just okay. I think it's
good. And
it is good. And I try to think, who is it better for? I think this is great for Jay Powell. I think it shows they've done a pretty good job, at least the last year.
Sure.
They probably don't need to do anything else right now, so maybe it is just a mid-cycle adjustment. But this also, to me, seems like it must be good for President Trump on trade. The U.S. is doing okay. Hey, you go to the negotiating table and you can say, we have, our economy is doing just fine. Our jobs are fantastic, 50-year low on our unemployment rate, and our stock market is at all-time highs. We don't need a deal.
I think many people agree that is the way that the administration approaches this. Now, you and I asked Peter Navarro that exact question a few weeks ago, and he said that's not how we think about it. So maybe it's not, but I think that who's this good for? It's pretty much good for everybody, right? More people having more money, working more is just in general good. And I think it's another reminder that while everyone gets very excited about these turning point events, next recession, bear market, blah, 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 that stuff is bad because in the aggregate, it gets worse for more people, right? And that's usually worse in general. And so, good economic data, good jobs reports, I think we're allowed to say it's just good.
Mm-hmm. And I really think the excellent maybe part of it was the leisure, the retail, the consumer.
Well,
we keep saying that that's so important, and then here we have data that those jobs are looking solid right now, heading into a really important month for a lot of those companies.
And with the exception of the month that Toys R Us went bankrupt, those data have never looked bad, right? Every month we have a ton of education services jobs. Every month we have a ton of healthcare services jobs. The story has remained the same, but we do have these sort of brief moments of maybe this is it, maybe it's inflecting. So we'll have plenty of ways to tell that story in 2020. All right,
It looks like we have President Trump
I think
talking
we
about
do.
jobs, not just us. Let's go to that in Washington, D.C.
We've created 7 million jobs since my election. Unemployment is at the lowest rate, as I told you, in many years. And in many ways, I think we can probably very soon say historically. A record 158 million Americans are now working. That's the largest number in the history of our country. We've never had 158 million people working. And we should be breaking the 160 million magic mark fairly soon. The stock market today, as you know, it's up 325. We've hit another record high. I believe that's 128 times, something like that, that we've broken the record, the all-time record for stock market highs. And think of that, about 128 times, and we've been here for less than 3 years, so it's, and that I can tell you is a record. 2.5 million Americans have been lifted out of poverty. African American, Hispanic American, Asian American poverty levels, in the positive sense, have hit record lows. It's something that nobody thought was going to be possible in a short period of time either. So they've all hit record lows. Our regulatory reform efforts are delivering prosperity to forgotten men, women, and children of America. We are seeing a middle-class boom led by blue-collar jobs, and that's one of the things that's so great. The blue-collar workers, great workers of our country, they're really benefiting tremendously from what we've done with the tax cuts and all of the other things that we've done. And very big, I think, is the regulation cuts, because even before we were able to get the tax cuts so successfully from Congress, we started cutting regulations immediately, and that had a big impact. And that's why we went up so much between the election victory. So you'd say really from November 9th, the day after the election, up until January 20th, the inauguration, the stock markets and jobs literally went through the roof. And if the election were lost, it would have gone right through the floor. It would have been a disaster. The soaring stock market is boosting pensions, 401ks, and college savings accounts at record levels. We've added $10 trillion in value to the economy, helping the small businesses that create 2 out of 3 new jobs. Nearly every single state has seen record numbers. Almost every state, I can tell you, every state I've been to in the last 3 months is having the best year they've ever had. And that's because of the federal policy. And they're very thankful. The governors are very thankful. The senators are very thankful. They're all very thankful. So things have happened that nobody thought would be possible. But literally every state I go to is setting a record for their state, individual states. And one of the states that just reported, and it's because of our actions, not because of their actions. This I can tell you, because their actions are very negative. California is doing much better than anyone anticipated because of what we've done at the federal level. So I'm very happy about that. Next year, we will continue our bold deregulatory campaign. We'll remove costly burdens to make cars safer and more affordable. I don't know if you know what's going on. We're in a dispute with California. California, in order to save a tiny amount of fuel, of which we have plenty, we have numbers that nobody ever would have believed possible. We're the largest energy producer now in the world, and we're an exporter of energy for the first time in our history, really. But we can make cars much less expensive, much better, much stronger, and about the same from an environmental standpoint, very close. But then when you realize that many old cars will be taken off the road because they don't want to get rid of them, because they don't want to buy the new cars, because frankly they don't work very well. That little, like this, you take that, sometimes it's about that much gasoline. It's a difference between $3,500, extra computers put on the engines, and all of the other things that you have to do. But the cars are much safer. Our cars are much safer. They're much cheaper. They're much better. And the reason they're safer is because they can be heavier. Because right now the cars are made out of paper mache. And ours are actually, we allow steel content. And so people are getting very excited about it. We have some good support with the auto companies. The only ones that don't support are the car companies that want to be politically correct. but we'll end up in some litigation with California. But
You've been listening to President Trump there. Now he is speaking about cars, and he's in this whole fight with California over emissions. But before that, he was talking about jobs, which is the story of the day, and also the stock market, repeating how good the economy is doing. We've heard this message from the president quite frequently. It's really what his platform is that he is running on right now. Let's bring in Yahoo Finance's Rick Newman, because it's time for This Week in Trumponomics. We hold this on Jobs Weeks because you need to get this latest data point. Because can you imagine if you had done this?
Yeah, it's obviously the biggest news in the economy this week. President Trump, we just saw him basically doing a victory lap. I mean, I think he gets to, frankly. The Trumpometer has expressed a lot of disapproval with some Trump policies, but I'm just going to get right to it and push the button if you guys don't mind.
Get to it.
Last week, that's last week's mediocre. This week's, I don't think anybody will be too surprised.
It's got to be up here, right?
I think it kind of has to be.
Level.
Big league. I mean, how could it be anything other than that? I mean, we just had a monster jobs
Jen, they
report.
never give him the credit he deserves.
Rick
Mainstream
Newman
media
is
will
giving
never,
him
they'll
the
never give him the
credit.
credit.
This is his third big
Why
league in
isn't it
2 months. Third big league in 2 months, I would like to point out.
Why is it not huge?
We're saving huge for something truly huge, like maybe if Trump resigns, that would be huge.
A phase one trade deal?
A phase one trade
Maybe
deal.
phase two trade deal.
In Trump's mind, that would be huge. I think I'm conditioned to expect there will be no trade deal. But, you know, I mean, you really just can't say anything bad about this report. I mean, it was not entirely perfect, but economists were just stunned. I mean, they just couldn't even really explain how we got so many jobs. And there are a number of reports saying this could be a fluke, this could be an anomaly, could be a one-off, expected to be revised downward. They're almost like it just can't be true. But at any rate, you know, the oddity of this is we still do have just about a 2% economy. Most economists think it's going to be lower next year. And we're seeing a cutback in business spending. We still see weakness in manufacturing, and we still got this 266,000. So, I mean, it's good news today.
But the 2% economy, to me, is why we continue to see these good jobs numbers.
Well, explain that.
Obviously, the economy is not meeting its full potential. Right? There's obviously a number of people who are out there in the workforce or who want to be in the workforce who are not working. There are people who can be enticed to take more productive jobs or higher paying jobs. There is an underutilization of the labor force, even if the numbers suggest there's only 3.5% of folks unemployed, right? And we've been seeing this theme play out really since 2015, right? 2015-16, the Fed, well, they raised rates December of 15. They raised rates again December 16. That was the year, Yellen's final year as Fed chair, that they started to begin teasing this idea that maybe we had finally reached full employment. We saw wage growth start to get into the mid-twos, the high twos, and yet we have continually been surprised at the amount of slack out there. So why do we have a 2% economy? Because we are obviously not utilizing all of the potential that still exists.
And
right?
also, another indicator of that is wage growth has actually been pretty low. I mean, 2% is no big deal. I mean, it was a big deal because it was hard to get to that for almost 10 years. But historically, that's almost nothing. But it's almost like the slack, you pull, and then there's more slack. Right. You think the rope is tight, but then there's more slack. I mean, but by definition, 3.6% and now 3.5% unemployment should be a really, really tight labor market, but it just doesn't. I think your point is that, the way I see it is, there's more slack than that very, very low unemployment rate suggests.
Look, we lost 10 million jobs. After the crisis, we have the largest generation in American history coming into their prime working years. We have people healthier at older ages who are re-entering the workforce. I know a lot is made of senior employment. Those people are still well and able to work, right? And of course, many of them need to. And so all these factors and the depth of the crisis, I think, still gets understated.
So can I just go back to something else Trump said in those impromptu remarks? So he had his bland recitation voice when he was reading from what his economist told him to say, but then he ad-libbed as he often does, and he started talking about cars, and he's trying to make the case for his new environmental rules, which will be lower than the Obama-era rules and the ones that California wants to put in place. So Trump said the cars they make today, they're just not very good. He's completely wrong about that. The cars today are fantastic. You know, nobody's car ever breaks down on the road anymore, unless it's more than 10 years old. And I think few people ever even bring their car in for a warranty claim because they're so good. I mean, cars today are fantastic compared to what they used to be. And by the way, when Trump says, you know, we need to make cars heavier so that they're safer, well, that car is safer if you're inside it. If you're the car that's being hit by it, you're less safe. You're less safe if you're being hit by a heavier car. And he's really misleading people on that, and safety matters. So get your story straight.
When do you think the last time he drove a car was?
A golf cart.
Golf cart, yeah, probably a golf cart.
It's probably been years since he drove a car.
One other thing, just because we had Jared Blick redo the numbers real quick. The president had been saying that there have been 128 stock market records. So Jared just ran through the numbers. Looks like 115 S&P 500, 135 NASDAQ 100, 129 NASDAQ highs. So more than
Trump is on the money on that. I thought that sounded high.
Dow 118. Yeah. So kind of just put them all together and you get there.
We'll give him that one.
There you go.
Close enough.
Rick Newman, have a great weekend.
You too. See you guys.
All right, coming up here on the final round, we'll have some stocks to watch, but first take a look at where the European markets close on this Friday.
Now let's take a look at some of today's stock movers. The trade desk after Needham upgraded the technology company to buy from hold while setting a $325 price target on the stock. Big Lots after the retailer reported a smaller than expected 18 cents per share loss for the third quarter. The street expected a 20-cent per share loss. Cloudera after a number of brokerage firms, including Morgan Stanley and Bank of America Merrill Lynch, raised their price targets on the company's equity after the company reported better than expected third quarter earnings and revenue.
And coming up here on the final round, influential Tesla analyst Adam Jonas gets bullish on the electric car maker ahead of their big January conference. It's our call of the day, but first let's take a look at some of today's trending tickers here on Yahoo Finance.
Let's go to our call of the day. It's Morgan Stanley on Tesla. So on the surface, everything's the same. Analyst Adam Jonas has an equal weight rating on the stock, a base case of $250. His industry view is still cautious, but he did raise his bull case to $500 from $440 to account for the newly unveiled Cybertruck and a more optimistic scenario in China. Jonas emphasizing that he's not bullish on Tesla longer term, but he thinks the Tesla Cybertruck and China can get him those 60 extra bucks he needs for the bull case. That's the longest I've gone without saying Cybertruck since it's been announced.
Cybertruck.
A whole week.
Cybertruck.
Yeah, but we haven't said it all week. We talked about it every day.
That's great.
I'm
glad we moved on.
It was announced, and now it's back.
Because, I think the note sort of says how we should be thinking about Cybertruck in general. We're discussing potential sales figures for the Cybertruck in 2024. So when we get closer to 2024, we can start talking about the Cybertruck again, right?
So stop.
2021 is when it's realistically expected that it could come out, which means it's not going to come out until 2022 or 23, and then we can figure out what sales of that vehicle look like. Not to mention, Lord only knows what Tesla's going to look like in 3 years from now, because you go back in time 3 years, and the story would have, you would have thought the Cybertruck would be out now, based on where the company was 3 years ago. So, fine, I get it, $20 maybe case gets added because of the Cybertruck. I think the Shanghai factory, $40 to the bull case here from Jonas, slightly more compelling, but again, when are we going to start getting to that? Again, 2024, 25 is the base case for estimates there. Tesla sales estimated at 250,000 vehicles a year, 5 years from now. So again, wake me when that is happening.
One of the things I liked about the Cybertruck incremental value here was how he compared it to the Hummer, the H3. Because everyone's trying to figure out how many of these are we actually going to sell? Because he uses the word polarizing. We know that on all the stories we've done on the way it looks, but even if it sells, how many would that be? So the H3, the Hummer H3, they used as a proxy, and vehicle peaked at 60,000 units globally, albeit mostly in North America. So they're kind of being generous, I think, here with 100,000 units already in their bull case assumption.
Yeah.
But they're trying to get some in there because there is some excitement around it. But this is on the bull case. Nothing has changed in just the regular.
Yeah.
This is
the equal weight world.
Our equal weight world, or our bear case at all. We're just there.
All right, we'll see how long we go from now without saying.
Can we do it all next week?
We'll see. Who knows? Maybe Jonas has another note on the Cybertruck. We'll have to talk about it. Coming up on the final round, how does today's jobs number impact the Fed ahead of next week's big policy meeting? TD Securities' Priya Misra joins us to break it all down. But first, take a look at how the financials are trading right now with 37 minutes to go in the session. November jobs report crushed expectations, but does it change the outlook for the economy as we head into 2020? Priya Misra is the head of global rate strategy at TD Securities, and she joins us now to discuss. So let's get right to that point. As we look at where you see markets heading in 2020, after what's been a very eventful year in the Treasury market, does this report change how you're looking at the next year?
Not really. I think what we've been seeing so far is that the labor market's been extremely resilient. Today's number was, we poured through all the details. It's a good report. But it doesn't reduce my nervousness around next year around the economy. Because I think what we know is the business investment sector is weak. So, manufacturing is weak, CapEx is weak. We've been sort of waiting, is that filtering through into the labor market? Historically, the labor market is a lagging indicator. It's literally the last shoe to drop. So I still don't think the uncertainty component's gone. So the key questions for next year that we're thinking as we sort of think about markets, number one, has global growth clearly bottomed? I think there's some evidence that pace of deceleration has certainly gone. I'm skeptical that you'll get this sudden surge in growth similar to 2016, because 2016, remember, we had that big fiscal stimulus from China. We're not getting that sort of fiscal stimulus. But if global growth has bottomed, I think one of the headwinds for US growth does dissipate. The other issue is around uncertainty, and this is where I think the election comes in. We have an election coming up. Tariffs have been weaponized by this administration. I mean, just 5 days ago, we were talking about, new tariffs on Brazil and Argentina. I mean, then France. So I think we spend the entire year still with that uncertainty, and that ultimately, I think, feeds through into the consumer.
Well, but I just want to follow up on the 2016 example quickly, because I think in 2016, with a little bit of hindsight, we have come to realize how close the global economy really was, I think, to a major problem, right? But for all the weakness in Europe, it doesn't seem like things were that imperiled, or perhaps were we understating some of the dangers that we were facing kind of collectively just a few months ago?
Right. If it's just Europe, if it's just manufacturing, I think we can probably weather that. If this is an uncertainty shock, and that's why I think when we look at the data, it shows up in CEO confidence, it shows up in PMI, even the PMI numbers, ISM manufacturing did disappoint this week. So if the spillover is just from Europe manufacturing, I think we can live through that. If it's global manufacturing, global business investment, this is where I sort of go into the uncertainty point. I think there is an assumption that the president is going to sort of capitulate into the election, because he wants a deal. I don't think he wants a weak deal. I don't think he's capitulating to the Chinese. We'll probably be talking about trade all next year. So that's not an environment where businesses want to increase investment. So where's the engine of growth for next year? I think the consumer's fine as long as the labor market's fine. But what gives us this additional boost to get GDP higher next year? I struggle to see that.
So while you still have questions about next year, I mean, you do think on its merits, it's a good report. So who deserves the credit for that? Is this President Trump and his policies? Is it the Fed? Is it American business? Who gets the gold star today?
I think I would give a lot of credit to the Fed. The Fed changed its reaction function earlier this year, lowered interest rates at a time when the US economy was not really looking like it was heading into a recession. And they cut 3 times. It was a very divided committee, and yet Chair Powell got that through. I also think the message we're hearing from the Fed in the last 2 meetings, and I think it'll be repeated next week, is key, that they're not about to take away these insurance cuts anytime soon. They really want inflation to go above target. So, we've just been effectively given forward guidance that interest rates are going to stay low for a while. So one form of uncertainty has been taken away. I think fourth quarter last year, there was a lot of Fed uncertainty because they were talking about hiking beyond neutral. They were talking about, balance sheet runoff on autopilot. I think they've learned a pretty valuable lesson. So I will give them some credit. I mean, I think the economy is strong and it's a very domestic-led economy. So you have to give some credit to momentum.
So when we look at the Fed then for next week, as you mentioned in the October meeting, they didn't put out an SEP, but they did, Powell said, we're not raising rates unless inflation goes higher. And inflation is probably not going higher, all else equal. So what do you expect to see from them then on Wednesday? Is there do they need to cut? I saw some folks discussing they really need to cut their NAIRU estimate because right now they're just far too high given what we've seen in the economy. Is there something like that you're looking for when all that comes out Wednesday?
Right, the infamous dot plot. We'll be looking at that. And now it's a very dated dot plot that we're looking at from September because it's before the last 2 cuts. Yeah. So where is it now and when are they taking back these insurance cuts? If you think that the committee put the insurance in, turns out we didn't need the insurance, they take it back right away, I think that's a very hawkish signal. I don't think they're there. In fact, that's why I'll highlight the framework review. They're in the process of an inflation framework review. They have made some conclusions that they need to signal that let inflation go a little above target. I think that's what we'll be looking for. So the dot plot for 2019 is on hold. 2020 median might be on hold, but I'm going to be looking at that distribution. I don't think you'll see too many hikes in there. I don't think you'll have too many cuts either. But really, it's that forward trajectory. It's the reaction function embedded in that. I will be looking at the inflation forecast. You know, when do they have inflation going above 2%?
Yeah.
In our forecast, that actually doesn't happen ever.
Yeah, it was like in our lifetime.
Yeah, right.
I mean, the structural forces, according to the TIPS break-even market, it's not happening for 30 years. So either that market is wrong or the Fed needs to cut a lot. So there is some disconnects, I think, even in the rates market.
All right, Priya Misra, Head of Global Rates Strategy at TD. Thanks so much for joining us. Talk to you soon.
Thanks.
Coming up, we got more final round. Plus, could Instagram's move to hide likes actually hurt profits? Why some employees are concerned. We're back right after this.
Welcome back to the final round here on Yahoo Finance. Miles Olin with you in New York. I'm joined as always by my co-host Jen Rogers. We've got 26 minutes to go in the session. Let's take a look where we stand right now. All three majors significantly higher after that jobs report. The S&P, the laggard here, up just under 1 full percentage point. For more on today's market action, let's go to Scott Gamm, who is live on the floor of the New York Stock Exchange. Scott.
Yeah, that's right, Miles. Everyone's talking about the jobs report, but there's a lot of news in the energy sector today as well, and that is helping to boost the broader market. Remember, OPEC was cutting 1.2 million barrels per day. That was set to expire in March of 2020. Well, this week at the OPEC meeting in Vienna, members agreed to steeper production cuts by an additional 500,000 barrels per day, bringing the total daily cuts to 1.7 million barrels per day. Those are still set to expire in March of 2020, so they didn't extend the deadline, but they did, of course, agree to a higher intensity of cuts. And with that, you've got pretty much everything energy related up, right? West Texas Intermediate, that's the U.S. benchmark for crude, crossed $59 a barrel today. It was just this past Monday that WTI was just over $55 a barrel. The two energy names in the Dow, Exxon and Chevron, are up. And then, of course, the energy sector
is the best performing sector in the S&P 500. And then while we're on the subject of energy, we also wanted to bring you up to speed on the Saudi Aramco IPO, which is due later this month. Pricing at the equivalent of $8.53 a share. It's going to raise $25.6 billion. That would be the largest IPO on record, a little bit more than the $25 billion that Alibaba raised here at the New York Stock Exchange back in 2014. And then this IPO is expected to have a valuation of $1.7 trillion. That's a little bit less than the $2 trillion that officials there wanted, but still, even at $1.7 trillion, that's a lot more than some of the existing trillion-dollar companies. You're talking about Apple at about $1.2 trillion, Microsoft at $1.15 trillion. So there's some competition for our beloved tech names here in the U.S., Scott.
All right, Scott Gam, we'll talk to you shortly after the closing bell.
Time now for Tech Howl. Instagram has extended its hiding likes experiment into the US. The feature is currently in its testing mode, only affecting some users. And while many users are upset or concerned, some are celebrating, and there's experts out there saying that this could be a real plus. Yahoo Finance's Dan Howley is here with more. Interesting that Miles and I can both see likes.
Yeah.
However, the
We're
tech
not
guy
influencers.
is in the test.
I'm an influencer. I know. Just so you know.
So that's, he got the
all 50
this
people that follow
first.
me. Yeah, it's interesting because what they're doing here is, and a Facebook spokesperson said to me, this is just an experiment right now. We don't necessarily know that we're going to pull likes being able to be seen from Instagram at large, but it's something we're trying out. And they say the reason is twofold, really. It would allow kids to kind of avoid that bullying pressure where, hell, you didn't get enough likes on your picture of your food this morning in the cafeteria, we're going to make fun of you or something like that. That's kind of where this social network has gone, and there's this insidious kind of atmosphere around likes when it comes to younger folks. And you were just saying that it's
terrible.
It gets weird. The other thing is when you think about influencers or brands, they use likes obviously to push out and say, look at how many people like this Clorox ad, or Kylie Jenner goes out and look at how many people like this.
Yeah, but aren't those folks going to still have access to their how their stuff is doing, even if it's not public?
You will still, so I can see how many people liked my photos, but you can't see yours. And the reason, you can't see mine.
You could still tell
how many liked
Dollar
yours.
Shave Club, who wants to sponsor your Instagram, how many likes you're getting, right?
Yeah, and so the thing is, when it comes to influencers and brands, being able to see that X number of people liked your photo is a benefit, because then that says, oh, maybe I should be following this person. Maybe I should like their stuff. So that's where this issue comes up. But I was speaking to some analysts, and they were basically saying, look, this will give brands the opportunity to go out and get more meaningful metrics beyond just likes. And Instagram's going to have to work with them to do that. But eventually it could come around to, let's try to focus more on how we can maximize our investment in Instagram and get more people to actually interact with the brand. And then that would obviously, hopefully, lead to more revenue for the companies themselves, not just Instagram. And then when it comes to influencers, this is actually surprising. This analyst that I was speaking to at Forrester was basically saying companies are now going for people that aren't necessarily mega influencers with hundreds of thousands of followers. They're going for the mid-level to zero followers or likes, because they want more authentic followers.
Did you say mid-level to zero?
There you go.
Zero.
That's me.
Sign you up.
Just get on there.
So Instagram, they're playing around with this.
Yeah, it's not
because they have
certain.
a very big heart, and they are worried about the youth.
Warm and fuzzy Facebook, as we all know.
I imagine there's also something about the bottom line.
Yeah,
and we've seen the rise of VSCO. Where it's not about the likes and people are posting more. Is that what they're trying to do here? Is that if they take that away, that people will maybe get out of stories, get back to the feed?
Yeah.
And is there any sense that that's going to work?
I mean, I think that's why they're testing this. It's on the face of it, it's the bullying. On the back end, it's, well, maybe people will end up posting a lot more and then spending time on it, because the idea is you are so concerned that you're not putting the proper post up or the right post. You didn't get the right lighting, or you didn't edit it this way, that you end up not posting as often. But if you take away the like counter and you take away that pressure, then you might end up posting more and spending more time on Instagram, which ends up being better for Instagram, because more advertisers will see, oh, these people are spending a lot of time on, let's buy more ads on Instagram. And I think that's really where it's going from their standpoint. And they can, say how it's going to help with bullying, which I'm sure it would.
No, and that's good. I'm not saying that's bad.
Exactly. But it's mutually beneficial.
So it's an anti-bullying show, just so we're clear.
Just so it's clear. It's not bad. But it's also a stock show, and I want to make sure this is what I know is going to happen to the
Exactly,
stock.
yeah.
That's all.
It's not just good for the kids, it's also good for Facebook and Instagram.
I'm all about the bottom line. Dan Howley, have a great weekend.
Coming up here in the final round, we'll have the winners and losers in the stock market. But first, take a look at some of today's most active tickers right here on Yahoo Finance.
Let's take a look at some of today's winners and losers. Stocks in the red include Uber after the ride-sharing giant revealed in its first ever U.S. safety report that more than 3,000 sexual assaults occurred during rides last year in the U.S. alone. Zoom Video Communications, shares of the video conferencing company, plunged after its latest earnings release revealed a slowdown in growth. Now for some stocks on the move higher today. DocuSign, after the digital signature software company reported quarterly results that surpassed analyst expectations. And Ulta, shares of the beauty company, are soaring after beating quarterly profit estimates thanks in part to sales of higher margin cosmetics products. Coming up, the used car dealership is going virtual. Would you buy a car strictly online? Vroom CEO makes the case. But right now, take a look at where the auto stocks are trading. next guest is a used car salesman. If those words make you want to open another window and watch something else, you're not alone, but stick around. He's trying to change how you think the whole used car selling and shopping experience should be. Paul Hennessy is the CEO of Vroom. Sorry, everybody really
Thank you
has
for
an
that.
opinion
I'm sure
about
Paul's never
used
heard
car
that.
salesman.
Thank you so much.
But, tell us about Vroom. I spent some time on the website today, and it seems like you're trying to make buying a car as easy as shopping on Amazon.
Well, that's exactly right. We built a innovative end-to-end e-commerce platform that's disrupting this massive used car market. And when I say massive, I mean $800 billion in annual revenue. And we're bringing everything you could possibly do in a dealer online, makes it easy for customers, and then ultimately we allow them to have a car delivered directly to their driveway. So it's a simple process.
All right, now everyone knows that going to a dealership can be not a lot of fun. It's a whole thing. We don't need to go through it. But what people do like to do is drive the car and actually get a sense for what the vehicle is like. So if I go on Vroom and I'm getting a car delivered to my home, how am I ensured that the quality is what I think it's going to be?
So first, we have a team of folks that recondition the cars, right, to what I would say expertly reconditioned. And then we display the cars online so customers can completely evaluate what they're getting. And then they can buy the car and they've got a 7-day test drive. And I would say that our test drive is far superior to the classic drive around the block with a stranger in the car. Mm-hmm. Customers can drive the car, to work. They can take the kids to school. They can see if their luggage fits in the back. And if they don't like it, they can return it.
How many people actually return the car?
It's very de minimis, low single digits. And then about 25% of the customers that do return the cars buy another car. So the car might not have been right for them. So it gives them great flexibility to buy from us.
Now, another thing that car people have talked about for a few years is the average age of a car is getting older because the cars just last longer, right? I mean, an engine built today is probably going to make it to the low 6 digits, whereas maybe 20 years ago, 75, something like that. Do you think that is kind of a tailwind for your business? Is that part of what's exciting you here, or is it just as simple as why are people still buying cars in person? They could just do that online.
Yeah, certainly that's a tailwind for us, and the fact that cars have a really long useful life. Our cars are typically 1 to 4 years old, so they're low mileage, recent models, and then customers can actually get value from the pricing differential between new and used vehicles, and then drive those cars for a long time. So it's a really outstanding value for our customers.
One of the things when you're shopping for a car, you're just so used to the idea that you're going to have to haggle.
Yeah.
And so you just have a price there.
Yes.
Does that work with customers? Because
I don't want to haggle.
Well,
I want a quicker
don't
price.
you want to know that it's on sale? So here's the RealReal is you're kind of like the RealReal but of cars. Yeah. The RealReal is constantly on sale and having promotions and getting people in. That's sort of how consumers are trained right now. And even if you want to create something frictionless, even with Zillow and offers, there's some give and take sometimes.
Yeah, I think if there's a pricing differential, customers think that there should be a different price. We've got a team of data scientists that actually help us price the vehicle so we understand what the market is, we understand what the consumer demand is, so we get the right cars at the right price, and then consumers are actually thrilled to have transparency in pricing rather than go through the traditional, because you always felt like the information was asymmetrical, and therefore customers felt at a disadvantage. So they never knew if they were getting a good deal. With Vroom, they get a good deal.
Now, you were the CEO of Priceline.com in a former life. When you look at the OTA business, and do you see any similarities between what that business looked like, the way that disintermediated traditional travel agents, and where you think the auto market might be today?
Yeah, certainly the pattern recognition between online travel, when online travel got started, and where we are today in terms of disrupting the used car market, it looks very much the same. If you recall, in online travel, people used to go to travel agencies and book trips. That's been effectively eliminated. That's exactly what we're planning on doing to the dealership model.
And now we're seeing the OTAs kind of get disintermediated and disrupted by Google. Is your business model secure that you will be able to stand the test of time for whatever comes along, SEO or otherwise? Why is it different?
Yeah, so let's talk quickly about the market. I mentioned it's $800 billion in annual revenue. It's also massively fragmented. So think 40 million cars sold a year across 43,000 dealerships, where the largest single shareholder in the space has less than 2% share. and then the next 100 have 7% share. So with that fragmentation and absolute size, and by the way, it's growing, yeah, we see all sorts of runway.
And do you guys think you'll go public eventually?
Look, we just received $250 million in investment capital. We're going to focus on building an excellent e-commerce platform, that's for sure.
Vroom CEO Paul Hennessy, great to see you. Thanks so much
Thank
for
you,
coming
great
in.
to see you. Thank you very much.
And coming up here on the final round, we'll have a closing bell on Wall Street. That's about 9 minutes away. But first, Jared Blickery will join me at the charts to get technical, talk about this market, what it's looking like towards the end of the year. We're back with that right after this. All right, 6 minutes to go in the session. The market having its best day in about 2 months. Jared Blickery joins me now. Jared, great jobs report this morning.
Thank you.
What is what's the market looking like right now? Just a little bit off the highs of the session.
Yeah, well, Dow's up the most, 320 points, about 1.17%. S&P 500 is up just shy of 1%, and the Nasdaq is about 1%. Russell 2000 outperforming 1.3%. Lots of numbers there. Now, here's what happened today. We gapped up, made some new nominal highs. You know, we're about 25 basis points off the record highs. No reason why we can't hit those again. But remember what happened Monday. A lot of people probably would not have expected to be back here. It was pretty nasty that day. But the correction was what, 2.7%?
Yeah,
nothing.
So let's just look at the market over a little bit of a longer term time frame here, just to kind of get a sense of whether we are, floating towards some level that we've gapped to, and we will inevitably get smacked down. Because I think what's really been standing out of the last couple of months is that move from sort of the lows in August.
Right.
Got a lot of steady grinding higher, and it felt as we hit those record highs in October like we were looking at something a lot more durable than maybe a flash high, right?
I think so too, because we made, here's a prior breakout area right here. It's about 3120 or so, 3130, or excuse me, 3020, 3030, and we had rallied substantially above that. The highs we were getting before, like this one right here, wasn't that much farther along than the previous high. So there are a lot of reasons why it looks like this has legs, and not the least of which breadth has bounced back. You look at internals, those have bounced back, and you can even draw a trend line here. And you can see this captured the sell-off here, the minor sell-off that we had, pretty accurately. But I think we're going to break above here into the new year because we have that seasonality as a tailwind. But I would be a little bit concerned about the trade war. If that ratchets up new tariffs, all bets are off.
All right, so leaving the headline risk aside, let's talk about the bond market, because that's really where we've seen the S&P get a lot of its kind of guidance from, as it were. What's that relationship look like today? And in general, has that held as tightly as it was holding a few months ago?
I've been tracking this very carefully, and we can look at some of the individual markets that are influenced by bonds. But if you wake up and you see bonds trading 2 or 3 basis points higher or lower, you can pretty much predict what's going to outperform that day. So let's take a look at some of the leaders here and what's working today. Retail bouncing back, that's concurrent with higher bond yields, which we just saw up about 5 or 6 basis points today. Now, the Philly Semiconductor Index, that has done well no matter what. So that's not really predicated on yields. But the transports are up. The regional banking index, financials are doing well. JP Morgan is at a record high. So we can take a look at that as well. And we can see it's not quite breaking out, nor has the transports, but the Russell 2000 has broken out. That's another thing that's done well.
Yeah, and it feels like the Russell has a lot of catching up to do as we look towards the new year. Potentially, to me at least, feels like we could be looking at an early period of 2020. That seems like 2018. Of course, not super great memories from that time, but we'll track that in the new year. Coming up here on the final round today, we'll have the closing bell on Wall Street. Plus, we'll take a look at the biggest companies that died during the 2010s. We are back with that right after this. Welcome back to the final round here on Yahoo Finance. Miles Upton in New York, joined by a completely new cast here. We've got Akiko Fujita, Emily McCormick, and Jared Blickery stopping by on this Friday. We're about 30 seconds away from the closing bell. Let's take a look at where we stand right now. All three majors right near highs of the session. The S&P, the relative laggard here, up 0.9%. The benchmark index is about 8 points below a record close, the closest of any of its peers. And you are looking at live pictures from the New York Stock Exchange and the NASDAQ market site. Of course, a tremendous jobs report earlier this morning. We heard from the president earlier in this hour on that topic. And so we go into the weekend with 2 full trading weeks left in this year, a Fed meeting, a UK election, in the general election in the UK, I guess we should say. And of course, we're about 9 days away from tariff deadline, but no need
Not
to
a
worry.
whole lot happening.
No need to worry about
2 more
tariffs
weeks
now,
left.
Kiko, because everything is perfect and amazing.
Yeah, it's interesting, right? I mean, I was looking at this report today and thinking, if you're bullish on the economy before, you're going to look at the headline number and say everything's great. If you were a little cautious, you're going to say, well, the participation rate dropped. You can kind of nitpick here, but I think at the end of the day, the outlook hasn't necessarily changed. You know, we look at the Fed meeting next week, no change expected then. I was reading this UBS report that said, look, the timeline may have shifted in terms of a rate hike, but they're still expecting 3 hikes next year.
Yeah, 3 cuts, you mean?
Oh, 3 cuts, yes,
Right.
3 cuts next year.
Because Jay Powell's like, no hikes in the rest of my
Jay
lifetime.
Powell could pivot on a dime. I'm not worried about that. He'll just say, whatever I said, the opposite. Yeah, it's a pretty impressive week here. Is this the time of the week where we talk about what happened during the week?
If you want.
Okay, good. S&P 500 just nominally positive, and we were just talking about, after Monday, not a lot of people thought we would have ended up in the green. Things looked bleak to some and very bearish to others. Didn't happen. Another big thing is crude oil. Crude oil had an incredible run-up just in time for the Aramco pricing, also concurrent with a surprise OPEC plus cut in production, which is, I couldn't have engineered that better myself. They got that $1.7 trillion valuation. We're seeing some record highs in some of the sectors here, such as staples, communication services. Financials are within a half a point of their 2007 highs. So there's a lot of strength in this market right now.
And Emily, this comes as we continue to see analysts issuing their 2020 forecast. It seems like the first batch was a little mixed, but Jefferies coming out today, 3,300 for the S&P. It seems like there's a little bit more of a bullish tone when you start to look at what strategists are expecting for 2020.
Well, bullish, but maybe not to the extent that we saw in 2019. I mean, they're not expecting the same level of 20+% appreciation. I mean, the Jefferies outlook for 3,300 is just in the low or mid-single digits for a percentage growth for the S&P 500. And really what they're saying is that next year will probably be a year of normalization, right? So we're really lapping the 2018 corporate tax cuts, which had weighed on those earnings outlooks for this year. We're lapping the point where the Fed had done its rate hikes last year and now unwinding that. So we're kind of getting back to the fundamentals and having earnings growth being that main driver of the stock market.
I was looking at the S&P 500 targets for 2020 for about 20 different investment banks, analysts, and the consensus is it's not going to be that bad next year, even at the worst, because the lowest target I saw was 3,000. That's pretty close. So if anything, there might be a little bit too much complacency in the Wall Street desk right now.
And what always surprises me about those outlooks is they generally cluster around the mid-single digits, right? Because the historical average gain of the S&P is like 7% plus the 2% dividend. But there are, I forget what the exact numbers was. I should have prepared this exactly. But I know that on average, the gain is usually double digits or negative, right? You rarely actually get a mid-single digits return year on the S&P because you the average out is to the year like a 2019, you're up 23%. A year like 2017, you're up 25%. And so I would be very surprised if we saw kind of a 4 or 5% grinded out sort of year. Even in the last 5, we've seen 0, negative, and a couple of blockbusters.
Yeah, the 0.
I mean, I'm with Jared, though. I think that there is a bit of complacency that's kicking in. I mean, I look at where the market is today, and you wonder, like, what's continuing to drive that optimism? Because the overhang, the question mark we started with at the beginning of the year is still there. And as you point out, still looking at December 15th, we don't know if that's going to go up. And, companies aren't necessarily investing the way that we've seen in the past.
And certainly will be the story, I think, of 2020 at the very least. For more of today's market action, let's go to Scott Gamble, who's live on the floor of the New York Stock Exchange. Scott, it is time, I believe, to get that 28,000 hat back out of the closet.
Yeah, I have an extra one. I also have one at home. That's how excited I am about Dow 28,000. But let's get right to the gainers of today's session. We're looking at names like 3M, Goldman Sachs, Boeing, and Dow Inc. Now, even with Boeing as a gainer today, it's still only at $353 a share. Back in September, the stock was at $389 at one point. So just imagine what could happen to the Dow if Boeing was able to retrace that level. Also, Apple was another big gainer in today's session, hitting a record high, crossing $270 a share for the first time ever, that helping to propel the Dow above 28,000. The laggards in today's session were Walgreens, Procter & Gamble, although even that stock is still above $124 a share. Also United Health and Visa, but all of these names were down less than 1%, so pretty modest declines. With all of this, the Dow did still close above, as we mentioned, 28,000 for the first time in more than a week, but we're still a little bit far away from record highs. The record was above 28,100, so we still need another up day or two to move back towards the records of November, guys.
All right, Scott Gamm, have a great weekend. Talk to you on Monday.
You too.
All right, just a few weeks away from a new decade, many companies and brands made their mark in history over the past 10 years, but the 2010s have also been a decade where many businesses reached their final end. Yahoo Finance's Emily McCormick joins us now as we look back on the companies that died in the 2010s.
Right,
with
so
this very exciting and uplifting story as we head into the weekend.
Exactly. So Brian Sozzi and I looked at some of the biggest corporate failures of the past decade. No surprise, a lot of these were clustered around retail. So think about names like Sears, Toys R Us, Wet Seal, if you remember that name, which was in shopping malls for the past couple decades and now is no longer. And if we really think about it, a lot of these had to do with competition, which of course is no surprise for any company, but a failure to really address the competition, to pivot to consumer demands and technological innovation. And then a lot of that also coincided with heavy debt loads. I mean, Borders towards the end of its lifespan had listed more liabilities than assets on its balance sheet, had these sprawling 25,000 square foot stores when shoppers were starting to go online for a lot of these purchases, just a huge amount of merchandise that people weren't buying through foot traffic anymore. And just an inability to pivot really brought about a lot of these downfalls.
Sears is incredible. Company's what, 150 years old?
Right.
No more.
Yeah.
No more. Eddie Lampert just ran it into the ground and bled it dry. What a tragedy.
I mean, you look at the other names, though, right? Blockbuster. What was the other one? Borders, Toys R Us. I mean, these are all companies that were essentially pushed out as more and more went online. And it's kind of, to your point, we see this with a lot of companies that just don't see the competition coming, see the change coming. And once they do, it's just too late.
Or they're
So
too
they
over-leveraged,
pivot.
right?
Yeah.
Right. I mean, we think about it. It's easy for us now in retrospect to sort of pontificate on these things, this move to the internet that is really driving just e-commerce corporations now. But if you look back, I mean, Blockbuster had an opportunity to partner with Netflix for just $50 million back in 2000. They turned that down because they really didn't see the rise of streaming. The fact that DVDs had really enabled Netflix from the get-go to begin just shipping out their movies, since VHS had been a little bit heftier to have to actually do that. So if you think about it, it really, again, is this competition and just on the part of management, too, to not be able to make those pivots in order to stay alive.
And then, of course, there's the companies that just died because they died. Vine and Theranos, which were two companies.
Two separate
Yes, very different situations. But it's like these were the companies that came up. Vine was fun. It was wholesome-ish, sort of.
Which is kind of making
Twitter
a
just
comeback in
killed
the
it
form of
with TikTok,
But
right?
also, this decade began on a very precarious footing. I mean, we were just getting over the financial crisis. It looked like we could go back or edge back into recession at any time. And so a lot of these companies were severely hurt by that and really didn't start out that well in 2010.
But look at all the companies that are doing fine after recession. I do think a lot of these failures were company specific and not necessarily because of macro.
But I think the
value guys,
Vine.
the value
I'm still
guys.
sad about Vine, though.
Are you?
Well, but Twitter wasn't.
Ethan Wolfman was like a Vine star. And then now he's just a guy on the internet writing stories.
Although Dom Hoffman is working on another app that is supposed to be Vine 2.0. So we could see that in a new iteration, potentially, in the next couple of years.
Yeah, and what's that ride-sharing company that just went out of business
Juno.
Juno.
Yeah, Sidecar was another one that we included on the list that also went out of business. So Uber and Lyft.
Dan Roberts' favorite company is Juno, I think. All right, should everyone do a prediction for a company I think it's going to die in the 2020s?
Ooh,
Ooh, you're putting us on the spot here.
Well, just pick a retailer. Throw a dart.
Yeah, I know, really.
Throw a dart at XRT and you can probably get one right.
JCPenney's going. That's an easy one. Maybe some big department store like maybe Macy's won't be here in 10 years.
Well, okay, what if Uber and Lyft merge?
Is WeWork too easy to?
But
I don't think it's too easy. SoftBank's put a lot of money into them.
What does that look like? Do they call themselves Luber or Lyft?
No, I don't think Uber and Lyft are going to consolidate in any way. Luber.
No.
I'm not going to go near that one.
Come on, Miles.
Emily McCormick, have a great weekend. Thanks for
you guys
joining
on
us.
that note.
Coming up here on the final round, we'll talk about the biggest retail trends of 2019 and what's going to be big in 2020. Jerome Martis from Refinitiv joins us for that. But first, take a look at where some of the retail names settled on this Friday. Mish consumer sentiment report out earlier today, hitting a 7-month high. Are we seeing that climb reflected in the retail sector overall? Joining us now to discuss is Refinitive's Director of Consumer Research, Daron Martis. So let's just kind of take stock of the consumer right now. We all know that the economy is basically betting that consumers will continue to perform fine through the holiday season and beyond. Is that what you guys are seeing in your work?
Yes, definitely. At Refinitiv, our estimates definitely show that the consumer is still engaged. 2018 was a very strong year in terms of consumer spending, and therefore retailers are facing somewhat difficult comparisons from a year ago, but they're still posting strong results. Look at Dollar General yesterday, smashing it out of the park. Again, underlining the factor that for consumers right now, the value proposition is extremely important. The only way retailers can get the consumers to open up their wallets is by offering them a discount. And we saw some of that during the Black Friday and Cyber Monday weekend. For Black Friday, actually, the discounts were slightly stronger compared to Cyber Monday, and the consumers went out at full force, and we continue to expect to see this growth into early 2020.
Is it really just about the discounts, though? How much of it is about loyalty programs? How much of it about return policy, having an online presence and an offline presence? What do you think is really driving the growth in some of the retailers?
So it's a combination of all of everything that you just mentioned. So retailers are not lazy about their survival. They're trying to do everything possible in order to lure that shopper in. And it's working, it's paying off. Consumers are really rewarding those retailers that are able to give them a fast, convenient way of shopping. And some of it has translated into customer loyalty. So for example, at Ross and TJ Maxx, we're seeing that they're still performing strong despite the fact that they don't have much of an online presence. They have a very interesting business strategy that's very difficult to duplicate online, but they have the customer loyalty because of the value proposition.
Yeah, a year ago we were in a very different situation. Consumer spending kind of rolled over because we were having a terrible fourth quarter. And when people look to these reports and they say the consumer is strong, how durable is that? I mean, it seems like it can kind of flip on a dime sometimes. What changes your outlook for next year?
So it's interesting because it's not that the retail space is changing, it's the consumer, the whole area is just transforming. Let's just put it that way. Before it used to be that consumers used to go more into the store, and we're seeing that online continues to grow, but they're still spending and they will continue to spend. When you look at overall consumer spending, over about 90% of it still happens at brick and mortar stores, despite the fact that online, the money that consumers spend online continues to grow. So you're seeing that despite the online growth, consumers still prefer to go into the store. They still prefer to touch the avocados and try on the shoes. And that will continue to be in 2020. When we look at the winners and losers going into the next decade, we talked a lot about those that offer the consumer a lot of convenience. Omnichannel is key. Home Depot has been investing significant amount of money in their omnichannel. Their projections continue to be strong. We're also looking at Lululemon, which is an athleisure company, as that trend continues to be strong. And we're also looking
no
at
longer a trend, right? What Dan Roberts always says, it's not a trend.
Norm.
Yeah, soon I'm going to be wearing a Lulu quarter zip on the show. Right? Get rid of this blazer. That's more of the times. But Daron, as you're talking, it makes me think about other industries we've seen go to this winners and losers dichotomy. I mean, look at social media, right? We've got like 4 companies and everyone else has died. I kind of look at the rise, especially this year, of companies like Target. Walmart has had a great year. Obviously, Amazon. Are we headed to a place where everyone shops at like 5 retailers? You have like Nike's doing D2C and maybe they're in some Targets and everyone knows Lulu's crushing it, but all the names on the periphery, and we don't have to name those names, but we know the department stores that are out there. Are they just facing an existential crisis as consumers become more aware of what they want, what they like, and the big just get bigger?
Well, you mentioned something very interesting, social media, right? Because of social media now, consumers are empowered and they can go directly to the brands. So that's the difference. That's a big change we've seen over the last
You can
decade.
actually shop in the app now.
Yes.
On Instagram, you can actually just put it in your basket and check out without ever going to the site.
To the site, exactly. And so then you're skipping the middleman, and that's why we're seeing the department stores struggle so much. Before you had to go to Macy's to buy a Nike pair of shoes. Now you can just go on Instagram and purchase them right then and there. So that's a big shift. It's not that we're just going to be shopping at Walmart or the Target. It's just that the consumer is now empowered and can go directly to the brand that they like.
All right, Drone Martis with Refinitiv. Thanks so much for your time. Have a great holiday, and we'll have you back in the new year.
Happy holidays.
All right, coming up here on the final round, we'll have the sector watch. But first, let's take a look at some of the leaders on the Dow during a big day for the markets. Only had one, utilities, XLU, down about 0.2%. Eversource, Sempra Energy, and Evergy weighed on the utilities there. Sectors in the green, we had 10 of them. Among them, consumer discretionary, XLY, up about 0.8%. Ulta Beauty led the way higher there. That stock was up after the company reported third quarter earnings that beat analyst estimates, with sales driven by higher margin cosmetics. Tech sector also higher on the session. XLK up over 1%. Chip stocks doing a lot of work there. Micron, Western Digital, and NetApp among the best performers on the session. Well, coming up here, we'll have what we're watching next week in the Look Ahead Plus. Would you spend 140 grand for a banana duct taped to a wall? Well, if you would, then you can buy it at Art Basel Miami. We'll talk about that right after this. All right, now here's a look ahead at some of the stories that will be making headlines next week. Well, the final jobs report of the decade was released on Friday morning, and in so many ways, it was the perfect report to cap a decade spent waiting for the other shoe to drop And that shoe, of course, never really did. Just a few months ago, recession fears were real. The yield curve was inverted. The manufacturing sector around the world was in a downturn. And the biggest question is whether the consumer would be impacted next. But with Friday's jobs report, we've now seen job gains average 205,000 over the last 3 months. The unemployment rate is back at a 50-year low, and the stock market is back within a percentage point of record highs. Challenges, of course, are still facing investors and the economy as we enter a new decade. We've got the trade war, the election coming up, and so on. But by the end of this decade, it probably shouldn't have been such a surprise to see data come in better than expected. Then again, missing one more positive turn in the economy and the markets one last time in the 2010s, I think, is the perfect way for everyone to go out. Now, turning to the calendar for next week, on the macro and political side, things are going to be quite busy. On Wednesday, the Fed will announce its latest policy decision. We're not expecting any change in its interest rate policy, but the central bank will offer a final set of economic projections for next year and a dot plot indicating expectations for future rate moves. Then on Thursday, the UK will hold a general election, and on the same day, ECB President Christine Lagarde will hold her first meeting as the head of the central bank. Elsewhere on the calendar, Friday's retail sales data for November should be the week's biggest U.S. economic data point. And then on the earnings side, we are expecting results out of Chewy, GameStop, Adobe, Oracle, and Costco. A banana duct tape to a wall went on sale at Art Basel Miami Beach this week. The cost was $120,000. Now, 2 of the 3 editions are already sold. The third is expected to sell for even more. It's titled The Comedian. The gallery's founder says the duct tape banana is, quote, a symbol of global trade, a double entendre, as well as a classic device for humor. Akiko obviously sees the humor in this.
Oh man, I'm just looking at this thinking, where is the 120,000 value in it? Like we can grab a banana and just tape it to the wall. So whoever
Yeah, but it wouldn't be your idea. You're stealing
Not anymore.
You're stealing the
no
IP.
longer. But I don't know, 120,000.
Well, the
also,
question,
what happens when the banana rots?
I was going to say, you wait 1 or 2 weeks, and it's gonna be pretty nasty.
Right.
It's gonna kind of like just shrivel up.
So then you can have a collection of fruit flies also for that 120 grand. Now, Jared, maybe the viewers don't know, you're a Miami guy, born and raised down there. Tell us about Art Basel. Like, I hear about it, and I'm like, whatever, who cares?
It's really big. It's so big that I try to avoid the beach when it's there because it just gets packed. They don't have enough venues. That's how big it is. So you go into McDonald's, and they'll have displays there. I don't think they tape bananas to the wall at McDonald's, but
maybe they could do Big Macs, which, by the way, those will last.
Yeah.
If you taped a Big Mac to the wall,
that would survive a nuclear holocaust.
Yeah, but those things, like, they're not going to go stale.
Yeah.
Remember there was that famous thing, like this high school science class, like put a Big Mac in like a glass case, and 40 years later it basically looked the same.
Does the Big Mac outlast the Wonder Bread? That's my
Tell you
question.
what, I'm going to leave the leftover for my lunch.
Yeah, I think it probably does, right?
I don't think so, no. I think the bread lasts longer.
Well, all right, here we go. Final round, Art Basel. We are going to take a loaf.
I think that's a $120,000
We're going to take a
idea.
loaf of Wonder Bread, but we're going to find a loaf that's uncut so that the loaf will stay on the wall. Then we're going to take duct tape, hang it up there. We're going to put it on this wall right behind us on the studio. So this board, the Empire State Building is now going to be a loaf of Wonder Bread for as long as the bread stays good.
If you so much as touch that with your finger, you're going to have people running in here freaking out.
I suspect this board is also worth more than 120 grand.
Yeah, it probably is.
Probably is. But it'll be worth even more once we put Wonder Bread on it.
On the record.
you
Somebody
go.
might be looking at our idea right now.
They're in the studio going out to
they're leaving.
Walgreens to buy Wonder Bread. Coming up here, we'll have more of the final round. Plus, Ethan Wolfman will join us to talk about Yahoo Finance's most influential companies of the decade. Are we sure that that first company belongs? Maybe we were, probably Spotify. We have the list right after this. back to the final round here on Yahoo Finance. Miles Ellen with you in New York. I'm joined by Akiko Fujita as well as Yahoo Finance's Jared Blickery. Let's take another look at where we settled on this jobs day. Rally ho on Wall Street. Dow up 337 points, up 1.2%. The NASDAQ up 85. The S&P closing right about, what was that, 8 points below its record high. So, Jared, we are back. I wouldn't even say in the neighborhood. We're basically next door to record levels at this point. You and I were discussing at the big board earlier this idea that perhaps we could see the rally extend into even further highs as we head towards the new year. It seems like with the seasonality and just the strength that this market has shown in a week where headlines were quite negative for a couple of the sessions, the bulls are clearly in control here.
Oh, definitely. The biggest pullback that we've had in this rally so far is 2.7%, which is just about nothing. And then you look at some of the sectors making record highs. We had communication services today. Fins are close to their 2007 highs, 2019 high. What else? Staples, which was underperforming today, even that is making record highs. So we got tons of breadth in this market. You look at the internals, the New York Stock Exchange advanced decline line, that's almost at a record high. If we get one more day of gains, it would be a high. So basically everything's confirming the strength of this market right now. What could set things off and pull things down is the trade negotiations. If we get additional tariffs on December 15th, I don't think that's priced in. What we saw Monday was just a little hiccup. You'd see much more of that.
You know, Akiko, surprised me the speed or the force with which investors have priced in that a deal will just get reached. Because we're now 9 days away, and it doesn't really seem like a whole lot has changed per se.
Yeah.
Like the market said, but it's fine.
And I think it's not just about the phase one deal, whatever that looks like, right? It's also not looking at, as I see it, sort of this decoupling that's happening. I mean, that seems to have much more longer lasting impact than anything that we're hearing, any details we're hearing about this deal. But you're right. I think that the market has just been very optimistic. And it's been interesting to see it move on these trade headlines when they pretty much have been the same.
I agree. You know, you come in and you're like, okay,
it's an excuse,
I guess.
It's an excuse for the algos to pick up 10 points in either direction. That's about it.
All right, well, 10 points in either direction awaits us in the week ahead. All right, we are wrapping up 2019, and Yahoo Finance is taking a look back at the year and the decade that was. Let's talk a little bit about some of the companies, or some of the decades, most influential companies. We're looking at the chart here. You know the names, the logos, Instagram, Betterment, an interesting one, Slack, of course, everywhere. And then WeWork. Ethan Wolfman joins us now to discuss. Ethan, let's just start with the good. So we have the influential companies that ended up doing good or interesting things, and then maybe we can get to the company that starts with a W.
Let's start with Instagram. I think this is probably the very...
Which might not be good, I guess we should say.
Well, yeah, it certainly may be toxic in many ways, but what it certainly has done is change significantly how we interact with social media. Having an image-based thing first has changed how companies put their images into the world, how people buy things, how people see things. Influencer culture has changed considerably since Instagram. I think it's really important to talk about and sort of keep in mind the relationship between all of these companies that are new of this decade with the older companies from the decade before. All of this stuff is built kind of on the backs of the Amazons, the Googles, the Apples, and also the Verizons, the AT&Ts, that provided this way of having internet connectivity in our pockets, which really drove a lot of the innovation that influenced the decade.
I'm surprised that there's no ride-hailing in there.
There is.
Did I just not see it?
Uber and Lyft. I mean, that
to me just changed the way that we operate on a daily basis, right? Like I was thinking this the other day. I was at the airport, and you just have a line, like a whole drop-off section, and everybody is relying on that when they land. I mean, that is just changing the mindset with which we operate.
LaGuardia is spending billions of dollars to completely reshape the airport with these companies' services in mind. I mean, it almost says that no matter how poor Lyft or Uber management behaves or acts or manages the company, they have to exist, right? We've all assumed they will now be here forever.
It's become one of those tools we can't live without.
Let me ask you, because the only name I saw on there that relates to a FANG company is Instagram, which is, of course, Facebook. So is your criteria looking for companies that mainly were up and coming in this decade?
Yes.
Okay.
Yes. Yeah, I mean, I think for sure, if you think about the big companies that had the biggest impact, it's really hard to beat a lot of these incumbents. It's really hard to be a company now, to start, and especially to stay your own company. I mean,
well, Instagram didn't beat them; they joined them.
Yep, exactly. And I think we're going to see a lot of that continue because, it is really, really hard to beat an Amazon, a Microsoft, a Google. And I think it's really important to mention that, Amazon Web Services and Microsoft Azure, all of these sort of cloud computing products, they had an enormous effect, as large as anything else. They make all of this possible. And I think that's, yeah.
No, there's an AWS commercial that they play that says that. It's actually a better commercial for Peloton than the Peloton commercial that Peloton runs.
Peloton also on the list, in a way that it is changing exercise. I think we're going to be likely seeing more of this into the future. Trends of taking something like a spin class, which is not particularly scalable. You need bikes, you need real estate, and just throw it in the house. Make it more available to more and more people. You can sell hardware, you can sell software, you can sell accessories, you can make those commercials.
Yeah.
And also we've seen a lot more of, I think this is Instagram's influence, a lot more of this direct to consumer and other ways to have direct to consumer. A lot of companies sort of following Warby Parker's lead, which was 2010, but I didn't put them on there. And having a really different relationship between customer and brand company, really, and having ways to either find new products, discoverability, talking about it. I put Instant Pot on there because you have this forum and community, which is so kind of tied to the product itself. That's something that we haven't quite seen in the same way in the past.
Yeah.
On the scale that we see today.
People develop passion about a pressure cooker. We'd be remiss if we didn't discuss WeWork briefly because I think it's been a debacle. There's a lot more chapters in this story to be written, but in many ways, WeWork is the company that perfectly distills what that whole 2010 Silicon Valley moment had been building towards.
I threw WeWork on here because I think their sort of innovation was they took something of the sharing kind of economy or the efficiency economy of trying to maximize, suppliers and supply and demand, and doing that with workspace for companies. Clearly, they're losing billions of dollars from it, so what they're doing isn't quite right. But it's really interesting to think about a company or a startup that is trying to scale. Here's a simple way to make it quick and easy, even if it costs a little bit more. And so I think applying those sort of Airbnb, Uber methods to this sort of interesting space may be something we see more of in the future.
Well, and you could argue that WeWork's model, the idea wasn't what caused the downfall.
Right,
it was
right.
the way in which
self-dealing.
they scaled out.
Yeah, but of course, I think a lot of the companies that we're talking about have great models. Some of them haven't made a ton of money either because they weren't pressured to, or we've definitely seen the downfall of a number of these founders, right? Travis, and Adam Neumann, not the least among them. All right, Ethan Wolfman with the most influential companies of the decade. Thanks for stopping by. Kiko Fujita, Jared Blickery, thanks for stopping by as well. Have a great weekend. We'll talk to both of you coming up next week. And coming up here today on the final round, former White House economist Austan Goolsbee breaks down the jobs report. We are back with that conversation right after this. November's blowout jobs report signaled further strength in the U.S. economy, thanks in part to a stronger pace of hiring. Austin Goolsbee, economics professor at the University of Chicago and former chairman of the Council of Economic Advisors under President Barack Obama, joined Yahoo Finance earlier today to talk about the report and the Democratic candidate he recently endorsed.
Well, you know, it's funny because we've got kind of this two economies going, or 1.8 economies and a 0.2 economy. Everything that has to do with the consumer, the job market, is very strong and very solid. And those things that have to do with manufacturing have not been that great. And even in this strong jobs number, you saw only enough strength in manufacturing that it probably came entirely from the GM strike ending and them coming back. I think the strongest story of the U.S. economy was, is, and remains that the U.S. consumer remains confident and keeps spending.
Austin, I'm curious, that wage increase, 3.1%, and non-supervisory wages, I don't have the percentage, but they actually rose by 7 cents. What do you interpret all of that to mean? Are we really seeing a tight labor market, or as some analysts have pointed out, that there may be slack, and what you really saw with wage growth is the end results of the stimulus we got through tax reform and fiscal stimulus from last year that still lingers today?
You know, I don't know if it's from the tax cut. I think most of the tax cut did what it was going to do in the first year, and then the tyranny of the accounting is if it goes up and then stays steady, that counts as zero after the first year because it's not contributing to growth. I think that 3% number has been relatively stable for several months. So before this month's job number, as you know, and as you saw on the graphic, we had 4 months where the jobs growth was getting slower and slower each month. But the wage number stayed around this year over year around 3%. So that's certainly solid. There probably, or there may be still a little bit of slack from the people who are out of the labor force. Maybe they could keep coming in. In the other survey, you saw that the number of people out of the labor force actually grew a fair bit this month. So it'll be interesting to see. This was an encouraging month. But like I say, if you have to do with the consumer, it's looking excellent. If you have to do with manufacturing, they've kind of been in decline for 4 months in a row now.
So Austin, Joe Brasuelas here. At the outset of the show, you noted, I think rightly, the unbalanced economy we had. What policy measures would you put in place to address that balance or imbalance?
Well, look, not to get into the realm of politics, my view of the tax cut was it cost $2 trillion, and what it mainly delivered was a windfall. It did not generate the investment that was promised. It didn't generate $5,000 increases in wages. It didn't increase the growth rate to anything substantial. We're now looking at a forecast for this coming quarter in the ones. So I think revisiting that and investing on the personnel side and in the labor force for the job market that we know we're going to have and need 2 to 5 years from now, I would put the focus kind of in that area.
Hey, Brian Chung here. So we've seen that maybe some of the previous jobs reports that we've seen, at least in the beginning of the year, were actually revised downwards, not necessarily meaning that all revisions are downwards, but that has been the trend recently. Do you expect this to be a candidate maybe for a downward revision? Would you expect it to be substantial when the BLS does end up revisiting these numbers at some point down the line?
That's an important question. It very well might be, especially when you get things like when you know there's a big strike. Months like that tend to have substantial revisions when you look back. I think an interesting additional, it's not really a revision, but what is going to be the role of the temporary census hiring, which in this month, government employment looked relatively small. I wonder when they come back with the revisions, if there's not going to be some more significant component of that temporary census hiring that from now through, let's call it the spring of next year, they're going to be literally hundreds of thousands of people getting hired. And then as we go into the summer of next year, there's going to be literally hundreds of thousands of people losing their jobs. So it's going to wreak a little noisy havoc on our jobs numbers.
Austin, next summer we're also going to be even more fully in the throes of the presidential campaign. It's my understanding that you have just endorsed Pete Buttigieg in that race. Tell us why. What do you like about him, particularly from an economic perspective?
Well, look, I think he's smart. I started skeptical, I will say, because he was a mayor. I got to know him. I think he's whip smart. His economic policy, I think, is spot on. In what he's placing his focus, and he's got a lot of energy, and it reminds me of, I was an Obama guy back in early in the day, 2006, 2007, out in Iowa. It kind of reminds me of what's going on there, and I just think there's so much chaos in D.C. these days. Somebody not from the D.C. chaos would probably be the order of the day.
All right, and coming up here on the final round, we'll have a look back at all the highlights and the lowlights from the 1,000 episodes of this program. Loyal viewers, remember that on Monday we celebrated our 1,000th show. We are back with that tape right after this. Final Round celebrated its 1,000th show earlier this week. Let's take a look back at some of the best moments in all of Jen Rogers' haircuts right here.
Stocks start the week off strong, soaring higher into the close. This is the Final Round. Global markets in turmoil in the wake of the UK's surprise Brexit vote.
This was not just a rejection of the EU. This was a rejection of the political elite.
They bailed out the bankers. They didn't help the little guys, and this is fallout from it.
Has enormous parallels here to the election cycle that's taking place in this country.
A surprise Trump win sends stocks on a roller coaster ride.
He has shown an ability to surprise. I mean, surprise he won. Surprise, the market's up after he's elected.
There's no question we're in a geopolitical recession because Trump ran on America First mandate.
So let's talk about Snap, because it is now a public company.
I think the stock market's reception showed that a lot of investors who do invest in public markets felt kind of left out. It's cool to say, I invest in Uber, I invest in Lyft, I invest in Snapchat.
We were just together for the announcement that Trump is nominating Jay Powell as the next Fed chair.
That was up from 40 points to 90 points, which,
That's doubling.
Now that we're almost at 24,000, it means a little bit less.
What are you thinking about Bitcoin?
Well, what is it? Bitcoin is money without a central authority.
It's up 538%.
You never want to use the word bubble, first of all. But also, as our editor-in-chief Andy Stover loves to mention, there are people buying up Bitcoin because they see that it's going up, but they got no idea what it does.
Joining us now, Elizabeth Warren. Let's talk about tax reform, pushing ahead.
The Republicans have decided that they want to push forward a bill that will give $1.5 trillion in breaks to giant corporations.
Another episode in the books, number 500.
The truth about Facebook, in a lot of people's minds, is that they have too much stuff. We need to find a way to regulate the stuff they have, and perhaps the company itself has monopolistic qualities.
Markets are people too.
Yeah, right.
They are.
Why isn't it Ms. Market?
Ms. Market. Let's go to Shauna Smith on the floor of the New York Stock
There's Ms.
Exchange.
Market.
Hello, Shauna.
That's actually a person.
Okay.
Definitely a person.
Jared Blickery live for us at the floor.
Yahoo Finance. Thank you.
He's about 10 feet away from you.
With this tweet from Elon Musk, am considering taking Tesla private at $420, funding secured.
The stock climbed steadily throughout the day, and then that tweet broke and it went haywire. NASDAQ finally halted the stock.
So-
He said he had secured funding. He might be in a little bit of trouble here.
Elon Musk was seen smoking. What he was told was marijuana.
Hang on.
Excuse me. It's not legal
It's
in
not
New York.
legal in New York. Shoot, Miles, that was a good idea of yours, though.
The unemployment rate did fall to its lowest level in 48 years.
Go back to 1969, that year, 550,000 Americans were fighting in Vietnam out of the labor force, which makes today's number look that much better. Hello and welcome to Yahoo Finance's coverage of Berkshire Hathaway's annual meeting live from the CenturyLink Center in Omaha, Nebraska.
On to the big story of our time, the hunt for HQ2. I know, but I'm still talking about it. Crystal City, Virginia, and Long Island City, New York would be the new locations. Various government, city, and local officials are protesting the new HQ2.
It's not about the tax incentives. It's about the fact that people who have talent in these fields are already coming to New York City. So why are we incentivizing companies who already wanted to come here anyway?
Guess who's here, you guys? King joins us on the set right now with his handler, Gabriel Rangel. Breaking news, it finally happened. Uber has filed to go public. Let's go to Jared Blickery. He is in our newsroom with more details. Jared.
We learned that they actually turned a profit in 2018, $997 million in net income.
We've got our final round team on the ground. Jen Rogers and Miles Udland live for us.
Miles and I obviously both made it to Omaha.
Last year at this meeting, we were discussing that they had increased their Apple holdings. Now it's about Amazon.
And it is a big day at the New York Stock Exchange for Yahoo Finance. This is to celebrate our brand new studio and 8 hours of live bell-to-bell coverage. And on the podium, a group of Yahoo Finance executives, anchors, and reporters.
I have an awesome surprise for you guys. Don't peek. I present to you, Miles and Jen, and to the world, the Yahoo Finance desktop Trump-ometer.
Oh my gosh, I love it.
It is an A+, I would say.
A+.
I would say it's a huge.
Big day for Dunkin' CEO David Hoffman and Beyond Meat founder Ethan Brown. New product launch. You told us on IPO day you haven't watched the stock price. Are you watching the stock price at all?
He is not today. I've been with him every minute. I've been looking at this.
All right.
By the way, that was a full sandwich.
This was a full sandwich when that interview started, and I am.
Jen is going ham on
it.
Scott Gamm was the first to report that the Dow 28,000 hats had been printed.
I'm here with Peter Tuchman, who, by the way, is responsible for printing and distributing the hat.
I'm the hat guy.
We're back right after this.
Plenty of economic data for investors.
That's all there is from New York. This is the final round on Yahoo Finance.
All right, and coming up here on this edition of the Final Round, we'll have what you missed today on Yahoo Finance. We're back right after this. It's time now for all the best moments that you missed today right here on Yahoo Finance.
Trump now knows he's got a strong market, high confidence, and is negotiating from a position of strength going into December 15th. So all bets are off in terms of if this market can keep going, based on the fact that this good news is going to give Trump extra leverage to push back on China.
There's very little not to like about this report. I mean, not only do we get much stronger than expected job growth, unemployment rate coming down. I mean, if there's anything that you could kind of, quote, quibble about here, it's that average hourly earnings weren't quite as strong as expected.
Everything that has to do with the consumer, the job market, is very strong and very solid. And those things that have to do with manufacturing have not been that great.
The workers that I talk to are very hesitant to report or even say anything to their passengers or their clients because they're going to get rated and ranked, and that affects their ability to get work in the future.
Over time, you're going to see more and more services that will include ads as we move away from cable into a pure OTT and streaming world, and that's going to take probably a decade for us to get there.
One negative about today's jobs number is that it might mean that the negotiation go on for a little longer because, as you mentioned, it shows that the U.S. economy is doing a lot better than what we had previously thought. That might mean that President Trump is going to look for more concessions from the Chinese.
The labor market is a lagging indicator. It's literally the last shoe to drop. So I still don't think the uncertainty component's gone.
All right, that's all for now from New York. Miles Udland is here. Final round is there. We are done for this week. All three major averages going out on top after a very strong November jobs report, just about a half percentage point below record highs for the Dow and the Nasdaq. The S&P just 8 points off its record. Very big week next week. UK general election, Fed meeting, ECB meeting, tariff deadline next Sunday. But for now, that's it. I'm Miles Udland. This has been the final round of Yahoo Finance. See you on Monday.